Hello students, myself By Ca Subramanyam and I welcome you all to the revision lectures of Paper 2 Corporate and Other Laws at CA Interlevel. Before you watch revision lectures, kindly listen to my instructions. Then only you can gain maximum advantage, maximum benefits from these revision lectures. See, today many students fail exams not because they lack knowledge, but because they do not revise effectively. Understanding concepts is one important challenge, but retaining and recalling them under exam conditions is another challenge. To overcome this challenge, I can help you with these revision lectures. See, the duration of total revision lectures would be around 14 to 15 hours. And yes, 14 to 15 hours, why sir? Because we considered the day before your examination. So roughly you will find 24 hours to revise paper 2 a day before examination. So considering this time constraint, we made revision lectures with a total duration of 14 to 15 hours. And these revision lectures are available in two parts. Part 1, total company law. In company law, we are having 11 chapters, right from preliminary to foreign company. So I covered all these 11 chapters in part 1 marathon. And the weightage of company law, you all know it is 60 marks. Including choice, you can expect 72 marks from company law. And you can see the duration of part 1 marathon would be 9 hours 15 minutes. And the other four topics which I am going to cover in part 2 is LLP, FEMA, Interpretation of Statutes, General Clauses Act. So which I will upload them in the next week. And the duration of part 2 would be roughly 4 to 5 hours. So you can use them a day before examination also. You can listen to them. You can use these revision lectures day before examination also. Getting my point, students? Next one. Throughout these revision lectures, I used this book, CA Inter Law, the Master Notes. See, we summarized entire study material into 220 pages without ignoring a single concept and without compromising keywords. Everyone. So, these 220 pages, if you prepare, I can tell you honestly, you can score maximum marks in objective as well as descriptive paper. For example, you can see the fourth point in this, accounts of companies, filing of financial statements with ROC. Based on these 3 points, in last attempt, 8 marks case scenario based questions came. 8 marks case scenario based questions came based on this fourth point. And reading this, you feel comfortable. Getting my point, students? Everyone. So that's it. So, sir, where to download this material, sir? You can see in our website, Shrestha for CA and CMA. In this website, go through the free resources. And here you can see P2, Corporate and Other Laws, D.V. Subramaniam, sir. Just open that. And there you will find P2 Law Master Notes. So you can download this, you can read it. Sir, I want to purchase a hard copy, sir. Yes, it is also available under Books tab. You can see under Books tab, CA Inter, select EVO Fast Track. So here you can see the physical hard copies. You can see hard copies. CA Inter Law, only concept book, color book available for 429 rupees. No sir, I want question bank also, sir. In question bank we covered all the illustrations that are there in chapter plus practical questions at the end of the chapter plus last 3 attempts MTPs, RTPs and question papers. So reading this concept book, solving that question bank, honestly telling you, you can score maximum marks. You can comfortably attempt examination. That's it. That's for sure. Getting my point, students? So you can watch the lectures from now onwards. I wish you all the best for your exams and just comment below, how you felt with these revision lectures. Thank you very much. Hello students, myself D.V. Subramaniam. Welcome to CA Inter Paper 2 Corporate and Other Laws quick revision lectures. Before I get into quick revision, let me explain you the weightage of each and every chapter that is there in our syllabus. Total in our paper we are having 15 chapters. 11 chapters Companies Act, 11 chapters from Companies Act, 1 LLP Act and 3 chapters from other laws. So if you look into the weightage, I took 3 attempts question papers and 3 attempts MTPs. That means 6 MTPs, 3 attempt question papers. Particularly if you look at May 24, it is for 89 marks because multiple choice question paper, objective paper is not available. And all remaining papers you can see 119 marks. So on an average, if you observe carefully, the highest weightage chapters are FEMA 14 marks, General Clauses Act 12 to 14 marks, LLP 14 marks, next Management and Administration 15 marks, Accounts of Company some 10 to 12 marks. So based on the content, that means size of the chapter and weightage of the chapter, I classified these 15 chapters into 3 parts. So first priority chapters, total 7 chapters are there in priority A chapters, priority A topics. You can see here deposits, charges, dividends, foreign company, LLP, General Clauses Act, FEMA. So from these 7 chapters, 7 out of 15 chapters, the average weightage in the last 3 attempts question papers as well as 6 MTPs is 62 marks. And if you observe carefully, sir, deposits, charges, dividends, they are having just 6 marks now, sir. But observe carefully, share capital, if you look at the share capital, the average weightage is 8 to 10 marks. But if you look at the size of share capital, it almost covers deposits, charges, dividends, foreign company. In share capital, we are having 30 sections. But if you look into deposits, some 4 to 5 sections, charges 11 sections, dividends 5 sections, foreign company some 10 plus sections. So total, when you total all these 4 topics, it's almost equal to share capital. So looking at the size of the chapter and weightage of the chapter, I classified 15 chapters into 3 parts. Part A chapters, don't ignore these chapters. And for covering these part A chapters, roughly 40 hours is sufficient. 40 hours of preparation is sufficient for covering all these 7 chapters. And when you complete, more number of chapters, having more weightage, psychologically you feel happy to read remaining chapters. So these are first priority chapters. Second priority chapters, management and administration, preliminary, incorporation, prospectus. Weightage point of view, moderate, and content point of view also moderate. If you look at incorporation, 20 sections are there, prospectus 20 sections, preliminary only 1 section, it's all about definitions. Management and administration, yes, we are having 35 sections, but looking at the weightage, yes, this would be a second priority chapter. You can take management and administration to part 1 also, but the point is, in part 1, content point of view small, weightage point of view either moderate or high. So here, weightage point of view moderate, content point of view also moderate. Next chapters, next priority chapters, interpretation of statutes, share capital, accounts of companies, audit and auditors. Content point of view somewhat, moderate to high. Weightage, average weightage. Are you getting my point? See, don't skip any chapter. If you are able to cover all the chapters. Or at least cover in this order, so that what happens, even if you complete first 2 priority chapters, first 2 priority chapters is 11 chapters. Even if you cover 11 out of 15 chapters, you can easily attempt some 62 plus 27, some 89 marks. That means approximately 90 marks you can easily attempt. If you have time, go with these chapters. And you had one more alternative. That alternative is, sir, I'll prepare all the chapters, sir, but some little things I want to ignore, sir. See, if you want to prepare one chapter, prepare it thoroughly. Don't take internal choice. Because if you take share capital and debentures from this chapter, in September 24 attempt, 5 marks question came on section 49, 50, 51. Actually, these are like miscellaneous topics, calls on shares, calls in advance, dividend, whether dividend is paid on face value or paid up value. These 3 sections are like miscellaneous concepts. No one expect question from this area, but 5 marks question came on this on these topics. So if you want to leave the chapter, leave it completely, or if you are preparing any chapter, prepare it thoroughly. Clear? So even if you prepare these first 2 parts, you can easily attempt 90 marks. Our question paper is for how many marks? 119 marks. So if you have time, go with these topics. First priority topics, read 3 times. Second priority topics, read 2 times. Third priority topics, at least cover 1 time, so that you are not going to miss any multiple choice question, objective question. And the second point is, if you look at our question paper, 90% of questions are practical questions. As you know, in practical questions, we need to write answer in 3 parts: provision, analysis, conclusion. So provision, and if you look at the weightage of each and every question, the maximum weightage of each and every question would be 5 marks. He's not asking 10 marks questions. He's not asking 8 marks questions. Yes or no? Maximum, a question can be asked for 5 marks. So in that provision will have a weightage of some 2.5 to 3 marks. Analysis, conclusion, some 1 mark, analysis, some 1 mark, conclusion, some 1 mark. So provision, for writing provision, no need to read complete study material thoroughly. So here I came up with a exam oriented notes. So this is of 220 pages. Even if you read this book, it is sufficient to write provision in your own words. For example, if you are reading exact content in the study material, you cannot reproduce that exact content in the examination. Clear? So if you miss any keywords, definitely it leads to loss of marks. So in this summary notes, or in this, in this book, you will find everything is summarized but with keywords. A day before examination also you can prepare using this book. Is it clear? So this is of complete 220 pages. This is the summary notes. And we had one more book called Question Bank. In that Question Bank you will find all the questions from study material and 6 attempts MTPs, 3 attempts question papers. Clear? That's okay, fine. So in this marathon I will cover all 15 chapters. So before I start any concept, first I'll give you a previous examination repeated questions concepts. Clear? So now coming to first chapter preliminary. First chapter preliminary, you all know in preliminary we are having only 2 sections, section 1 and section 2. Section 1 is all about scope, extent, applicability of the Companies Act 2013. Section 2 is all about definitions. So in the definitions part, these are the definitions which were repetitively asked so far, and these are the important definitions. So just look at the screen. Private company. So private company, question may be asked like this. In this company, for example, number of members as per register of members is 350. In that, number of employees is 100. Number of former employees who became members during the employment, right now they are not in employment, like that some 50 are there. Joint shareholding, some 30 to 40 members are there. Like that they will ask you a question whether company has defaulted the limit of number of members as per provisions of section 2 clause 68 or not. So limit on number of members, to test limit on number of members, a practical question can be asked. In past 2 to 3 times question came on this concept. Next one, small company associated with financial statements exemptions. As you all know, financial statements means 5 components: balance sheet, profit and loss account, cash flow statement. Next one, statement showing changes in equity, notes to accounts. But for small companies, certain exemptions are there. Cash flow statement is not required. So they may ask you a question. First they will ask you whether the proposed or whether the specified company in the context is a small company or not. And again, for small company, you have to remember all the exclusions like public company, statutory company, section 8 company, subsidiary, holding company are excluded from the definition of small company. So you need to identify whether it is a small company or not, whether small company is exempted from cash flow statements or not. Like that a question can be asked. Next one, subsidiary company. Here they will illustrate a situation and they will ask you what is the relationship between these 2 companies, or what is the relationship between 3 companies. Are you getting my point? They won't ask you define subsidiary company. They will illustrate a situation. In that situation you need to identify which one is a subsidiary, which one is a holding, which one is a associate. Next one, financial statements exemptions point of view. Which companies are not required to prepare financial statements. Like this also question they will not ask. They will give details of one company, and they will ask whether company is required to prepare cash flow statement or not, whether company is exempted from preparation and presentation of cash flow statement or not. Next one, listed company. These points, financial statements I'll discuss with you in accounts of companies. Listed company I'll discuss with you in prospectus. Listed company, they will not ask you a definition, but very recently we can see certain amendments happen to the listed company. Some companies are not treated as listed company even though those companies' securities got listed on stock exchanges. So what are those companies? For that, they will narrate a story and they will ask you whether it is a listed company or not. Next, definition of free reserves, definition of promoter, definition of books of accounts. So these last five definitions I will cover in the respective chapters. So in this present in the preliminary chapter, I will cover only these 3 definitions. Is it clear? Can I proceed? Fine. So definition of the company, you all know company means company incorporated under Companies Act 2013 or any previous law. That means company is equal to existing company plus new company. Existing company plus new company. Sir, what is existing company? Company which got incorporated under previous company laws, that is Companies Act 1956, Companies Act 1913. New company means what? A company which is getting incorporated under New Companies Act. Clear? So only an incorporated association, if such incorporation happens under Companies Act, we call it as a company. There is a difference between body corporate and company. Body corporate means an incorporated association. Any association getting incorporated under any statute, we call it as body corporate. For example, LIC, LLP, next one, companies, all these are body corporates. But if that association is getting incorporated under Companies Act, we call it as company. So every company is a body corporate, but every body corporate need not be a company. Clear? If that association is incorporated under foreign company laws, that means if a company is incorporated outside India, it is a body corporate, it is not a company. Next one, private company. What is a private company? It is a company with a paid up share capital, minimum paid up share capital as may be prescribed. And its articles of association shall contain 3 conditions. What are those 3 conditions? Restricts the right to transfer its shares. So in what manner, restrictions are placed on transfer of its shares? Prior to transfer, yes, transferor has to intimate board of directors. And such transfer shall be done in favor of existing members. If existing members are not willing to purchase shares, then transferor has to sell shares to the persons identified by the board. At what price? Price fixed by the company, certified by the company auditor. So who will fix the price? Board of directors fix the price. And who will certify the price? Auditor certify the price. In this way, right to transfer of shares is restricted. It's not prohibited, it is restricted. Next one, limits number of members to 200. And while counting 200, 2 precautions we have to take. One precaution is all present employees are excluded. All present employees who are members of the company are excluded while counting 200. And all past employees, former employees means past employees who became members during their employment and subsequently terminated from the employment. Yes, those people are also not counted for the purpose of 200. And next precaution is joint shareholders are not counted as 1, 2, 3, 4. All joint shareholders, that means 2 or more persons holding a single share certificate jointly, they are counted as 1. Suppose 5 couples are there. Each couple is holding a share certificate jointly. Actually, number of members means 5 into 2, that is 10. But for the purpose of count 200, it is not 5 into 2, it is 5 into 1, that is 5. That means how many persons are holding share certificate jointly? All those persons are counted as 1. Are you getting my point? Couple means how many people? 2 people. 2 people holding share certificate jointly means we need to consider them as 1. Okay, na? So in the recent examinations, if you look into the question papers since May 2018, so the question was asked on this particular point, how they asked, there is a company called C Limited, a public limited company. Number of members as per register of members, as per register is 340, imagine. While verifying the registers, we came to know that present employees who became members, some 120 are there. Past employees who became members during their employment, some 30 are there. And 5 couples are holding shares jointly. Now, for the purpose of 200, how we should count? 340 minus present employees shall be excluded, minus past employees who became members during employment shall be excluded, and 5 couples, that means, maybe 10 is included in this 340. We need to exclude 10, and in that place we need to add 5. So total, if you observe, 120 minus 120 minus 30 means minus 150, minus 150 plus 5. Yes or no? What is the calculation? Just wait. It's not minus of 10 minus 5 actually. It's actually minus of 10 minus 5. So that means total 155, right? 120 plus 30 plus 5. 155. So 340 minus 155, total it would be 285, correct? How much it is? Yeah, 185. So since the number of members is within the limit of 200, yes, company can be converted into private limited company. Getting my point, students? Forget about the calculations. Just I am telling you who are excluded and how joint shareholders are considered as one. It is important. Next one, prohibits any invitation to the public to subscribe for its securities. Can private company make public offer of its securities? No, it is prohibited. So restricts transfer of shares, limits number of members to 200, prohibits invitation to public to subscribe its securities. And Section 8 company is exempted from minimum paid up share capital requirement provided it has not committed any default under Section 90 to 137. Can I proceed? Next, important definition, important part of public company definition. Important part of public company definition. See, what is a public company? A company which is not a private company and which has minimum paid up share capital as may be prescribed. This is okay. This is okay. But they can ask you a practical question on the second part of definition. The second part of public company definition is any private company by its articles of association, if it is subsidiary to public company, then this private company, even though it is private company by its articles, it is deemed to be public company as per the provisions of Companies Act 2013. That means to this company, all the provisions that are applicable to public company, applicable. But this company cannot offer securities to the public because its AOA is containing prohibition clause. Getting my point? That means deemed public company will have only disadvantages of private company and disadvantages of public company. It cannot enjoy advantages of private, it cannot enjoy advantages of public. Are you all getting my point? Everyone, what is the second part of public company definition? Any private company, if it is a subsidiary to public company, it is deemed to be a public company. Next, small company. Small company, we need to identify small company in the context. So they will illustrate a story, they will give you a story, beautiful story, and they will ask you whether it is a small company or not, whether small company is exempted from preparation and presentation of cash flow statements or not. Like that they will ask you a question. So to become a private company, a company should satisfy three conditions. How many? Three. First one, it should be a private company. Other than public company means private company. Its paid up share capital is up to 4 crores. That means 4 crores is also covered. And its turnover is up to 40 crores. Any company satisfying these three conditions, it is a small company. Are you all getting my point, students? Everyone. But if that private company, for example, take up GMR Private Limited. For example, GMR Private Limited, its turnover is 30 crores. Its paid up share capital is 3 crores. So whether GMR Private Limited is a small company or not a small company? Yes, it's a small company. Suppose, what would be your answer? Out of 3 crores paid up share capital, 2 crores share capital was held by P Private Limited, Prasad Private Limited. Let me repeat the last point. Suppose, what would be your answer? 2 crores out of 3 crores paid up share capital held by Prasad Private Limited. Now the answer is different. Why? This is a subsidiary company. A subsidiary company is excluded from the definition of small company. Holding company is excluded. Subsidiary is excluded. Statutory company excluded. Section 8 company excluded. Public company is also excluded. Getting my point? Everyone. And what would be your answer if Prasad Private Limited paid up share capital is 1 lakh, turnover is 10 lakhs? Yes, Prasad Private Limited is also not a small company because it is holding company. Everyone. Another example, LIC, Life Insurance Corporation, which got incorporated under LIC Act 1956, for example. Its paid up share capital is 10 lakhs, its turnover is 30 lakhs. Whether it is a small company or not a small company? Not a small company because it is a statutory company. Statutory company means any company registered or incorporated or came through a statute. Can I proceed? Small company also over. Next, subsidiary company. Subsidiary company. In how many ways a company can become subsidiary? Primarily in 2 ways a company can become subsidiary. One is control over composition of directors. Other one is if one company is having more than half of the total voting power. Getting my point? If my company or my body corporate, because holding company, the status is given to both company and body corporate. If my company or my body corporate is having control over composition of directors in your company, then your company becomes subsidiary. Suppose if my company is having more than half of the total voting power in your company, then also your company becomes a subsidiary. Sir, control over composition of directors means what? Appointment or removal of majority or all directors. Suppose in your company total 9 directors are there. 8 out of 9 directors can be appointed by my company. Then my company becomes holding company, your company becomes subsidiary. Question came like this only, 8 out of 9. This is one way. Second way, half of the total voting power. This voting power can be exercised in 3 ways. Directly, direct and indirect, totally indirect. Direct and indirect, totally indirect. For example, C Limited is having 60% voting power in P Limited. Now P Limited is a directly subsidiary to C Limited. Suppose P Limited is having a 59% control in A Limited. Now A Limited is subsidiary to P Limited. A Limited is also subsidiary to C Limited. This is totally indirect. Deemed subsidiary. Are you all getting my point, students? Next one, direct plus indirect. Suppose C Limited is having 60% control in P Limited and C Limited is having 20% control in A Limited. And P Limited, in fact, it is also having some 40% control in A Limited. Now, if you observe, in A Limited, C Limited is able to control 60% of the voting power. How? C Limited directly 20 and indirectly 40. Getting my point? Now, in this way, A Limited becomes subsidiary to C Limited. And A Limited is an associate company to P Limited. Getting my point, everyone? So they may directly mention voting power, or they may mention, total paid up share capital of A Limited. For example, it is 60 lakhs. Out of 60 lakhs, 40 lakhs is held by P Limited, 20 lakhs is held by C Limited. Like that also they can ask you a question. Is it clear, everyone? So this is all about subsidiary company definition. An important point while finding out the relationship of subsidiary, you have to take care about this point. What is this point? Shares held as a trustee or in a fiduciary capacity do not make a company subsidiary. For example, two companies, let's take C Limited, A Limited. C Limited, A Limited paid up share capital. For example, A Limited paid up share capital is 1 crore. C Limited is holding 48 lakhs paid up share capital of A Limited. Now, is A Limited subsidiary to C Limited? No, it is just associate company because more than half condition not satisfied. More than half. Remember, more than half means greater than 50%. It's not greater than or equal to 50. It's greater than 50. Clear? Next, C Limited is having a managing director. This managing director is holding 4 lakhs paid up share capital of A Limited. One day, before the death of managing director executed a will. As per will, C Limited is the legal guardian to his son, who is 16 years old. Son is having age of 16 years. Until son attains age of majority. So who is the legal guardian to the son? C Limited. Accordingly, all the properties of managing director got transferred or transmitted to C Limited. Now if you observe, C Limited is holding total how much paid up share capital? 48 lakhs individual capacity, 4 lakhs as a legal representative capacity. Sir, now can I add both and can I tell yes, 52% of the voting power is with C Limited. So C Limited is holding, A Limited is a subsidiary. No, you should not add shares held in a fiduciary capacity. You should not consider shares held in a fiduciary capacity. Is it clear? So in the subsidiary company definition, if you put, if voting power, more than 50% voting power is with another company becomes holding company, this company becomes subsidiary. Suppose if that control is of significant influence, that means at least to 20%, but should not exceed 50%. Simply 20 to 50% control if one company is exercising in another company, that another company becomes associate company. Associate company includes joint venture company. Clear, everyone? And to whom holding company status is given? To all the persons, only to the company and body corporates, only to the company and body corporates holding company status is given. Can I proceed? Foreign company, we are having a separate chapter. There I will discuss. Government company. Government company, here the limit is, it's not greater than 50, it's not greater than 51, it's greater than or equal to 51%. Greater than or equal to 51% of paid up share capital held by CG or SG, partly by CG, partly by SG, then that company becomes government company. And subsidiary to government company is also a government company. Are you all getting my point? And here a tricky question can be asked like this. The tricky question is, suppose G Limited, one company is there. Its total number of equity shares, for example, total number of equity shares 10 lakhs. Out of 10 lakhs, 4 lakhs are held by Government of India, that is central government. Next, 50,000 shares are held by Tamil Nadu government. And 60,000 shares are held by Indian Oil Corporation, which is a government company. Now, you should not add 4 lakhs plus 50,000 plus 60,000. That adding is mistake. You should consider only government holdings, CG, SG, CG and SG. That means total how much? 4 lakhs and 50,000. Total 4 lakh 50,000. 4 lakh 50,000 out of 10 lakhs means the control is 45% only. But how much we need for determining it as a government company? 51%. So while calculating, you should not consider government company holdings as per the definition. Suppose if IOCL is holding 5.5 lakh shares of G Limited, 5.5 lakh shares of G Limited, then G Limited becomes subsidiary to government company. Default, it also becomes government company. Are you all getting my point? Everyone? Next. So that's it. Preliminary chapter completed. That's it. Remaining definitions I will cover in the respective chapters. As I told you, financial statements, accounts of companies, free reserves, dividends chapter, promoter next chapter, books of accounts, accounts of companies chapter. Can I proceed? Next, what is our next chapter? Incorporation of company. In incorporation of company, most repetitively asked concepts are one-person company. In that one-person company also, they will ask you eligibility criteria to become a member, to become a nominee, and what activities, from what activities OPC is prohibited. Next, submission of false information for incorporation. What are the powers available to NCLT? Section 7. Revocation of license of Section 8 company and its consequences. Reasons for revocation and consequences. Entrenchment provisions of AOA. Next one, exceptions to indoor management. So up to here, these concepts are very repetitively tested. And to the best of my knowledge, these concepts can also be tested, because if you observe question paper pattern, they are not going with general provisions, they are not going with general rules, they are always concentrating on exceptions, exclusions. So rectification of name can be tested in the upcoming attempt. Subsidiary not to hold shares in holding company, this question came almost 3 to 4 times. And in subsidiary not to hold shares in holding company, voting powers, particularly talking about voting powers, when voting powers are restricted, when voting powers are available, that point is very, very important. Next one, service of documents, alteration of situation clause, breach of minimum number of members, this can also be tested. First 5-6 concepts are repetitively asked. Remaining concepts can also be tested. Let's see. Incorporation of company and matters incidental thereto. Promoter. Who is a promoter? Very simple. 3 points, remember. Named promoter. Named means one who has been named in prospectus or annual return as a promoter is a promoter. Next one is by way of control also he becomes a promoter. One who is having control over the company either directly or indirectly as a member or a director or a creditor or otherwise. If that fellow is having control over affairs of the company, he is called a promoter. On whose advisors, directions, instructions board is accustomed to act. Simply this fellow is known as shadow director. He is not actual director, shadow director. Clear? But from this point one person is excluded. So this can be asked in the examination. Board of directors are continuously listening to the company auditor with respect to preparation of financial statements, with respect to conduct of AGM, with respect to filings with ROC. CA is giving advices. CA is not working. CA, company auditor is not doing those works because all those are prohibited services under section 144. Now the point is CA is advising and company is following accordingly. Now can we call company auditor as promoter? No. Professional, as long as rendering services in professional capacity, he is not a promoter. So this can be tested for 3 marks. Only exclusion part of promoter can be tested for 3 marks. Suppose if professional is rendering services beyond his capacity, then that professional is treated as promoter of the company. Can I proceed? Next one. Come on, tell me. To form a company, first of all, how many types of companies are available? 3. OPC, private, public. In fact, 2. OPC is a part of private company, but okay, no problem. 3 companies. OPC, private, public. Yes, minimum number of members. In OPC, minimum and maximum number of persons is 1. Private minimum 2, max 200. Public minimum 7, max unlimited. Okay, now with respect to directors, OPC should have minimum 1 director, private company should have minimum 2 directors, public company should have minimum 3 directors. But in all companies, maximum number of directors is 15. Okay, fine. Sir, you are telling that minimum number of members, yes, minimum number of members required. When, sir? At the time of incorporation or subsequent to incorporation or at both the situations, sir? Both the situations. Minimum number of members, an association should satisfy both at the time of incorporation, subsequent to incorporation. Suppose after incorporation, if number of members falls to below 2 in case of private, below 7 in case of public, then law is giving a time limit of 6 months to increase that reduced number to statutory limit. Or else debts, obligations, contracts entered into by the company after 6 months. During 6 months or after 6 months? After 6 months from the date of reduction of number. To those debts, company is not liable because corporate will already lifted. That association members who are having knowledge of the fact that company is doing business with reduced number of members are liable jointly and severally. Are you getting my point? You can see here below 7 for public, below 2 private company. Company carrying business operations for more than 6 months. Then every person who is a member during the time, it so carries business after 6 months and is cognizant of the fact. 2 conditions to be satisfied. After 6 months, and member who is having knowledge of the fact that company is carrying business operations with a reduced number. So such members shall be sued severally for the entire debt incurred during that time. Suppose as on date of reduction, total liabilities of company is 30 lakhs. Imagine. Let's take public company for example. Total 7 members to be there. 2 members died. So total 5 members are there. Imagine 5 members are having knowledge about the reduction. 5 members are having a knowledge of reduction. As on date of reduction of number of members, 30 lakhs is the debt. After 6 months, total debts of the company is 50 lakhs. And after that means after 6 months, at one point of time, total debts of the company is 90 lakhs. Now up to 50 lakhs, company is personally liable. And the debts incurred subsequent to 6 months, that means if you observe carefully, 40 lakhs. I assume that no loans were repaid during this period. Loans got increased from 30 to 50, 50 to 90. Now that increased figure 40 lakhs, for that 40 lakhs, when they incurred 40 lakhs, during 6 months or after 6 months? After 6 months. For those 40 lakhs, company is not liable. 5 members are personally liable jointly and severally. Suppose out of 5 members, 2 members became insolvent. Now 3 members should contribute 40 lakhs. Suppose out of 3 members, 2 members ran away. We are not able to trace those 2 persons. Now we are able to find only 1 person. Now that 1 person is liable for entire 40 lakhs. Everyone. Next one. Procedure for incorporation of company. Yes, here you have to remember documents. For this, I will show you handwritten notes. Procedure for incorporation of company. What are the documents to be submitted by the promoters of company to the ROC? If you observe, MOA, AOA, signed by subscribers. Declaration of compliance by professional as well as a director or manager or secretary included, involved in the incorporation. So this declaration is all about the proposed company incorporation is as per provisions of Companies Act and rules made thereunder. Next one, a declaration by the subscribers, all the subscribers and all the directors, stating that last 5 years we have not convicted any offense, we have not been found any guilty of fraud, and all the documents for incorporation of company, whatever documents we filed with ROC for incorporation, they are complete and correct. And next one, details of the directors, subscribers, written consent of directors, interest of directors in other business entities, address for temporary correspondence. Upon filing all these documents, with whom? With the ROC, who is having jurisdiction to issue certificate of incorporation to us. Suppose we want to incorporate company in Chennai, then we need to file all these documents with ROC Chennai. ROC having jurisdiction. Finally, he issues certificate of incorporation, and all these documents shall be preserved at registered office till liquidation. See, this handwritten notes is for revision, but in examination you can't write like this. So what to write in examination? For that, you are having a detailed material, summary material. If you write these points, sufficient. And you can also find extra points. Suppose if body corporate subscribes to MOA, then what details shall be added? And details of first director means what? Name, DIN, proof of identity, consent to act as a director. That means written consent to act as a director. Next one, finally ROC issues a certificate of incorporation. All the documents shall be preserved at registered office till liquidation of the company. Getting my point, students? Everyone? Post incorporation, company is bound to file one more declaration. This is the post incorporation point. This is also a document to be filed with ROC, but this is post incorporation document. What the document is telling? All subscribers have paid the value of shares agreed upon. Verification of register office has been filed, and this shall be done before commencement of business. So this shall be done before commencement of business, but post incorporation. Is it clear? Section 7, incorporation part completed. Signing of MOA, AOA, just give one time reading, not important, just give one time reading. How signing will be done? Suppose if a member is a illiterate subscriber, how signing will be done? So he will affix a thumb impression, but one literate person who have read the content and who have explained the content to the illiterate subscriber, he should also sign along with illiterate subscriber. Illiterate subscriber affix thumb mark, and this fellow will sign it. Next one, if foreign national is becoming subscriber, what are the documents to be attached? Next one, if a body corporate is becoming a subscriber, what are the documents to be attached? Yes, board resolution copy. Body corporate can't sign the documents. On representing body corporate, one person will sign it. That person should get a board resolution copy in favor of him. Next one, LLP of subscriber. Here, authorization by all the partners. Authorization person cannot act as a subscriber to the MOA, AOA simultaneously. That means here, authorized person can represent body corporate, can represent LLP. Both not possible. That means authorized representative as a member and representing company, both at a time without any breakup is not at all possible. Clear? Next one. Next important point. Consequences of furnishing false information, suppression of material fact. This concept was tested 2 times in the past. Recent attempts not came, so chance is there, because if you look at the question papers, he is always concentrating on the exceptions part or punishments part, more or less analytical part. Okay, now you need to identify when such wrong information has been furnished. If such wrong information has been furnished before, for incorporation, then applicant gets punishment under section 447. Suppose certificate of incorporation already been issued, sir. Then punishment applies to 2 parties. One is applicant, other one is company. Applicant will get punishment under section 447, no problem. Applicant means the persons who signed the declaration of compliance, declaration that complete and correct information has been filed for getting certificate of incorporation. All these people will get punishment under section 447. But for company, the punishment, the powers of NCLT, powers available to NCLT with respect to punishing a company if it is incorporated by furnishing false information. And the powers are: alter MOA, AOA, convert members limited liability to unlimited liability, removal of name from the register, simply strike off, order for winding up of the company, or pass any other orders as necessary. But before passing any order, NCLT will verify, will do 2 things. NCLT is having 2 duties. One is reasonable opportunity to the applicant, and it will also consider all the transactions entered by the company post incorporation till the date of NCLT order. Clear? Everyone, applicant gets 447 punishment, company will get any of these following orders. And the next concept is one person company. In this concept, 3 points are very very important. First one, restrictions imposed on one person company. Next one, restrictions imposed on member and nominee. And last one, benefits available to one person company. So these 3 points are very very important. First one, restrictions imposed on one person company. You know, one person company is prohibited from carrying 3 activities. How many activities? 3 activities. So what are those activities? Investment in body corporate, NBFC activities, Section 8 activities. So one person company is prohibited from carrying investment in body corporates, NBFC activities, Section 8 activities. So tomorrow in examination they may ask you a question like this. One person wants to incorporate OPC with an intention to start charitable activities. Can he incorporate OPC for carrying charitable activities? The answer is no. Getting it? And the next point is, who can become member of OPC? Who can become nominee of OPC? Simply restrictions on member and nominee. Let's see, just look at the material. Only a natural person who is an Indian citizen, whether resident in India or otherwise, can incorporate an OPC, can be a nominee for the sole member in another OPC. So if you look at the conditions, how many conditions a person should satisfy to become a member, to become a nominee? 2 conditions. What are those 2 conditions? Natural person and Indian citizen. Whether resident in India or otherwise means what? You know, even a non-resident can become a member of OPC. Even a non-resident can become a nominee of OPC. So technically 2 conditions to be satisfied. One is natural person, other one is Indian citizen. So in examination you may get a question like this. You know, Infosys Limited want to incorporate one person company. Is it possible? Not possible. Why? Infosys Limited is not a natural person. It is a company. It is an artificial person. It cannot incorporate OPC. Next one, for example, you know, Glenn Maxwell, Sir Glenn Maxwell, Australian citizen, wants to incorporate OPC in India. Is it possible or not possible? Answer is not possible because he is not Indian citizen. Getting it? So like this you need to answer this kind of practical questions. Next one, if you want to check whether he is resident in India or not, you have to check his period of stay in the preceding financial year. If his period of stay in the preceding financial year is at least 120 days, then he is said to be resident in India. See, now this condition is no more relevant because even a non-resident can become member of OPC, can become nominee of OPC. Getting my point, students? And you know, concept of nominee. Before naming someone as a nominee, it is very compulsory that you have to obtain written consent from nominee, and that nominee position becomes vacant because of 3 reasons. So what are those 3 reasons? One is withdrawing the consent. Second one is removal of nominee, no change of nominee by the member of OPC. And third one is nominee becoming member. You know, in case of member, in case of death of the member or in case of incapacity of the member of OPC, you know, nominee takes the position of member. So in all these 3 cases, nominee position becomes vacant. Now within 15 days, a new person shall be appointed as a nominee by taking a written consent. Yes, sole member has to name a new person as a nominee, and within 30 days, OPC has to communicate same with ROC. Getting my point, students? Next one, benefits of OPC. Benefits of OPC. For OPC, cash flow statement is not required. Annual returns can be signed by a single director. You know, signing by CS, company secretary, is also not required. One board meeting is required for half year, and you know, this condition is applicable only if OPC is having 2 directors, 2 or more directors. Suppose if OPC is having only 1 director, then you know, board meeting is not at all required. Yes, you heard it correct. You know, maximum number of directors in all companies, whether it is OPC or private or public company, you know, maximum number of directors is 15. Minimum, if you ask me, minimum in OPC minimum 1 director, private limited minimum 2 directors, public limited minimum 3 directors. Suppose in OPC only 1 director is there, board meeting not required. And OPCs can file financial statements with ROC within 180 days from the end of the financial year. You know, for all other companies it is 30 days from the conclusion of AGM, but coming to the OPC, 180 days from the end of the closure of the financial year. Next one, change in nominee shall not be deemed to be an alteration of MOA. So as you all know, alteration of MOA, we need to comply section 13. And you will find nomination clause in MOA. And if there is any change in nominee, actually MOA should be altered, but here alteration of MOA provisions will not apply. Just look at the point one more time. Change in nominee shall not be deemed to be an alteration of MOA. So alteration of MOA section 13 will not apply even if you change nominee. That is also one advantage, because for alteration of MOA, you all know, so meeting is required, resolution is to be passed, filing with ROC is required, getting it. But for OPC, all these provisions not applicable with respect to change of nominee. Change of object clause, change of capital clause again requires section 13 compliance, but change of nominee, section 13 compliance is not at all required. Clear, everyone? Next, section 8 company. Section 8 companies, important point, eligibility criteria. What kind of associations can get license from central government to become section 8 company? So that association should satisfy how many conditions? 3. One is objects SARC. Second one is prohibition on declaration and payment of dividends. Third one is invest surplus in promoting other objects of the company. Tell me, association should satisfy majority of conditions or all the conditions? All the conditions. They may ask you a question like this. 8 persons came together, incorporated one with a view to incorporate a company to carry charitable activities for 10 years. After 10 years, they want to close the company. Whatever surplus arising out of liquidation, that amount they want to distribute among themselves. Possible or not possible? Not possible. Not at all possible. Procedure for incorporation of section 8 company, just give one time reading. What are the documents to be submitted, to whom we need to submit documents, just give one time reading. Generally procedural oriented questions will not come, practical questions only will come, generally majority of the cases. If procedure oriented question is coming, that means it's a shocking factor only. Now here revocation of license. When license be revoked, it is important to know when license gets revoked. Tell me, in 3 ways license can be revoked. What are those 3 ways? Violation of section 8 conditions. Just now I told you 3 conditions. Suppose if any section 8 company is distributing surplus among its members, it's a violation, leads to revocation of license. Second one is violation of CG conditions. At the time of granting license, CG may levy additional conditions. Any additional condition getting violated leads to revocation of license. And last one is carrying objects in such a way creates negative impact on the public, prejudicial effect on the public. Then also section 8 company license may be revoked. And one of the important advantage in section 8 company you need to remember is notice calling for meeting 14 days sufficient. Even a partnership firm can become member in section 8 company. Another biggest privilege available to section 8 companies, no need to constitute committees, nomination, remuneration committee, minimum and maximum number of directors, all these are not applicable. Clear? Revocation of license, these 3 points you have to remember. And before revocation of license, authority, central government gives one opportunity of being heard. Once license gets revoked, central government may either order for winding up of the company, that means liquidation of the company, or it may order for amalgamation of the section 8 company. But remember, amalgamation will not happen with all section 8 companies. Amalgamation happen with a section 8 company with similar objectives. Our company is a sports club. Now our company can be amalgamated with another sports club section 8 company, but not education clubs, or but not education foundation, but not other charitable activities. Only sports club. With sports club we can be amalgamated. Next one, in case of liquidation, if any surplus is arising out of liquidation, that surplus money can be transferred to either IBF, insolvency bankruptcy fund, or that amount can be transferred to similar section 8 company. Getting my point? Finally, punishment. What is the punishment? For company 10 lakhs to 1 crore, for directors 25,000 to 25 lakhs. In case affairs are conducted fraudulently, then punishment is 447. Next one, name clause in MOA. It can also be asked, particularly rectification of name point of view, this concept can be asked. Section 16. I'll discuss section 16 later. But just give one time reading all these points. Just basic reading is required. Next one, in this name concept, this is the important point. This is important point. If you want to incorporate a company, the first step is reserving unique name. That means our name should not be identical with or resemble to the name of another body corporate or another company. So for that we need to check whether our proposed name is available or not. If available, it will be reserved for a period of 20 days normal time limit for new companies, proposed companies, 60 days for existing companies. But if you reserve that name by furnishing false information, if company not yet incorporated, then punishment is up to 1 lakh on the applicant. For reserving the name, if you furnish false information, if you furnish false declarations, then the name so reserved is cancelled and applicant is fined up to 1 lakh. Sir, false information, one example, sir. Suppose if my name is similar to existing trademark, I should produce NOC, no objection certificate, which was signed by owner of the registered trademark. Imagine that was forged. I didn't consult owner of registered trademark to give NOC, but I signed it. That means, is it containing false information or correct information? Of false information. If ROC comes to know before incorporation, he cancels the name and he will levy fine up to 1 lakh rupee on the applicant. Suppose company already incorporated, sir, then ROC will pass an order. It will order the company to change its name within 3 months. Operations not yet started, sir. It will remove the name from the register. Operations started and company is not listening to me. Then it can file a petition with whom? With NCLT. Petition is with NCLT. NCLT is having an order for, NCLT is having a power to pass an order for winding up of the company. So petition with NCLT for winding up. Clear, everyone? Everyone. Next one, situation clause. Situation clause. Importance of situation clause is CJI. Remember these 3 letters. CJI: communication, jurisdiction, inspection or investigation. All letters, notices are addressed to registered office address. All disputes are subject to the jurisdiction where company's registered office is situated. All inspection, investigation activities are carried at registered office. Okay na, everyone? Come on, tell me. In MOA, an application has been filed for incorporation of company. ROC rejected the application stating that MOA situation clause is not having complete address of the company. Do you agree with ROC or not? Yes or no? No. I will not agree with ROC. Why? Situation clause contains only the name of state. It will not contain complete address. Are you getting my point? So a 2 marks question can be tested in this way. Next one, within how many days company shall maintain registered office? Within how many days of incorporation company shall maintain registered office? 30 days, and subsequently for all the days. Object clause. Importance of object clause is doctrine of ultra vires, constructive notice, indoor management. Ultra vires means what? Ultra vires means beyond the powers. If it is beyond the powers of Companies Act, it is illegal. It is illegal. Companies Act is not allowing you to do activities. Suppose I'm OPC company, myself OPC company, I'm not allowed to invest in body corporate. But if I'm making investment in body corporate, this is ultra vires not to MOA, ultra vires as to Companies Act, and this is illegal as per Companies Act. Ultra vires as to MOA, it is void ab initio. It is void ab initio. Can ultra vires acts be ratified with the resolution of all the members? No. Profit loss arising out of ultra vires acts, company is not responsible. Who is responsible? Board of directors are personally responsible. Clear, everyone? So on ultra vires acts, they can narrate a story which is similar to Ashbury Railway Company versus Ritchie. So you have to write the provision. Ultra vires as to MOA is void ab initio. It can't be ratified even with the consent of all the members. Board of directors are personally liable for all the effects that arises due to ultra vires acts as to the MOA. Analysis conclusion, you just write according to the question. Next one, articles of association. Important concept is entrenchment. How can we insert entrenchment provisions in the AOA of a company. In how many ways I can insert? Two ways. One is at the time of incorporation, that means on formation of the company. The second one is by making amendment to the AOA. By making amendment to the AOA. First of all, sir, what is this? What is the effect of entrenchment, sir? See, generally, any clause in AOA can be altered by passing special resolution. Suppose underwriting commission, you mentioned 1%. After looking at this point, no underwriter is coming to you. Now you want to increase 1% to 2%. Possible? Yes. But for this, what kind of resolution required? Special resolution. Sir, for increasing this rate, I don't want SR, sir. I want 100% consent of the members, sir. That means if you want something which is more difficult than SR, we call it as entrenchment. Altering clauses of AOA much difficult compared to SR. It is nothing but entrenchment. To insert entrenchment, you are having one option is at the time of formation of company. Other option is amendment to AOA. Sir, how can I alter AOA, sir? With how much consent I can alter AOA? If you are a public company, to insert entrenchment provisions, SR is sufficient. But for private company, consent of all members is required. Agreed to by all members in case of a private company. Getting my point, students? Everyone? Now, whenever you insert entrenchment provisions, either at the time of formation or at the time of subsequent to incorporation, it is a duty of company to communicate same with ROC. Within how many days? Within 30 days after entrenchment for existing companies. Because ROC should know whether entrenchment provisions, whether any company containing entrenchment provisions or not. So tomorrow, if association alters that particular clause of AOA, ROC ensures whether entrenchment provisions have been complied or not. Getting my point? Suppose my name is there, my name is included in AOA as a managing director. I'm the managing director of the company. Like that, my name is included in AOA. And to remove this clause from AOA, generally for alteration of AOA, SR is required. I'm not talking about removal of director. I'm talking about removal of clause from AOA. SR is required. But at the time of formation, I told her 95% consent is required to remove this clause from AOA. So tomorrow, any amendment to this clause is happening, ROC ensures that whether 95% consent has been obtained or not. Or else what ROC think? SR is sufficient to remove the clause. Are you all getting my point? Everyone, this point is different point. Why we need to communicate with ROC? So tomorrow, if company is filing any application with respect to amendment to this particular clause, ROC ensures whether requisite majority has been passed or not, whether requisite majority have been consented it or not. Clear, everyone? So entrenchment provisions also completed. Entrenchment provisions also completed. Next one. Can company have its own articles? Yes. Can company have model articles as its articles? Yes. Can company have mixture of model articles and own articles? Yes. Next one. Doctrine of constructive notice. Only here assumption is important. Assumption. What is that assumption? Everyone dealing with company is assumed to have read MOA and AOA. It's not only reading MOA, AOA, it's also understanding MOA and AOA. Getting my point, everyone? Next, doctrine of indoor management. Important point is conditions, exceptions to the indoor management. We had 5 exceptions to the indoor management. A practical question may be asked on these 5 points, or they may ask you write the exceptions to indoor management, or write the situations where constructive notice is applicable. So what are those 5 situations? Knowledge of irregularity, negligence, easily discover irregularities, but he failed to discover irregularities means he is negligent. Forgery, doubt regarding existence of agency, and last one, no knowledge of MOA, AOA. No knowledge of MOA, AOA. Clear? So this can be asked like a descriptive question. Everyone? Next. So doctrine of constructive notice protects company from outsiders, whereas doctrine of indoor management protects outsiders from company. As per doctrine of indoor management, outsider is not required to verify internal proceedings. He can assume that all internal proceedings policies have been as per AOA, MOA Act. That's it. Next. So far this concept not yet tested. Can be tested. The point is, which is supreme and which is not supreme. Between Act, MOA, AOA, member resolution, board resolution, agreements executed by the company. So which one is superior, sir? Act is superior. Act have overriding effect. If there is any inconsistency between these two things, Act and 5 documents, Act prevails. Everyone? Now tell me, do you think complete document becomes void? No, only inconsistent clause becomes void. Only inconsistent. Suppose if you take MOA of OPC, it is having some 16 objects. Out of 16 objects, 15 are allowed by Act, only one, investment in body corporate, is not allowed. Now that particular clause in OPC MOA becomes void, remaining 15 clauses, remain 15 objects, yes, company can carry business operations. Okay, now everyone. Next one. Effect of MOA, AOA. Just go through these practical situations. Company is liable to members. Members are liable to company. But members are not liable to each other directly. Members liable among themselves only with these documents, MOA, AOA. So for that you can refer this case scenario. As per this case scenario, if any member of a company is selling, if any member of a private limited company wants to sell a shares, he can sell only shares to existing members. Now because of MOA, AOA, the existing member, suppose if a director is an existing member, he gets an obligation to purchase shares from the selling shareholder. That is as per which section? Section 10, effect of MOA, AOA. Can be asked only for 2 marks. So yes, these questions, the examples, the practical scenarios have been mentioned in this material. So from these points you can expect a practical question. Next one, alteration of name clause. For alteration of name clause, what are the defaults company should not possess at the time of alteration of name clause? What are the defaults a company should not possess at the time of alteration of name clause? So what are those defaults? 6 defaults. Remember how many? 6. What are those 6? Financial statements filing with ROC, annual returns filing with ROC, deposits repayment, interest on deposits, debentures redemption, interest on debentures. These 6 defaults, out of 6 any one default is there, then company is prohibited from changing its name. Once name has been changed, it has to disclose old name along with new name for the next 24 months, next 2 years. That means last 2 years, any time when name has been changed, you have to disclose old name along with the new name. Now what is the conditions for alteration of name clause? Very simple. You can see name clause in MOA. MOA is a contractual document between company and members. So for alteration of terms and conditions of a contract, mutual consent of parties is required. Yes or no? So here company will request, that means on behalf of company, board of directors call for a general meeting. In general meeting, members have to pass what type of resolution? Special resolution. This is not rectification of name. Rectification of name, OR is sufficient. This is voluntary change of name. Okay, defaulters cannot change their name. This is the important point you need to remember. If they want to test this concept, they will definitely test a concept based on this defaults only. And they will also ask you, how can company change its name? Now you have to tell that upon rectification of these defaults, immediately company can change its name. Clear? Rectification of name. Rectification of name arises in 2 cases. How many cases? 2 cases. One is, if my name is identical to or too similar to an existing company name, or when an application is filed by registered trademark owner, that company name resembles to his registered trademark. Let me repeat. When rectification of name comes into the picture, two cases rectification of name comes into the picture. One is name is similar to the name of existing body corporate, name is similar to the name of existing registered trademark, but application by the registered trademark shall be filed within how many years? Two times question came on this note point. One time owner of registered trademark filed application after 5 years of incorporation of company. Now is there any obligation on company to change its name? No. See, we are in revision lecture. In revision we will just revise the facts, revise the content. I will not explain the concept, okay, to the viewers. This point is to the viewers, so don't expect complete conceptual clarity in this revision lecture. I hope one who have completed complete revision of this corporate and other laws, for them only this revision lecture will give maximum benefits. Clear? Fine, come back. No, it's a disclaimer actually. Next one, registered trademark shall file application within how many years? 3 years. And once CG passes an order for rectification of name, it is the duty of company to comply with CG order within how many months? 3 months. How we comply with the CG order? By passing ordinary resolution. By passing ordinary resolution, and shall be filed with ROC within how many days? 15 days. So if you observe carefully, 3 years is for 3 years is a duty of registered trademark owner. 3 months is on company for rectification of name. 15 days is for filing documents with ROC for rectification of name. Everything should be done within 3 months. Now what ROC do? ROC registers the same and issues a new certificate of incorporation, fresh certificate of incorporation. But remember, this doesn't prevent company to change its name voluntarily under section 13. If they want, they can also change name under section 13 voluntarily. But the difference between 13 and 16, under 13 special resolution is required for alteration of a name, whereas under section 16 OR is sufficient. Can I proceed? But in these both cases, if company wants to know whether proposed name is available or not, that name can be reserved for not 20 days, it can be reserved for 60 days. Next one, registered office of the company. I told you what is the time limit to have a registered office? 30 days of incorporation. For IFSC companies, 60 days. Okay na. Next one, whenever company shifts its registered office from one premises to another premises, that means whenever there is a change in registered office address, it is the duty of company to communicate same with ROC. Within how many days? Within 30 days of shifting. But if that shifting is from one city to another city, special resolution is required. Within the city, board resolution is sufficient. One city to another city, special resolution is required. One ROC to another ROC, special resolution plus RD approval is required. One state to another state, special resolution. CG approval delegated to RD, creditors approval also required. Clear? For that, you can see the time limits here. Just look at the time limit. For time limits, you can see here. Yes. So yes, case 1, shifting within same city. What is the procedure for shifting of registered office from one place to another place within the city? Board resolution, ROC filing, INC 22. Within how many days? 30 days of shifting. From one city to another city, board approval, special resolution, ROC filing. From one ROC to another ROC within the same state, that is applicable only to the Tamil Nadu as well as Maharashtra. There, board resolution is required, special resolution, application with a regional director. Now, regional director shall pass an order within 30 days of receipt of complete documents along with application. Once regional director order has been passed, it is the duty of company to file RD order with ROC within 60 days of regional director order. And within 30 days of filing with ROC, ROC issues a certificate. And once you shifted to new premises, within 30 days file INC 22 with a new ROC. In case 4, board resolution, that means one state to another state. If you observe carefully, last case, change in state requires alteration of alteration of MOA, because situation clause, the name of state is getting changed. So here board resolution, special resolution, creditors approval. Once you get it, file an application with a CG but power delegated to RD. Along with application file, altered MOA copy, general meeting minutes, board resolution copy, special resolution copy, plus list of creditors, plus acknowledgement of service of documents, application to the ROC and CS. And advertisement shall be done, which should not be older than 30 days. Which should not be older than 30 days. So if no objection has been received, RD shall pass an order within 60 days of application. Same RD order, file it with ROC within 30 days of receipt, within 30 days of RD order. And ROC issues a certificate within 30 days of filing of RD order. Date-wise order, date-wise chronological order. First RD will issue an order. Next, file it with ROC within 30 days of order. Next, ROC issue certificate within 30 days of filing. After going to new premises within 30 days, file INC 22 with ROC. Clear? Everyone? Change of objects. Punishment, just remember the punishment. Already prepared a separate list, containing a list of penalties, list of time limits. So at the end, I will show that document. Next one. Alteration of object clause. This point we will see in prospectus. In prospectus also alteration of object clause we will see. Next one, alteration of AOA for conversion of companies. Alteration of AOA for conversion of companies. This procedure to be followed. So public to private requires CG approval, whereas private to public doesn't require CG approval. Okay, now so alteration of AOA, important conditions. First, you have to pass special resolution. Next, filing with ROC. ROC filing should be done within 15 days of alteration of AOA. And in alteration of MOA 13, alteration of AOA 14, one important point. After alteration, every copy of altered MOA, every copy of altered AOA shall be noted about the alterations, or else without such amendment, if you release MOA AOA, for each copy, what is the punishment? 1000 rupees to both company and its officers. Next one, distribution of MOA and AOA to the members. Distribution of MOA and AOA to the members. Here, if a person satisfied two conditions, then company will get a duty. How many conditions? Two. What are those two conditions? Requester plus payment of fees. Requester plus payment of fees. These two conditions members should satisfy. Then what is the duty of company? Company should send these documents within 7 days of written request. Only request there, sir, no payment of fees, then no duty to the company. No duty to the company. On satisfaction of two conditions, company get a duty to submit these documents, copies of these documents to the requested person, or else punishment 1000 for each day during such default continues up to 1 lakh rupee. Okay, now next, commencement of business. Commencement of business. One small addition to be done to here, a small addition. The addition is applicable to companies with share capital. Companies with share capital incorporated on or after 2nd November 2018. On or after 2nd November 2018. Right now these two conditions are not that much important because already 5 years completed from amendment. From amendment to condition, 5 years completed. But the point is, before commencement of business, two conditions to be satisfied. One is file INC 20A with ROC, that is subscribers have paid, subscribers have deposited the money that they promised at the time of incorporation. Of course, this condition will come in which company? Company with the share capital, without share capital? Without share capital, no need to contribute during the lifetime of the company. Contribution is required only at the time of liquidation if assets are not in a position to meet liabilities. So by default, these conditions are applicable to company with share capital. And next one, it should also comply with verification of registered office. That means file verification of registered office with ROC under section 12. Clear? punishment for default, 50,000 penalty for non-compliance, 1,000 rupees, 1,000 rupees per day for officers up to 1 lakh rupee. Okay, now if no declaration is being filed, sir, what is the difference between these two? Delay in filings, this punishment. Non-filing, forgot to file these documents, ROC verifies whether company is carrying business operations or not, and if ROC believes that company is not operating, then they may initiate removal of name from the register. Strike off, simply strike off. And who signs this document? Practicing professional plus director. Director shall file a declaration, and who will also sign this declaration? Practicing professional. And for special entities like banking companies, insurance companies, for them approval from sectorial regulators also required. Approval from sectorial regulators also required. Next one, conversion of companies already incorporated. Yes, amend MOA, AOA, file it with ROC. ROC registers that application and ROC issues a fresh certificate of incorporation. And this point is very important. They can ask you a practical question on this point. Upon conversion, is there any change on the company obligations, company debts, company liabilities? No. There will be no effect on company existing debts, existing liabilities, just because of change in constitution. 2 marks question can be tested. Subsidiary company is prohibited to hold shares in its holding company. True or false? True. But it had 3 exceptions. In 3 exceptions, it can hold shares of holding company. What are those 3 cases? Legal guardian, legal representative, trustee, before becoming subsidiary. Out of 3, first 2 cases voting allowed. As a trustee, as a legal representative, voting by subsidiary in holding company AGM is allowed. But as a before becoming subsidiary, that means what? Today I am not subsidiary, I acquired 10% shares in your company. Next day you acquired 70% shares in my company, now I became subsidiary. So whatever holdings I am having, those holdings I had before becoming subsidiary, can I continue to hold such shares? Yes. Is company entitled to exercise voting power in the AGM of a holding company? Answer is no. Voting rights is strictly prohibited in case C. So they may ask you combination of BC or combination of AC, and they will ask you in what cases voting right is allowed. As a legal representative, suppose as a legal representative it is holding 4%, and for itself, that means before becoming subsidiary, it is holding a 7% shares. Now to what extent it can exercise voting rights? To the extent of 4%. To the extent of 4%. Clear? Everyone, can I proceed? Service of documents to the company, by the company. First point is service of documents to the company, that means members, ROC sending documents to company. Second one is company sending these documents to ROC member. In what way they can serve documents? Post, speed post, courier, leaving at register office, or electronic mode. For DMAT, obviously electronic mode is applicable. Next one, serving document to registrar or member, post, registered post, speed post, courier, delivery at address, electronic mode if prescribed. But if any member want different mode of service of documents, he can make request, and he should also deposit sufficient fees. 2 conditions: request, fees. Immediately this will be updated in the register of members maintained by company under section 88. And for Nidhi companies, service of documents, to the members individually happens if the members are holding more than 1 lakh paid up share capital or 1% of the paid up share capital. For others, no need to serve individually, just publish on the company's notice board, not website, notice board. And same shall be communicated with members through advertisement in local newspapers. Clear? Everyone? Authentication of documents 21. Who authenticates documents on behalf of company? KMP or officer employee authorized by the board. Sir, how authorization is done, sir? How authorization is done? Authorization may be done under common seal of the company. Under common seal of the company. Or it can be signed by 2 directors. If company is having CS, 1 director and 1 CS. And same power, same structure is also required for execution of bills, execution of promissory notes. Suppose
I'm a KMP, I can execute it. I can execute instruments on behalf of company, but I'm an employee. So can I execute negotiable instruments on behalf of company? Yes, if authorized. How authorization will be done in my favor? That letter of authority should be under common seal, if common seal is there, or else ignore common seal. That letter of authority should be signed by 2 directors or 1 director and 1 company secretary. Clear, everyone? With this, incorporation of company chapter completed. Let's continue with the third chapter, that is prospectus, which is having a weightage of minimum 6 marks. So if you look at the recent examination papers, recent MTPs, these are the concepts which are repeatedly asked, which were repeatedly tested. Let's see, first one, 27, section 27, variation of objects in the prospectus. 31, shelf prospectus. 32, red herring prospectus. 34, 35, punishment, criminal liability. 34, civil liability. 35, they will not ask you what is liability. They will ask you when persons are not liable under section 34, 35. That means exemption part we need to remember. Next one, conditions for allotment of securities, or else when refund, and what is the deadline for refund of application money. Next one, conditions for payment of underwriting commission, particularly sources for underwriting commission and rates of underwriting commission, important. And last one, private placement, in that limits part, 200, 60 days, 15 days, punishment part. Limit up to 200, right? Allotment should be done within 60 days, right? So those limits are very important in private placement. And these two concepts are also equally important. One is deemed prospectus when not required. See, when deemed prospectus required, happening of any of the two conditions. Two conditions means, one is issue house making offer within 6 months of allotment or agreement to allot, or at the time of making public offer, they have not paid complete consideration, they have not discharged complete consideration. But we need to remember contrary, that means opposite part, when deemed prospectus not required. And the abridged prospectus. Let's see, prospectus and allotment of securities. It is total of 20 sections, section 23 to section 32. So 23, summary of section 23 you can see here. 23 subsection 1, public company can issue securities to the public at a large through a document called prospectus, to the identified persons through a document called private placement offer cum application letter, to the existing members under section 62 subsection 1. Private company can offer its securities to the identified persons under section 42 through private placement offer cum application letter, and to its existing members, that is through rights issue under section 62 subsection 1. And prescribed class of public companies are permitted by central government to list their securities on foreign stock exchanges. And finally, central government is having power to exempt certain public companies from complying with chapter 3, chapter 4, section 89, section 90, section 127. And you can see all these points in the material clearly. Okay, now, so section 23. Next, section 24. Section 24. 24 is all about powers of CG and SEBI. So particularly powers of SEBI. Two companies. How many companies? Two companies. In those two companies, two activities are regulated by SEBI. What are those two companies? Listed companies and companies in the process of listing. In these two companies, the two activities are issue and transfer of securities, non-payment of declared dividend. These two activities in these two companies are governed by or administered by SEBI. And all other activities in these two companies are managed by central government. For example, shifting of registered office from one state to another state, SEBI approval is not required. CG approval is sufficient. That is all about section 24. That is all about section 24. So briefly, listed company in the process of listing, issue of securities, transfer of securities, non-payment of dividend regulated by SEBI. All other matters and all matters in other companies are administered by CG through Companies Act and rules made thereunder. Next one, sir, when prospectus is required, sir? Whenever company is making public offer, prospectus is required. And what is a public offer, sir? No definition to the public offer, just public offer covers 3 items. Here we are not defining the word public offer. Here we are providing list of items covered by public offer. Public offer is equal to IPO, FPO, OFS. After incorporation, for the first time company is making public offer IPO. Any public offer subsequent to IPO, we call it as FPO, further public offer or follow on public offer. If company is offering its members shares, if company is offering its members shares, then it is called offer for sale. It's not fresh issue. Here company will take shares from existing members, those who are willing to exit from the company. Yes, existing members, they authorize company to sell their holdings to public. Now whatever offer company is making to public, we call it as public offer, particularly offer for sale. Now prospectus is required not only for IPO but also to FPO as well as OFS. And our chapter is not prospectus and allotment of shares. Our chapter is prospectus and allotment of securities. Securities is a broader term compared to shares. Securities includes all these items. Government securities, shares, stock, bond, debentures, derivatives, collective investment scheme units, security receipts under surface, mutual fund units. Next one, special purpose entities issued instruments or certificates, other instruments described by CG, including rights in the rights issue, renouncement right in the rights issue. But here very important point in securities definition is securities exclude one particular item. That one particular item is unit linked insurance policy. In unit linked insurance policy, you will find two components. One is investment component, other one is risk component, risk mitigation component. So all units linked insurance policies are not treated as securities. This is important point, can be asked 2 marks MCQ. Clear everyone? Next one, important concept, definition of listed company. Here they will ask you, they will illustrate few situations. Suppose company C Limited is there. Its equity shares are listed on stock exchanges. Is it a listed company? Yes. That is by way of definition you can tell. Listed company means any of its securities listed on any recognized stock exchange, it's a listed company. But they will not ask you questions in that manner. They will ask you questions which covers exceptions. Let's see. Public company. First condition, equity shares not listed. Debentures, preference shares. I'm talking about debentures, preference shares. Debentures, I'm talking about only NCD. And these debentures were issued under private placement. If these two conditions are satisfied, then even though they are listed on recognized stock exchange, then it is treated as unlisted company. It is not a listed company. Getting my point? It is not a listed company. What are those two conditions? NCD, private placement. And similarly for preference shares, non-convertible redeemable preference shares issued under private placement. If these shares are listed on the stock exchanges, then also it is not a listed company. Suppose if it is convertible debt or if it is offered through prospectus, then it is a listed company. Getting my point? Two securities. What are those two securities? Non-convertible debt, non-convertible redeemable preference shares. If offered through private placement and listed on stock exchange, then it is not a listed company. In the place of NCD, if CD is there, it is a listed company. In the place of non-convertible preference shares, if you find convertible preference shares, then also it is a listed company. In the place of private placement, if you see public offer, then also it is a listed company. For private companies, non-convertible debt securities issued on private placement basis, even though listed on recognized stock exchange, then also that private company is not a listed company. Clear? And foreign listings. Public companies, according to section 23 subsection 3, certain public companies are allowed to list their shares on foreign jurisdictions. And if those equity shares are not listed on Indian stock exchange and listed on foreign jurisdictions, observe carefully, not listed on Indian stock exchange but listed on foreign jurisdiction, still it is not a listed company. Okay, no. So they will illustrate a situation and they will ask you whether it is a listed company or not. Then you have to write complete provision, and it would be for 3 marks. Analysis conclusion 1 + 1, total 5 marks. Identification of listed company, very important. One more time, just one more time. Public company, let me write here, public company plus NCD plus private placement plus equity shares unlisted. Equity shares unlisted. Then it is a not a listed company. Then it is not a listed company. Next, public company plus public company plus non-convertible redeemable preference shares plus issued on private placement basis plus equity shares unlisted, then also not a listed company. Clear? Next, for private companies, for private company condition plus non-convertible debt securities issued on private placement basis, then also not a listed company. Everyone, foreign listings, as I told you, public companies that have not listed equity shares on Indian stock exchanges but whose equity shares are listed in foreign jurisdictions as specified under section 23 subsection 3, it is also not a listed company. Can I proceed? Next one, section 24 already over. Prospectus. Prospectus is any document described or issued as a prospectus. Any document contains name of prospectus, it is a prospectus. Prospectus includes red herring, shelf, notice, circular, advertisement or any other document if invites offer from public to subscribe or purchase securities of a body corporate. So any notice, circular, advertisement or any other document that invites offer from public, any document company is issuing, if the objective is inviting offers from public regarding what? Regarding securities subscription or purchase of any body corporate, then also it becomes a prospectus. So a document becomes prospectus if it satisfies three conditions. First one, inviting offers from public regarding subscription or purchase what? Securities of a body corporate. Can I proceed? Next, matters to be stated in the prospectus. So what are the matters to be stated in the prospectus? Very simple. It should contain information and reports on financial information as specified by SEBI in consultation with SEBI. 2 points you have to write here. 3 points you have to write when a question is asked regarding matters to be stated in prospectus. First point is prospectus shall be dated and signed. Second point is it should contain information and reports on financial information as specified by SEBI in consultation with CG. Clear? And third condition is all about declaration. Declaration about compliance with the 3 acts. Since Companies Act, and public involved, right? SEBI, securities are involved, Securities Contract Regulation Act 1956. So what are the 3 points that are to be there in the prospectus? Prospectus shall be dated and signed. It should contain information and reports on financial information as specified by SEBI in consultation with CG. Next, it should also contain declaration signed by all the persons authorizing the issue of prospectus. Regarding what? Regarding compliance with Companies Act, SEBI Act, Securities Contract Regulation Act. Next one, prospectus is not required in 2 cases. What are those 2 cases? If an offer is made to the existing members, if an offer is made to the debenture holders, then prospectus is not required. If an offer is made with respect to shares or debentures which are similar to shares which are previously issued and quoted on recognized stock exchange. That means previously I issued prospectus. Out of 100 applications, out of 100 securities, I got subscription for 96%. Imagine. I made allotment, balance 4% securities I am offering right now. Right now, whenever I am offering, prospectus required or not required or not required. So simple, prospectus is not required in how many cases? 2 cases. If offer is made to existing members or existing debenture holders. If offer is made with respect to securities which are previously issued and dealt on recognized stock exchanges. Because for that I already issued prospectus in past, you can refer it. Now the point is, if any new class I am offering along with existing class of shares, prospectus needed. If I am offering shares to outsiders along with the existing members, then also prospectus is required. Next one, date of publication. Whatever date published on the prospectus, it will be the date of prospectus. Filing with ROC before publication. Before you issue prospectus to the public, it should be filed with ROC. And it should also be signed by all the persons named in the prospectus, whether present directors or proposed directors or CEO, CFO, whose names are mentioned in the prospectus, all those people shall sign the prospectus. Only signed prospectus shall be filed with ROC. And what is the validity of prospectus? 90 days from the date of filing with ROC. After 90 days, prospectus valid or not valid? Not valid. Again need to prepare new prospectus, again need to file with ROC. Now issue to public within 90 days. Sir, can I include expert statement in a prospectus? Yes, but you need to satisfy these conditions. There is no compulsion to include expert statement, but if you want to include expert statement in the prospectus, conditions to be satisfied are he should be independent person, that means not connected to company's promotion management, and he provides written consent to include his statement in the prospectus. Such written consent is not withdrawn before filing with ROC. Finally, declaration by expert is included. Declaration about expert disclosure regarding written consent, submission of written consent, filing it with ROC, everything should be published on prospectus. Who is an expert? Expert includes engineer, valuer, CS, CMA, whoever authorized under the law to make statements, expert statements. Clear? Let me repeat. There is no compulsion to include expert statement, but if you want to include expert statement, he should not be an employee, promoter of the company. He should be an independent person. He should give written consent, and such written consent should not be withdrawn until a copy of prospectus has been filed with ROC. Disclosure about these conditions is required. Next one. Punishment for contravention: for company 50,000 to 3 lakhs, for individual, that means officer who is in default, knowingly issuing prospectus with contravention, for him also same punishment, 50,000 to 3 lakhs. Next one, issue of securities in demat form. Issue of securities in demat form. So to which companies or to whom issue of securities in demat form is applicable? To all listed companies and to all prescribed public unlisted companies. Every company making public offer, compulsory demat form is, demat form is compulsory. They should also comply with Depositories Act 1996. Next one, subsection 1A, prescribed unlisted companies security shall also be held transferred only in demat form. For them also, for them is who? Unlisted companies shall also comply with the Depositories Act 1996. Apart from listed companies and unlisted public companies, all other companies, simply private company, if they want, they can convert material form of securities into demat form of securities. Then also they need to comply with the Depositories Act 1996 provisions. Clear, everyone? So for the time being, section 29 is applicable to how many companies? Mandatory, 2 companies: listed companies, companies in the process of listing. Next, prescribed unlisted public companies. Prescribed unlisted public companies. Next one, advertisement of prospectus. Tell me, advertisement of prospectus compulsory or optional? Optional. There is no provision that mandates advertisement, but if you decide to advertise prospectus, it shall contain following contents. That advertisement shall contain following contents. First one is object clause of MOA, object clause of the company, liability of the members, and the amount of share capital of the company. This is nothing but capital clause. Signatories to the memorandum, subscription clause. Number of shares subscribed by the signatories, subscription clause. Capital structure of the company, that means debt equity components. So that advertisement shall contain following contents. One is contents of MOA. Next one, simply capital structure of the company. Can I proceed? Next one, types of prospectus. In that, first one is shelf prospectus. Generally, what is the validity of the prospectus? 90 days from the date of filing with ROC. But certain, prescribed companies can make more than one public offer using a prospectus called shelf prospectus. Here, the validity period of shelf prospectus is 1 year not from the date of filing with ROC. 1 year is from date of opening of first public offer under shelf prospectus. Let's see, validity period cannot exceed 1 year from the date of first offer. It's not date of filing with ROC. General prospectus validity 90 days from filing with ROC. Shelf prospectus validity is 1 year from the date of first offer under shelf prospectus. So here under shelf prospectus, company can make multiple offers in a year. That means the process can be repetitive. Shelf prospectus allows company to issue securities for subscription over a certain period without issuing a new prospectus each time. And filings with ROC, shelf prospectus shall be filed with ROC at the time of first offer of securities. Validity begins with date of first offer under the shelf prospectus. For subsequent offers during the validity period, no new prospectus is required, just information memorandum is required. And what are the contents of information memorandum? New charges created by the company, changes in the financial position of the company, and any other material facts. Important points are, when should I file information memorandum with ROC? Information memorandum shall be filed with ROC 1 month prior to the issue of second or subsequent offer. Are you getting my point? When should I file prospectus with ROC? Before making public offer. When should I make when should I file shelf prospectus with ROC? Before opening first public offer. But information memorandum, 1 month before making subsequent public offer, you have to file information memorandum with ROC. Now you know, shelf prospectus plus information memorandum deemed to be prospectus. Like this, you know, in this equation only. In this equation only, one time a question came for 4 marks. How to identify whether question belongs to shelf prospectus or not? Very simple. Company is planning to make multiple public offers within 1 year. Advise the company. If you see 1 year, multiple public offers, that is all about shelf prospectus only. Don't get confused with the word deemed prospectus. Here deemed means what? Shelf prospectus including information memorandum deemed to be prospectus under section 26. Getting my point? Everyone? So information memorandum includes, I told you, contents, new charges, changes in financial position, material facts. And you know, company has to give withdrawal option to the applicants who deposited money in advance. Any applicant wishes to withdraw after the changes are made known, the company shall refund all subscription money within 15 days of availing that option. Information memorandum is filed along with shelf prospectus, will be considered as prospectus for each new offer of securities. That is all about shelf prospectus. Shelf prospectus, how many time limits you need to remember? 3. 1 year from the date of first public offer, shelf prospectus validity period. Information memorandum shall be filed 1 month before subsequent public offer. Withdrawal option shall be given to the applicants. If applicants choose withdrawal option, then within 15 days we need to refund those monies. Clear? Next, red herring prospectus. Red herring prospectus, how can we identify red herring prospectus in the question? Particulars of the public offer is not complete. Price unknown. Quantum of securities unknown. Capital to be raised unknown. Out of 3, any 2 factors are unknown, then the concept is all about red herring prospectus. In red herring prospectus, company has to file 2 prospectuses with the ROC. One is red herring prospectus before public offer, final prospectus after public offer. Final prospectus after public offer shall be filed with ROC and SEBI. Clear? And you know what is the time limit for filing red herring prospectus? At least 3 days before opening of subscription list and offer. At least how many days before subscription offer? 3 days before opening of subscription offer. Just observe, prospectus before public offer, before making public offer. Shelf prospectus before opening of first public offer. Red herring prospectus, it's not about public offer, it's about opening of subscription. Opening of subscription 3 days before opening of subscription. Clear? Everyone, once public offer is over, then company has to complete the details, incomplete details in the red herring prospectus. Any differences between red herring prospectus and final prospectus shall be highlighted as variations. And filing final prospectus with ROC and SEBI. So in that final prospectus, yes, we need to provide information regarding total capital raised, closing price, missing details from the red herring prospectus. So that is all about red herring prospectus. Important time limit, 3 days before opening of subscription list. Next, abridged prospectus. This is a prospectus that contains salient features as specified by SEBI through regulations. It's not a complete prospectus. It contains only material information. Generally, prospectus contain complete and correct information, but this prospectus contains material information, and this should not be available individually. This should be accompanied with a application form. And if any person requests for complete prospectus, it is the duty of company to submit complete prospectus to the requested person, or else default punishment. For company, what is the punishment? 50,000. If any application form is issued not accompanied with a abridged prospectus, or on a written request, if abridged prospectus is not submitted to the requested person, then also default happens, then also punishment to the default comes into the picture. Clear, everyone? But abridged prospectus is not required in 3 cases. One is offer made to the existing members. Next one, when an offer is not made to the public, that means private placement. Last one, offer is made with respect to underwriters. Offer is made with respect to underwriters for entering into underwriting agreement. These cases, abridged prospectus is not required. Next one, deemed prospectus. In deemed prospectus, important point is when offer becomes deemed public offer. When offer becomes deemed public offer. Here, how many parties are involved? Generally, in a public offer, you will see company and public. But here you will see 3 parties. One is company, issue house, public. Company, issue house, public. So here, what company will do? Company allots shares in the name of issue house, or enters into an agreement to allot shares in the name of issue house. Issue house will transfer all the shares to the public. So company allots shares to issue house with a view to offer shares to public. Now, offer made by issue house is deemed to be public offer if any of the 2 conditions are satisfied. What is the first condition? If such offer is made within 6 months of allotment or agree to allot. What is condition number 2? Condition number 2, at the time of public offer, full consideration for securities has not been received by the company. Now tell me, when that offer is not treated as public offer, you have to write reverse conditions. That means offer made after 6 months, end, or becomes end. At the time of making offer, whole consideration has been received by the company. Then it is not deemed to be public offer. No need to prepare prospectus, no need to issue any prospectus. Clear? Now who prepares prospectus here? Issue house. Coming to the contents of deemed prospectus, section 26 contains similar, plus net amount of consideration received or to be received by the company, time and place for inspecting the contracts. You have to additionally disclose these 2 points. What are those 2 points? Net amounts of the consideration received or to be received, time and place for inspecting contracts. Which contracts? Contract between company and issue house. Clear? Contract between company and issue house. Next one, who signs deemed prospectus? Persons making public offer, simply issue house. If issue house status is a partnership firm, then it should be signed by at least half of the partners. At least, the word at least, not less than or at least to be used. If issue house status is a company, then it should be signed by 2 directors. Coming to the contents of deemed prospectus, all contents as specified in 26 plus about consideration plus about place of inspection of contracts. And the person signing deemed prospectus, we assume them as directors. So for all misstatements, who get punishment? These directors, these people who are signatories of the offer, they will get punishment. And all legal obligations will arise more, like misstatements in the prospectus, contents, liabilities, everything will be similar to section 26 only. And one important note point, company is making a rights offer, company is making rights issue. If members are renouncing the rights in favor of outsiders, if the count of outsiders exceeds 50, then the document becomes deemed prospectus. That means that concept is covered under section 25. Deemed public offer, everything is applicable. Clear? Next one, offer for sale to the public. Only point you have to understand here is, under offer for sale to the public, under offer for sale to the public, company will get money, but company cannot use that money. Company should return that money to the selling shareholders. It is an option given to the existing shareholders to dilute their holdings to the public. So here you will find three parties. Selling shareholders authorize company to offer their securities to the public at a large. Now whatever offer is made by company, we assume it as a public offer, that is deemed public offer. For this also company should prepare a document called prospectus. See, there is a difference between 25 and 28. 25 issue house is involved, 28 selling shareholders are involved. Selling shareholders authorize company to sell their shares to the public. Both are different. Both are different. Under section 28 offer for sale, who signs this prospectus? Company director signs this prospectus. Under 25 deemed prospectus, who signs deemed prospectus? Issue house authorized person signs the prospectus. Can I proceed? Everyone? Now you know, under offer for sale, conditions like minimum subscription, minimum application value will not arise, because here it is not allotment of shares, it is just a transfer of shares. Tell me, under offer for sale, subscription is happening, allotment is happening, or just a transfer? Just a transfer. Existing members with the help of company selling their shares to the public. So minimum subscription, minimum application money, statements by board of directors regarding utilization of funds will not apply. But you know, 34 misstatements in prospectus, 35 civil liability, 34 criminal liability, all these are applicable. Section 26 is also applicable. Filing of prospectus with ROC, everything is applicable. Only change, money will not, company will not receive money. Whatever money company receives, after deduction of legal expenses, all other expenses, balance amount company will return to the selling shareholders. Can I proceed? Next one, variation of terms of the contract or objects stated in the prospectus. So can a company change terms of the contract mentioned in the prospectus? General rule, no. But exception, yes. Yes, only if it is with special resolution. You can see here, company cannot change the terms or objects of the prospectus without special resolution at a general meeting. So special resolution should be passed via postal ballot in this case. And for getting resolution, yes, company has to issue notice calling for general meeting. Along with the notice, explanatory statement shall be attached. In that explanatory statement, company has to provide details like what are the original conditions, what are the altered conditions, how much money raised, how much money utilized, progress about original contracts, unutilized money, what variation we are seeking, why we need that variation, proposed time frame to complete varied objectives, clause wise details of original objects and altered objects, risk factors associated with new objects, and any other material information which can influence members from taking decisions. Next one, advertisement and website. Yes, prospectus reached public via advertisement. Now alteration to objects specified in the prospectus also requires advertisement. Here it is compulsory. Advertisement is compulsory. In how many newspapers? 2 newspapers, English vernacular newspaper, and same shall be published on company website. An important point, dissenting shareholders. So what is the treatment to the dissenting shareholders, sir? Can company offer buyback to the dissenting shareholders? No, company cannot offer buyback. Then who will offer buyback to the, who will offer exit option to the dissenting shareholders? Either promoters or controlling shareholders. Price, terms and conditions, SEBI will take care of. SEBI will take care of all the activities. And if they want to ask a question on section 27, they can frame an illustration on this point. Sir, with the special resolution, is company allowed to use that money for trading of listed company equity shares? That means listed equity shares of a company? Answer is no. Speculation is strictly prohibited. So everyone remember the provision except this point. This point is also equally important. What is that? What is this point, ma? Speculation about unutilized funds. Speculation activities allowed or not allowed? Not at all allowed. Can I proceed? Everyone. Next, misstatements in the prospectus. First of all, what is misstatement in the prospectus? What is meant by misstatement? Any misleading statement or any false statement. Any omission of fact, if it is misleading the prospectus, or inclusion of false particulars. Both the cases we call misstatement. What is the punishment? If misstatement comes, people authorizing issue of prospectus gets punishment under section 447, and they get exemption only if they prove that misstatement is immaterial, or they had reasonable grounds to believe that statement was true until filing a prospectus with a ROC. So on the basis of these two grounds only, they get exception to the liability, or else they get punishment under section 447. Civil liability. When civil liability comes into the picture, first condition, there should be misstatement. Second condition, first condition, there should be misstatement. Second condition, there is a loss to the subscribers. There is a loss to the subscribers. I'm using the word subscribers. I'm not using the word buyers. You know, buyers you will find in stock markets. Subscribers means those who file application based on the prospectus. So there should be a misstatement and there should be a loss to the subscribers, then only civil liability comes into the picture. Here 6 people, how many people? 6 people. Who are they? Company, promoters, present directors, proposed directors, expert. Next one, person authorizing issue of such prospectus, maybe CEO, CFO, etc. All these people will get punishment. What is the punishment? Compensate the losses of investors. Compensate the loss to the investors. Tell me, this remedy, is it available to subsequent acquirers from the stock markets? No. This benefit is restricted to persons who subscribed securities on the faith of prospectus. Suppose I didn't read prospectus, sir. I subscribed shares without reading prospectus. I am at loss. Can my loss be reimbursed? No, because you didn't study prospectus. Doctrine of constructive notice is applicable. Are you all getting my point? Everyone? So the conditions is prospectus, person should have read prospectus which contains misstatement, and finally he is at loss. Who? Subscriber or purchaser? Subscriber. Sir, any exemptions, sir? Yes. If you withdraw consent before filing prospectus with ROC, you will be exempted. Or if you give public notice regarding inclusion of your name wrongly, mistakenly your name is included, at least if you give public notice, you will be exempted. Or, sir, I believed experts, sir. On the faith of expert statement only, I gave my consent to the prospectus, sir. So if you prove any of these grounds, if you fall under any of these 3 grounds, then you get exemption from civil liability, or else civil liability. What is the punishment? Loss suffered by the investors who subscribed securities on the faith of prospectus. Any limit on liability? No limit on liability. Next one. You know, there are few examples for misstatements. Just give one time reading, because these 3 cases can be tested individually in the examination. So these points, you know, on these points they can frame a question and they may ask you whether civil liability applicable or not applicable. Getting my point? Suppose substantial portion of securities has been subscribed by director and friends. In fact, it is a false. Now this is misleading in nature, so this is a misstatement. Next one, company is paying regular dividends. In fact, company is not at all paying dividends. Now this is a false information, inclusion of false information. What is happening? Misleading the public from subscribing. No, it is making people to subscribe securities. So this is also misstatement. Next one, statement about company's turnover was true only if considering production capacity. So if you increase that production capacity based on this, you know, turnover will be true, means that means your assumptions are misleading in nature. Again, it becomes a misstatement. Getting my point? Next one, remedies for the misstatements in the prospectus. What remedies are available for the misstatements in the prospectus? First one is they can cancel the contract because their consent is not free. Misstatement means, you know, it is similar to the effect of fraud. Contract becomes voidable at the option of a subscriber. If he want, he can cancel, or he can continue by claiming the damages. But you know, this claiming the damages or cancellation of contract is not available to the subscribers of MOA subsequent purchases from the market, because there is no direct contract between company and a subsequent purchaser. There should be a contract on the basis of prospectus. Subsequent purchaser means what? Company allotted shares to me, I sold shares to you. So you didn't got shares through the prospectus, I got shares through the prospectus. I can cancel the contract, but now I can't cancel the contract because I already sold shares to you. You can't cancel the contract because you didn't subscribe through the prospectus. Next one, right of action for damages. If the misstatement amounts to the fraud, investor has a right to claim damages even if company is in liquidation. What are the prerequisites to claim damages? First of all, there should be a prospectus which contain material misstatements as to the facts, and finally, I suffered some losses. Damages for deceit, that means damages for fraud. So can I claim damages for fraud? Yes. For that also same prerequisites. Fraudulent misstatements in the prospectus, and this misstatement is about facts, not opinion. Fact. Fact means actual things. If you are providing wrongful things, that means misstatement as to the facts. Original allottee who saw the prospectus and finally who got deceived, only that person can claim damages for deceit. I can, either I can cancel the contract. If I cancel the contract, I get my money back. No, I can continue the contract by claiming my losses. Whatever losses I got due to misstatements in the prospectus, I can got those losses. I can also claim damages for the fraud. Because of these misstatements, I was upset. I was upset mentally. And every day I'm going to the court, all legal expenses, whatever losses to me, I can also claim. But I should be a original allottee. I should have read the prospectus which contain a material misstatements with respect to the facts. Finally, I suffered a loss. Clear? Next, section 36. Punishment for fraudulently inducing persons to invest money. See here, a person will make a statement. He may be connected with the company. That means he may be a director or employee, or he may be an outsider. But he is making some statements either intentionally or negligently. And what kind of statements he is making? False, deceptive, misleading. Deliberately hides material facts to induce another person to enter into an agreement for acquiring, disposing, subscribing of securities like Harsha Mehta. Secure a profit to any of the parties from fluctuations in the securities value. For obtaining credit facilities from the bank. Company applied for bank loan. Actually, company is not eligible to claim bank loan because company is in losses. Now that company CFO is making fraudulent financial statements. He is converting loss-making financial statements into profit-making financial statements with an intention to obtain loans from the banks, with an intention to obtain loans from the financial institutions. Then such persons will get punishment under section 447. And what is the punishment under section 447? First, we need to check whether public interest is affected or not. If public interest is affected, imprisonment minimum 3 years, maximum 10 years. Minimum 3 years, maximum 10 years. Next one, fine. Minimum amount involved in the fraud, but may be extended to 3 times of the amount involved in the fraud. But if public interest is not affected, then check amount of fraud involved, whether it is greater than or equal to 10 lakhs or 1% of the turnover. Amount involved in the fraud is 5 lakhs, sir. It is less than 10 lakhs and it is also less than 1% of turnover. Then the punishment is imprisonment up to 5 years or fine up to 50 lakhs or both imprisonment and fine. Suppose, sir, suppose amount involved in the fraud is 20 lakhs. Now 20 lakhs is greater than 10 lakhs, yes or no? So 20 lakhs is greater than 10 lakhs. If no public interest, then imprisonment minimum 6 months, maximum 10 years. Fine, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. So fraud amount is 20 lakhs, right? Fine is minimum 20 lakhs, maximum 3 times of 20 lakhs means 60 lakhs. Are you all getting my point? Everyone? Next. Meaning of fraud, you all know, but these points are important. Wrongful gain, wrongful loss. Actually, I'm not entitled to that profit, but I'm claiming it. It's a wrongful gain. Wrongful loss means I should incur that loss. Legally, I should bear that loss. But illegally, I'm transferring loss to some other party. That means it's a wrongful loss. Someone should get that gain. If I claim it illegally, it's a wrongful gain. I should incur loss, but I am spreading that loss over other members. It's a wrongful loss. One, I'm not entitled. Other, I'm entitled. Not entitled, I'm taking. Entitled, I'm giving away. Both are wrongful only. Punishment for personation, for acquisition, etc. of the securities. Personation means what? Changing the identity. Why? So that I can file multiple applications for securities. In that case, the person who is engaged in such kind of activities, he will get punishment under section what? 447. How he can make personation? Either he may file an application in fictitious name, that means a person is not in existence. I'm filing application with a name who is not in existence, or I'm filing an application with my name only but in different combinations. Suppose DVS, one application DVS, other application VS, other application S, other applications DS, other application DV. So multiple applications I'm filing in my name in different combinations. Or I'm inducing company to allot securities in a fictitious name, then I will get section 447 punishment. In addition to that, whatever gains I got, whatever profits I claimed, all those profits, all those gains shall be transferred to IEPF. Not only shares but also securities I am possessing. All those securities are subject to seizure and disposal. Seizure and disposal of securities found in my possession. All those amounts, all those securities will be credited to IEPF account. Clear, everyone? Next, 34, 35, 36, class action suit. Suppose I issued a prospectus, 1 million persons got affected because of misstatements in the prospectus. How many? 1 million. That means 10 lakhs. Now individually, if they file application, if they file cases on me, how many cases would be? 10 lakh cases. But matter is only one matter, misstatement in prospectus. So instead of filing 10 lakh cases, file just one case. All represent, one representing all, or all can file only one case on me. That's what class action suit. Can I proceed? Next one, minimum subscription and allotment of securities. What is meant by allotment? What is the meaning of allotment? Allotment refers to appropriation out of previously unappropriated capital of a company. Two conditions to be satisfied: appropriation, previously appropriated capital, unappropriated capital. Unappropriated capital. Appropriation out of previously unappropriated capital is called allotment. Who should make appropriation? Board of directors or a committee of directors. Only they can make appropriation. And shares comes into existence only through allotment. Without allotment, shares will not come. Now tell me, reissue of forfeited shares, offer for sale of securities. In these two cases, allotment term comes or not comes or not comes. Because reissue of forfeited shares, offer for sale, it's simply a transfer. It's simply a transfer. Whereas allotment, fresh shares are offered to the applicants. Fresh shares are allotted to the applicants. It is done by the board of directors. What is that activity? Appropriation. What? Previously unappropriated capital. So what are the conditions, for minimum subscription, for minimum application money? What are the conditions a company should satisfy? Minimum subscription. First of all, minimum subscription means it is an amount mentioned as minimum amount in the prospectus. It is the amount mentioned as minimum amount in the prospectus, and it should not be less than 90% of issue size. That means minimum subscription is equal to minimum subscription mentioned in prospectus or 90% of public offer, whichever is higher. So when a company should satisfy minimum subscription, minimum application conditions, company should satisfy these conditions within 30 days of issue of prospectus. If not, refund within 15 days from closure of public offer. So when offer closed, from that date onwards, yes, at that date everyone knows whether minimum subscription, minimum application money condition satisfied or not. So from that date onwards, 15 days, within 15 days, refund. Refund to whose account, sir? Refund to bank account from which subscription money was received. In case of default, officers in default, it's not company, officers in default will get punishment. What is the punishment? They need to add interest. How much? 15% per annum interest they should add. They should add 15% per annum interest for the delay period. And minimum application money condition is at least 5% of face value or as specified by the SEBI. Currently it is 25% of issue price. Once allotment is done, it is a duty of company to file return of allotment with ROC within 30 days using form PAS3 along with prescribed fees. And what are the documents to be attached with PAS3? For that, separate question is there. Just give one time reading. Not that much important. The attachments are like this. The attachment is copy of contract. Copy of contract. I'm talking about which type of allotment? Allotment for non-cash consideration. If it is for cash consideration, list of allottees, number of securities allotted, sufficient. If it is for non-cash consideration, copy of contract to be attached. or sale deed should be attached. If not available, then write it now, execute it now in writing, stamp it as per the Indian Stamp Act and attach the document. Along with that, registered value report is also required regarding valuation of consideration, valuation of issue price. And what is the time limit to file this form? 30 days. Any default, punishment. What is the punishment? 1000 per day for company as well as officer. 1000 per day, maximum 1 lakh. Under section 39, default is of two types: failure to refund within due period, failure to submit return of allotment within due date. Failure to refund within due date, failure to file return of allotment with ROC within due date. In these two cases, punishment is 1000 per day during such contravention continues up to 1 lakh rupee. Can I proceed? 39 over 40. Tell me, until I make allotment, all the application money shall be kept in my account, separate bank account, and that money can be utilized for how many purposes? Two purposes. One is adjustment against allotment of securities, or repayment of money if company is unable to allot securities. If company allots securities, use that money. Who use that money? Company use the money. You can transfer that money to your own bank account, utilize as per the object specified in the prospectus. If not, refund it. Okay, no? But before making allotment, company has to file an application for listing approvals, and company should obtain listing approval from all the stock exchanges whose names are mentioned in the prospectus. Suppose one stock exchange rejected our application. Now can I proceed with allotment? Should I refund that money? Question, you didn't get it. I filed application for listing with 3 stock exchanges. 2 gave approval, 1 rejected me. Now can I proceed with allotment of securities, or should I refund application money? I should refund application money. Speed okay na? Everything okay. Next one. Next important point: any condition that attempts to make applicants waive compliance with any of the provisions of this section will be considered void. That means imposing any conditions in the prospectus stating that even though if I don't comply with provisions of Companies Act, I won't refund, I will make allotment. Such terms and conditions stands void. Punishment: for company 5 to 50, for officer 50,000 to 3 lakhs. What is 5 to 50? 5 lakhs to 50 lakhs for company fine, officer 50,000 to 3 lakhs. And payment of underwriting commission. Here you need to remember conditions for payment of underwriting commission. What are the conditions? First condition, authorization of AOA. And commission can be paid out of issue proceeds or company profits or both. Either issue proceeds or company profits or both. Then what is the rate of commission? Maximum rate of commission. Rate mentioned in AOA or 5% in case of shares, 2.5% in case of debentures, whichever is lower. Sir, 5% or 2.5% on what? 5% on issue price, 2.5% on issue price. Clear, everyone? Next condition, disclosure in the prospectus. Yes, with whom you made underwriting agreement. What are the terms and conditions? Okay, but in the entire underwriting commission, important point is company should not pay commission on the securities which are not offered to the public. If promoters are subscribing any securities, company is prohibited from paying underwriting commission on the securities which are not offered to the public. Next, private placement. In the entire private placement, remember a limit. What is the limit? 200. Is it throughout the company? No, throughout the lifetime of the company, per financial year? Per financial year. And while counting 200, 2 people are excluded. Who are excluded? QIB, ESOP. And is this 200 limit only for all securities or for security, for one security, for each security? Let me repeat. 200 count is not lifetime, it is per financial year. It is not for all securities, it is per security. And while counting 200, QIB, qualified institutional buyer, employees under ESOP are excluded. And this count 200 is not applicable to NBFC housing finance companies. For them, specific regulatory limits are already made applicable. Next one, if company makes offer exceeding 200, it is deemed to be public offer. Next important point in private placement, authority. Whose approval is required for making private placement? Whose whose approval is required for making private placement? For that, we need to classify securities into three parts: equity, preference, debenture. Debenture again two parts: convertible debt, non-convertible debt. For equity, preference, convertible debt, one private placement, each private placement requires a special resolution. For non-convertible debentures, if they are within the limits under specified under section 180 subsection 1 clause C, that means 100% of paid up share capital plus free reserves plus securities premium, outstanding debt plus proposed non-convertible debt, if it is both less than or equal to 100% of paid up share capital plus free reserves plus securities premium, then board resolution is sufficient, or else one special resolution for 1 year is needed. Clear, everyone? Now for getting members resolution, yes, definitely we have to issue notice calling for meeting. Along with that notice, we need to provide explanatory statement specifying kinds of securities we are offering, justification, and who performed valuation, how much amount we are going to raise through private placement, and what are the terms of issuance. Everything we need to prescribe. Next one, board resolution for issue of NCDs within the limits specified in section 180 subsection 1 clause C. In that next important point is, private placement offers come application letter to be issued within how many days? 30 days of recording the names. And such payment shall also be made through banking channel, not cash mode. Cash mode is not available. Through banking channel only payment should be done. And once company received those monies, within 60 days company has to make a allotment, or else within next 15 days company has to refund failure. Company is liable to pay interest at the rate of 12% per annum, including for that default period. Everyone getting my point? 12% per annum from 61st day onwards. Next one, suppose I made offer to joint persons. That means, two or more persons holding, to the two or more persons, I made an offer jointly. In case of joint shareholding, amount should come from whose which bank account? First named person. If an application is having two or more names, in that first named person bank account, from first named person bank account only we should receive money. And all the money shall be kept in separate bank account, shall be utilized only for two purposes. One is allotment, other one is repayment. If you proceed with allotment, utilize that money, or else refund that amounts to the applicants. And filing resolutions, filing allotment letters with ROC is compulsory. But if you make any default in filing ROC returns, in filing written of allotment with ROC, punishment is 1000 per day up to such default continues, maximum 25 lakhs. 1000 per day during such default continues, maximum 25 lakhs. And if a company wants to make fresh private placement, it has to check whether previous private placement has been completed or cancelled. Either two things should be happened. That means keeping previous private placement pending, company is prohibited from making new private placement. So can company advertise private placement? No. In private placement, renunciation benefit is available or no? A question can be asked on these 2 points. If company advertises private placement offer come application letter, what would be the consequence? It is deemed to be public offer. And it is not a private placement offer come application letter, it is deemed to be prospectus. Renunciation available or not available? Not available. Advertisement not available, renunciation not available. Suppose section 30, can company follow section 30 for private placement? What is section 30? Advertisement. Can company follow advertisement provisions for private placement? No. Renouncement also? No. Non-compliance of section 2042, the punishment is up to 2 crores. How much? Up to 2 crores. And what is the minimum amount? Amount raised through private placement offer come application letter. Either amount raised or 2 crores, whichever is lower. And immediately you have to refund those monies within 30 days of imposition of penalty, or else offer will be treated as deemed public offer, and it is prospectus related conditions shall apply. Clear? Next one, irregular allotment. One time irregular allotment question came in the exam. So when allotment is treated as irregular, very simple. Without prospectus if you make public offer, without filing prospectus with ROC if you issue prospectus to public. Next one, prospectus containing material misstatements, without minimum subscription, without minimum application value if I make allotment of securities, without stock exchanges approval if I make allotment of securities to the public at a large, then also it is treated as irregular allotment. What is the consequence of irregular allotment? Company has to refund all the application monies. In addition, company will get a punishment under respective sections. Clear? Global depository receipts. Here in this concept only one point you remember. That one point is who can exercise voting rights in case of GDRs? Depository receipt holders are overseas depository. Overseas depository. Until GDRs are converted into equity shares, until depository receipt holders becomes member of the company, he cannot exercise voting rights. Only overseas depository bank exercises voting control, voting power. Clear? Everyone? Approval process is common ma. Special resolution is required, members approval is required. Compliance with FEMA also required. So with this prospectus chapter completed. Let's continue revision with next chapter, share capital and debentures. Second biggest chapter in the entire corporate and other laws, that is after management and administration. Here we are having sections 43 to 72. For remembering section numbers, I'll make a separate video for each and every chapter and I'll upload on my channel. But for the time being, I'm not going to revise section numbers in this revision lecture. And if you look at the important concepts in this share capital and debentures, section 54 specifically limits with respect to sweat equity shares. In a year, to what extent company can issue sweat equity shares? Throughout the lifetime of the company, to what extent company can issue sweat equity shares? How startup companies are getting exemption? That is important part in limits in sweat equity shares, section 54. Next, duplicate share certificate. Procedure of duplicate share certificate is not important, but punishment with respect to duplicate share certificate is very, very important. Next, application of securities premium. All these questions are repetitively asked in the MTPs, RTPs, previous examination questions. Next one, preference shares. Deemed redemption concept is important. Issue of preference shares, conditions for redemption of preference shares, they are important, but deemed redemption is very, very important. Next one, forged transfer. With respect to transmission of securities, forged transfer is important. And refusal to transfer, what are the rights available to the aggrieved party? That is also important. Bonus shares. At times, every 3 attempts you take 2 attempts, there will be question on bonus shares only. Right now, this is not getting tested. Next one, buyback also. Every 3 attempts, 2 attempts, there will be question on buyback. Generally 2 questions come from this chapter. The expected weightage of this chapter, minimum 8 marks. Maximum, including multiple choice questions, it can touch 15 marks also. So objective question point of view, you should have knowledge about this chapter. Next one, prohibition on buyback. Yes, I told you many times. Apart from general rules, apart from general provisions, punishments, prohibitions are very, very important. Next one, financial assistance to the employees, exceptions to restrictions on purchase of company shares, exceptions in that third exception. Giving loans to the employees to purchase or subscribe company shares, that is important point. And last one, disqualifications of the debenture trustee. So in the past 2 attempts, in the past 2 attempts, this question came into the examination. Now let's see the chapter share capital and debentures. Total how many sections? 30 sections. So starting with kinds of share capital, types of share capital. I repeat, kinds is different, types is different. Kinds means we are having only 2 kinds, equity, preference. Types means authorized, issued capital, subscribed capital, called up capital, paid up capital. Okay. So equity share capital means any share capital other than preference share capital. Any share capital which is not preference share capital, it is equity. It is of two types. One is ordinary shares, other one is differential rights. For issue of equity shares with the differential rights, company has to satisfy certain conditions. I'll discuss with you, just wait. Next one is preference share capital. Any share capital which carries priorities, preferences when compared to equity shareholders, we call it as preference share capital. What are those priorities or what are those preferences? One is dividend payment priority, second one is redemption of capital, that means repayment of capital either with premium or without premium, subject to MOA, AOA issue terms. But that means dividend payment, repayment of capital, yes, preference shareholders get priority compared with equity shareholders. And preference shares can be participative preference shares. In case of participative preference shares, who will also get right to participate in profits available to equity shareholders? It is preference shareholders. Which profit? Profit remaining after payment of preference dividend, after payment of equity dividend, whatever profit left over in that equity pool. If preference shareholders are also getting participation rights, then those preference shareholders are called participatory preference shareholders. That capital is known as participatory preference share capital. Okay now, so preference share capital can have participatory rights or can have two preferences, or they can also have both. Sir, no preference rights, sir, or no participation rights, sir, then it is equity share capital. No preferences, no participation right, then it is equity share capital. Next one, equity shares with the differential rights. What are the conditions a company should satisfy for issuing equity shares with differential rights? Just remember default MOA. Just remember default MOA. Now reverse, default MOA reverse. First one, A stands for AOA authorization. O stands for ordinary resolution. If it is a listed company, then that ordinary resolution shall be passed through postal ballot. M stands for maximum limit. What is the maximum limit a company can issue equity shares with differential rights? So that voting power from differential rights shall not exceed 74% of total voting power. This condition we should check before issue, after issue. After issue of equity shares with the differential rights, all times. Post issue of equity shares with the differential rights, voting power from differential rights shall not exceed 74% of total voting power of the company. So you know default MOA, in default MOA we completed MOA. Now we need to talk about default. So here defaults are classified into how many parts? 3 parts. How many parts? 3 parts. You can see here in handwritten notes I will show that content. Defaults are of 2 types. Subsisting default, time default. Time default again 2 types. 3 years defaults, 5 years defaults. Subsisting default means at the time of issue of equity shares with the differential rights, company shall not possess these defaults. At the time of issue, company shall not possess these defaults. Time defaults means for the prescribed time period, company should not commit those defaults. Clear? So subsisting default, how to remember these defaults, sir? As you know, we are having 5 sources of finance: equity share capital, preference share capital, deposits, debentures, and then term loans from the banks of financial institutions. Now just observe what kind of defaults are possible in these 5 sources of finance. For equity share capital, we can do default in with respect to declared dividend. For preference share capital, we may do default of payment of dividend, we may do default of redemption of capital. In deposits also, payment of interest, redemption of principal. In debentures also, payment of interest, redemption of principal. Payment of interest, redemption of principal. Term loan also, payment of interest, redemption of repayment of principal. Now total 5 sources of finance are there, 9 defaults are there. Out of 9, preference dividend, term loans will fall under 5 years. All remaining defaults comes under subsisting. That means declared dividend, preference share capital redemption, debentures, interest on debentures, deposits, interest on deposits. If company is having these defaults, rectify and then proceed with issue of equity shares with the differential rights. Next defaults, last 3 financial years, company should not commit these 2 defaults. What are those 2 defaults? Non-filing of returns with ROC, penalized under sectorial regulators, that is RBI, FEMA, SEBI, SCRA. RBI, FEMA for money, SEBI, SCRA for securities. So last 3 financial years, any defaults are there? Wait. Until last 3 years, it proves that there is no default. last 3 financial years it is proved that no default, then you can proceed with issue of equity shares with differential rights. Next one, 5 years is entirely different concept. Here year of default is not required. Here year of rectification is important. Ignoring year of rectification, next 5 years company is prohibited from issuing equity shares with differential rights. What are those defaults? Already told you. Term loans principal, term loans interest, preference dividend, already I told you. Extra 2 points you have to remember. Those extra 2 points are employee statutory dues, IEPF transfers. Clear? Clear? Everyone? Next one, ordinary resolution I need. That means members approval I required. For members approval I should issue notice, and along with the notice I should also attach explanatory statement. In that I should mention details about issue, kind of share cap, a type, how much capital you are going to raise, to whom you are offering those securities, everything I need to mention. Conversion allowed or not allowed? Conversion of existing equity into equity with the differential rights not allowed. Either company should take back those shares, company can issue equity shares with the differential rights, but automatic conversion is not possible. Through issue only equity shares with the differential rights comes into picture. And disclosures in board report compulsory. Rights of equity shareholders holding differential rights is similar to rights of ordinary shareholders, but they had only 2 differences. The difference is voting right may be up or down. Next one, dividend may be up or down. Getting my point? Equity shares with the differential rights, they may not have equal voting rights. They may have inferior voting. That means 10 shares equal to 1 vote, or they may have superior voting. That means 1 share equal to 10 votes. Getting my point? Everyone? Everyone. Next, particulars to be mentioned in the register. Particulars to be mentioned in the register. So simply last 2 points is all about disclosures. This point, disclosure in board report, disclosure of particulars in the registers. Section 43 not applicable to IFSC public company, private company, provided MOA, AOA provides otherwise. Same is there in material, but in material chart form is not there. All the points are incorporated in a simplified manner only. Clear? Next one, share certificate section 46. Share certificate section 46. So share certificate gives you 2 rules of estoppel. One is ownership estoppel, other one is liability estoppel. On the share certificate, if your name is visible, you are the owner of the company prima facie. And if you are holding fully paid up shares, that means your liability in future is 0. So tomorrow company cannot deny your ownership, company cannot deny your liability. That means if there is 0 liability, tomorrow company cannot increase the liability. 0 liability means what? Face value is equal to paid up value, then unpaid value becomes 0. Unpaid value 0 means liability is also 0. Everyone getting my point? Everyone. Now that share certificate, to be a valid share certificate, it should be issued under common seal of the company. If no common seal, don't worry, don't affix common seal, but it should be signed by 2 directors or 1 director and CS. If company appoints 1 CS, then 1 director and 1 CS. So here the important topic is duplicate share certificate. When duplicate share certificate comes into the picture, if original share certificate is either lost or destroyed, or it is available sir but defaced, mutilated, that means turn into 2 pieces. Now in second case, you can surrender original share certificate to the company for the want of duplicate share certificate. But in the first case, there is no share certificate at all. So here they need to submit a indemnity bond. Here they need to submit indemnity bond. Getting my point? Next one, how much fees they should pay at the time of application? Up to 50 per certificate. And disclosures important, 2 disclosures. One disclosure is in register of duplicate share certificate, other disclosure is on the share certificate itself. Duplicate issued in lieu of share certificate number and prominently print duplicate, so that easily can be identified, this is a duplicate share certificate. And what is the time limit for issuing duplicate share certificate? If your company is unlisted company, you should get duplicate share certificate within 3 months of application. If your company is listed company, duplicate share certificate should be issued within 45 days. Clear? And everything should be recorded, in the separate registers, in register of members, update register of members with a duplicate share certificate details. Next one, register shall be kept at registered office or at any other place where register of members is kept. For demat, all these things will not apply. Depository records are prima facie evidence of the ownership. Next one, manner of issuing certificates or duplicate certificates. You can see section 46 overrides company AOA. That means whatever section 46 subsection 3 is telling, just follow it. Ignore AOA. Share certificates are issued for physical shares only, not for demat. And what are the prerequisites we need to satisfy? Surrender letter of allotment or fractional coupons. If you had letter of allotment, surrender it, you will get original share certificate. If you had original share certificate which is turned into pieces, then surrender original share certificate to get a duplicate share certificate. Fractional coupons, I told you. If company is offering bonus shares in the ratio like this, for example, 1:19. For every 19 shares, you will be given one bonus share. Suppose I am having only 18 shares. Now, will I get complete share? No. I will get 18/19 fraction part of share. It's not actually share, but it's a coupon. The moment I get 1/19 coupon from other person, both together it becomes one share. Now I can take this one share. So on surrender of these fractional coupons also I will get shares. And share certificate should be in which form? Form SH1. And share certificate shall contain particulars, names of the shareholders, number of shares, amount paid up on each and every share. Next one, maintenance of share certificate records. I told you these should be kept in the possession of CS or any authorized person. And all records shall be maintained at least how many years? 30 years. MCQ point of view important, or practical question point of view, true or false point of view also important. Share certificate records shall be maintained at least 30 years. And in case of disputed cases, dispute with respect to ownership, so those certificates, those records shall be maintained permanently till the liquidation of the company. Next one, surrendered certificates shall be defaced. That means shall be cancelled and can be destroyed after 3 years subject to board resolution and in the presence of a duly authorized person. So actually why surrender of certificates happens, suppose at the time of allotment I got partly paid up share. The moment I pay complete amount, what happens? I will surrender my present share certificate to the company. Company will issue new share certificate. You can see Infosys earlier issued partly paid up share certificate. If company makes calls on shares, if I make payment, along with that payment, I will also submit a original share certificate so that I will get another certificate with a full paid up value will be mentioned. Punishment for fraudulent duplicate certificates, this punishment you have to remember. For officer in default, punishment is 447. There is no compromise, 447. For company only, fine. How much? Minimum 5 times of face value involved in the duplication. Maximum 2 limits are there. For maximum 2 limits. What are those 2 limits? 10 times of face value or 10 crores, whichever is higher. It's not lower, whichever is higher. Getting my point, everyone? So, under this section, under section 46, a company may issue original share certificate upon surrender of letter of allotment. A company may also issue duplicate share certificate based on the application. For issue of original share certificate, we have to comply with section 56 provisions. Within 2 months from the date of allotment, within 2 months from the date of incorporation, within 1 month of delivery of transfer or transmission documents, those points are there. Whereas for duplicate share certificate, time limits have been prescribed under section 46. That is 3 months for unlisted, 45 days for listed. Previously, it's 15 days like that there. But amendment came, 45 days for listed company, 3 months for unlisted company. Can I proceed? So remember all these limits. Next one, 47, voting rights of the shareholders. Tell me, on all resolutions in general meeting, who gets voting rights? Equity shareholders. How many votes each equity shareholder will have? It depends on number of shares held by the person. In fact, technically, how much is the paid up share capital? In that paid up share capital, how much he is holding, that proportionate he is entitled to the voting rights. Now in this section, we need to discuss about preference shareholders voting rights. When preference shareholders get voting right? On 3 matters, specifically they get voting right. One is matters affecting their rights. Suppose originally we agreed to pay 10% dividend, now we want to decrease it to 9%. So this is a matter affecting their rights. Preference shareholders will be given voting rights. Second one is winding up of the company. For winding up of company along with equity shareholders, these people consent is also required. Third one is reduction of capital under section 66. Suppose their paid up value is 10 rupee, their face value is also 10 rupee. Company decided to reduce the paid up value to 8. Whatever losses are there in the company decided to write off losses against paid up value. Now here also preference shareholders will get voting rights. So 3 cases preference shareholders will get voting rights. Another point, sir, when preference shareholders get equal voting rights along with equity shareholders in a general meeting. So do you think preference shareholders get voting rights similar to equity shareholders in general meeting? Generally no. But if their dividends are not paid, forget about whether they are cumulative or uncumulative, continuously, consecutively 2+ years if they are not getting dividends, then they will also get voting rights equal to equity shareholders. That means equity shareholders, if they can exercise voting right on 10 resolution, preference shareholders can also exercise voting right on 10 resolutions. And what is the voting power of preference shareholders, sir? It depends on the total paid up share capital. Suppose preference share capital is 40 lakhs, equity share capital is 60 lakhs. What is the total paid up share capital? Total paid up share capital is 100 lakhs. Visible? Now preference shareholders will get 40 out of 100 lakhs. That means total preference shareholders voting power is 40%. Equity shareholders voting percentage will be 60%. Are you all getting my point? Everyone? That proportionate is difficult to understand but very simple. That proportionate. Shareholders vote proportionately to the paid up share capital of their share class in the AGMs or EGMs. Can I proceed? Everyone? Next, section 47 does not apply to private companies. Specified IFSC public companies provided their MOA provides for it. Okay, that is ignore. But in the entire section 47, important point is C point. C point is important. If preference dividends remain unpaid for 2+ years, those shareholders can vote on all resolutions like equity shareholders, and they will lose voting rights once their dividends are paid. Once their dividends are paid, their voting rights becomes 0. Variation of rights of the shareholders. 5 points. Remember 5 points. Variation, that means alteration. So for alteration, definitely mutual consent of the parties is required. So here company requests members to change the terms and conditions, and members gives approval by way of passing a resolution. If meeting is possible, special resolution. No, sir. Postal ballot is applicable, sir. Then 3/4 of the capital holders, 3/4 of the class capital holders should give permission, should give approval in writing. But before that, you need to check constitutional documents. What are the constitutional documents? MOA, AOA. Whether MOA, AOA permits variation or not. Sir, MOA, AOA silent, sir. Then go with issue terms. That means go with prospectus if it is a public offer, or go with a private placement offer come application letter. Sir, issue terms does not contain prohibition clause, sir. That means we can vary members' rights, sir. Then proceed with members' rights variation. But variation of one class, if it is affecting the other class, if variation affects the rights of another class, similar consent we have to take from other class also. Similar consent we have to take from other class also. This particular section is applicable to a company with share capital with more than one class of share capital. More than one class of share capital. Suppose if you take equity shares, here we are having 2 classes of equity share capital, like ordinary shares, differential rights. Now I am changing differential rights, then call for a meeting of differential rights holders only. Variation of rights of differential rights holders, if it is affecting ordinary shareholders, then ordinary shareholders consent also required. Can I proceed? Dissenting shareholders. Who are the dissenting shareholders? Those who are opposing or against to the variation. If they want, they can go to NCLT. But they should satisfy 2 conditions. What are those 2 conditions? One is status. What is the status? 10% or more of the class capital. The other one is time limit. What is the time limit? Within 21 days from the special resolution or consent was given for variation. 10% class capital holders within 21 days of variation can file a petition with NCLT. Now ball is in the court of NCLT. NCLT decides whether to approve the variation or cancel the variation. Whatever NCLT passes an order, file a copy of NCLT order with ROC within 30 days. Clear? Last attempt only, I think, last but one attempt, this question came for 5 marks. So chances of getting the same question in the next attempt is very less. But here you need to remember limits only, limits. For approval, how much limit I need? 3/4. For filing a petition with NCLT, how much approval I should have? 10%. 10% of the class capital. Within how many days I should file a petition with NCLT? 21 days. Once NCLT passes order, within 30 days of NCLT order, file a copy with these are the 4 limits you have to remember. Next one, 49, 50, 51. What is 49? Calls should be on uniform basis. Uniform basis means what? Same for all. Suppose sir, one group call money 1 rupee, for other group call money is 2 rupees. Can I do like that? No, it should be on uniform basis. Who is having power to make calls on shares? Board of directors. Next one, calls in advance. For accepting calls in advance, one of the important condition company should satisfy is AOA authorization. Without AOA authorization, company cannot accept calls in advance. And calls in advance, is it a capital to the company or debt to the company? Debt to the company. That's why company is liable to pay interest if authorized by AOA. With respect to calls in advance, can a member exercise extra voting rights? No, because voting rights are proportionate to paid up share capital. In paid up share capital, calls in advance is not a portion, it is a debt. Getting my point? So next, on calls in advance, is company liable to pay dividends? It depends on section 51. If AOA authorizes company to pay dividend on paid up capital, then dividend will be paid only on paid up capital, or else dividend will be paid on face value. If I'm talking about face value, I'm not considering unpaid calls or unpaid value. For me, it's not a matter at all, because face value is something greater than paid up value if shares are partly paid up. Getting my point? That means some people they made calls in advance, some people they paid only call money. For all, on 10 rupees only they get dividends. For all, on 10 rupees only they get dividends. That means you paid calls in advance, extra dividend. They didn't pay calls in advance, less dividend. It won't be like that. For all, uniform dividends only. Okay now. But if it is on paid up value, if authorized by AOA, then in that case also, on paid up value only you get dividend. Calls in advance is not a part of paid up value, so you won't get dividend on calls in advance. Calls in advance become call money when company make calls on shares subsequently. Next one, issue of shares at premium. There is no prohibition to fix security premium this much only. There is no condition specifying that security application premium, security premium should be this much. It should be 20% of face value. It should be 100% of face value. Like that, there is no condition. If you want, you can fix securities premium according to your will and wish. But there is condition only on utilization of securities premium. On what? Utilization. Tell me, for what purpose I can utilize securities premium? For all companies, securities premium can be utilized for buyback, bonus issue, expenses connected with issue, preliminary expenses, redemption of preference shares, redemption of debentures, premium on redemption of preference shares, premium on redemption of debentures. For all companies, 5 purposes: bonus shares, right of preliminary expenses, right of expenses connected with issue of securities, premium payable on redemption, buyback of shares. Whereas for section 133 companies, sir, what is section 133 companies, sir? Companies which are required to prepare financial statements by complying accounting standards, AS. For them, it's not 5 purposes, only 3 purposes: buyback, bonus issue, writing of expenses connected with issue of security. Can I proceed? Next, 52 over 53. Can a company issue shares at a discount? No. 100% prohibition. 100% prohibition with some exceptions. It's not absolute prohibition. It is a prohibition with exceptions. How many exceptions are there? General point of view, one exception, sweat equity. But section specifically excludes one more item, that is, it's a matter of like internal reconstruction. It's a matter like internal reconstruction. Either under debt restructuring scheme or under statutory resolution plan, a company may issue shares at a discount to the creditors. But it should comply, the scheme should comply with RBI guidelines, directions, regulations. Okay, now can I proceed? Suppose if company makes default, that means if company is issuing shares at discount without DRS, debt restructuring scheme, or statutory resolution plan, or if it is not sweat equity, that means other than stated purposes, if shares are issued at discount, then punishment is to both company as well as officer in default. To both company and officer in default, amount raised through issue or 5 lakhs, whichever is less, is the penalty. They need to pay penalty. Along with that, they need to refund including interest at the rate of 12% per annum. So in section 53, 3 points to be remembered. Issue of shares at discount is void. Exceptions: sweat equity, DRS, SRP. DRS means debt restructuring scheme, SRP means statutory resolution plan. That's it. Non-compliance penalty. How much is the penalty? Amount raised through issue or 5 lakhs, whichever is less. But this restriction does not apply to debt instruments like zero coupon bonds, where debentures are issued at a discount. Annually we will not pay any interest. At the time of redemption we redeem at par. So you might have calculated the bond values, bond valuation in financial management or in mathematics. You might have calculated bond value based on present values. Present values, yes or no? Next one, issue of sweat equity shares under section 54. First thing, who can issue sweat equity shares? Any company or company which has completed 1 year of after incorporation. Who can issue sweat equity shares? All companies or companies who have completed 1 year of existence. All companies. 1 year of existence condition is not there now. To whom sweat equity shares can be offered? Directors, employees, but they should be permanent. Employee should be permanent employee. Director may be either full time or not. And these people may work in my company or in my holding company or in my subsidiary company. These people may work in India or outside India. Okay. Who can issue? To whom we can issue? Told you. At what price? Either at 100% discount or for a consideration other than cash. If you are getting any asset in return, record it in the balance sheet. If you are not getting any asset, then you know what you do. You have to expense it. That means you have to charge to the profit and loss account. You have to charge the amount to the profit and loss account as employee benefit expense. Clear? Everyone? Next one, conditions for issuing sweat equity shares. As I told you, one condition is missing. That condition is issued shares. Sweat equity shares, condition E. Sweat equity shares must belong to existing class of shares. Existing class of shares. So 5 conditions company should satisfy. What are those conditions? Very simple. AOA, by default AOA compliance is required. So other conditions, special resolution. How long the special resolution is valid? 12 months. Within 12 months of SR, allotment of sweat equity share should be completed. Now, for getting SR, I need to give a notice calling for a meeting. And in that notice, I need to mention number of shares being offered under sweat equity, market price, what consideration company is getting, and to whom we are offering sweat equity shares. Everything we need to prescribe. In addition, listed companies should comply with SEBI regulations. Unlisted companies, it's sufficient if they comply with the Companies Act. And sweat equity shareholders will have same rights as if they are all other equity shareholders. Can I proceed? Other important conditions. In a year, sweat equity shares issuance is limited to 15% of paid up equity share capital or 5 crores, whichever is higher. Higher you have to remember. Existing paid up equity share capital, suppose 100 crores into 15%, that means 15 crores, or limit 5 crores, whichever is higher means 5 crores. But during the lifetime of the company, total sweat equity shares shall not exceed 25% of other equity share capital. Other equity share capital, 100 crores. That means throughout the lifetime of the company, it should not exceed 25 crores. Suppose if I increase other equity share capital, if I double it, I can also double sweat equity shares. By offering 100 crores worth of securities to the public through prospectus or to the identified persons through private placement, here what I can do, here I can also increase sweat equity share issuance. I can increase issuance of sweat equity shares. So you just remember three limits: 15% in a year or 5 crores, whichever is higher. Lifetime of the company 25% or 25% only. But for startup companies up to 10 years. How many years? Up to 10 years. The limit is not 15, the limit is not 25, the limit is 50%. And one more important condition: once allotment completes 3 years from the date of allotment, sweat equity shareholders are not allowed to transfer them. 3 years lock-in period. Next one, the asset we are getting from employee or the shares we are giving to the employee, both should be valued by a registered valuer and based on accounting treatment shall be done. Disclosures in the board report. Next one, disclosures in the register. These are common things. Disclosures, common things. Disclosure in board report, disclosure in registers. Next one, treatment for non-cash consideration. If we are getting depreciable asset, amortizable asset, record the value in the balance sheet as per accounting standards and registered valuer report. Sir, we are getting nothing, sir. Then treat it as an expenditure, charge it to the profit and loss account under employee benefit expenses. Next one, definition of employee. I told you, permanent employee, director, whether whole time or not, whether they are working in India or outside India, whether they may work in our company or our holding company or our subsidiary company. Next one, section 55. Section 55, issue and redemption of preference shares. Issue 4 conditions, remember. Redemption also 4 conditions, remember. Deemed redemption 3 conditions. Total in this section 11 points you have to remember. What are those 11 points? Issue of preference shares requires AOA authorization compulsory. AOA authorization compulsory. Issue shall be authorized by special resolution in general meeting. That means AOA authorization plus special resolution. Third condition is at the time of issue of preference shares, company shall not commit. That means company shall not have subsisting defaults. With respect to what? Preference shares only. With respect to preference shares, how many defaults are there with respect to preference shares? 2. One is dividend default, other one is capital default. So company shall not possess these defaults at the time of issuing preference shares. Next, can a company issue redeemable preference shares? No, only redeemable. And what would be the tenure? Max 20. For infra companies, up to 30, provided 21st year onwards, every year 10% they need to redeem. So 21st year onwards, every year 10% means by the end of 30th year, it becomes 0. Clear? 4 conditions for issue. Come on, tell me, what are the 4 conditions for issue? AOA, special resolution, no subsisting default, max tenure 20 years. For infra, 30 years, redemption from 21st year onwards, 10% per year. 4 conditions. Next, for redemption also 4 conditions. One is shares should be fully paid up. Before redemption, shares should be fully paid up. Next condition is about sources. So here redemption value will have 2 figures. One is face value or nominal value. Other one is a premium on redemption. I repeat, redemption value includes premium on redemption. So with respect to face value, you can utilize 2 sources. One is issue proceeds, or you can utilize company profits, free reserves. If you select free reserves, then CRR shall be created. How much amount I should transfer to CRR? The amount of the nominal value of shares so redeemed. Nominal value. I'm not talking about issue value, redemption value. I'm talking about nominal value of shares so redeemed shall be transferred to CRR account. Next one, sir, for premium on redemption, sir. For premium on redemption, you are having either one resource or 2 resources. It depends upon your company nature. Suppose if you are a section 133 company, for you only free reserves are allowed for premium on redemption. No sir, all other companies, sir, then for you free reserves or securities premium. So first I utilize securities premium for premium on utilization of first I utilize securities premium. First I utilize securities premium for premium on redemption. Getting my point? Order of utilization of free reserves. First priority shall be given to premium on redemption. Second priority I will give to nominal value. Unable to redeem, three conditions to be kept in mind. Unable to redeem, three conditions to be kept in mind. So first of all, let's see redemption. In redemption I told you four conditions, right? One is fully paid shares. Second one is sources for nominal value. Third one is sources for premium on redemption. And fourth one is CRR account, transferring to CRR account. And there is one more condition that is there in section 64. What is section 64? Communication with ROC. There or not there? There. Whenever company redeems preference shares, it has to communicate the same with ROC along with the altered MOA if required. Can I? Next one. Unable to redeem, three conditions. What are those three conditions? First, take approval from the existing preference shareholders. How much consent, sir? 3/4 in value consent. Sir, then can I redeem them, sir? No. Can I redeem them by issuing new shares in the place of old shares? No. Go to authority called NCLT. Take NCLT approval. NCLT gives approval only if company redeems dissenting shareholders. Only after redemption of dissenting shareholders, NCLT gives approval. So how many conditions? Three. One is 3/4 value consent. Dissenting shareholders shall be redeemed immediately, NCLT approval. Then what can I do? I can issue new preference shares in the place of old preference shares, covering not only capital amount but also outstanding dividends. Because of this, capital increase provisions, capital reduced provisions applicable or not applicable? Or not applicable. Suppose if reduction of capital applies, section 66 comes into the picture. In section 66 you will find NCLT only. Here also NCLT is there. Why again applying two sections in the given situation? Unnecessary. Already NCLT is there, no? So do no need to apply section 66 here. Can I? We completed 55. Next 56. What is 56? Transfer, transmission. Let's see the difference. Transfer is a voluntary act between two persons. One is transferor, other is transferee. Transmission is an operation of law act. It's an act of operation of law where a member got deceased, so his legal heir is becoming a member. Or a member become insolvent, official assignee is getting all the shares from the insolvent person. So transmission comes under operation of law. Transfer is a voluntary act. For transfer, certain preconditions to be satisfied. What are those conditions? First one, instrument of transfer, that is transfer deed, is required. It should be dated and it should be signed. It should be duly stamped, dated and executed. Executed means signed by both transferor and transferee. Include complete details about transferee. Like the details you can see in MOA, same details you can see in a transfer deed regarding transferee. And this transfer deed shall be submitted, shall be delivered to the company within how many days? 60 days of execution. Or else they need to submit indemnity bond. They need to submit indemnity bond. Getting my point? So along with the transfer deed, original share certificate or letter of allotment shall be submitted to the company. Who submit these documents to the company? Either transferor or transferee in case of transfer. In case of transmission, person intimating transmission will file application with the company. Now this transfer deed is not required in two cases. One is government company security is not required. Second one is depository security is also not required. Third case, transmission case also not required. In transmission, tell me, transfer deed required or not required or not required? Depository securities, securities in demat form, transfer deed required or not required or not required? Next one, government securities, certain transfers in government companies, bonds issued by the government company, transferee needs to inform company along with the bond certificate. So here also transfer deed not required. Next one, if instrument of transfer is lost, if instrument of transfer is lost or original share certificate is lost, then, or if it is not delivered, if instrument is lost or not delivered within 60 days, board may register transfer subject to indemnity. Can I proceed? Board may register the transfer on the terms of indemnity. next important point, this can be tested. The point is, in a transfer situation, shares are partly paid up and application is filed by transferor alone. If application is executed by transferor alone and if shares involved are partly paid up, then company shall not register transfer unless it gets no objection from transferee. For that, how many weeks company should wait? Company should wait for 2 weeks after giving intimation to transferee. Within 2 weeks, if there is no response or if there is no objection from transferee, then company can proceed with registration of transfer of partly paid up shares. Okay, now for transmission, I told you transfer deed required or not required? Very simple. Transmission, transfer deed required or not required? Consideration required or not required? Stamp duty required or not required? Execution by both transfer or transferee required or not required? Everything not required, just intimation is required. And for filing that intimation also, there is no time limit. For transfer case, intimation should be done within 60 days of execution of transfer deed. For transmission, there is no time limit. And once company receives any documents with respect to transfer, then company has to deliver the security within how many months? 1 month. Clear? In case of incorporation, subscribers should get certificate within 2 months. That means company should deliver certificate within 2 months. In case of allotment, company should deliver certificates within 2 months. In case of allotment of debentures, company should deliver the security within 6 months of allotment. But above all cases, for IFSC companies, it is 60 days only. For demat form of securities, immediately they happens. Time limits are not applicable immediately. It's like Google Pay, Phone Pay transaction. If I make payment today, you'll get amount today itself. You won't get money tomorrow or day after tomorrow or after 1 month. Getting my point? Everyone. Next one. In case of transmission, I repeat, in case of transmission, the legal representative of a deceased member will have 2 options. How many options he will have? 2 options. Option 1, either he can register shares in his name. Option 2, he can directly transfer security to the outsider. If he avail option 1, intimation of transmission is required. If he avail option 2, then transfer deed is required. Signed by whom? Legal representative. Company assumes it is a valid signature only. Company assumes it's a valid transfer deed only. Everyone getting my point? Everyone. So a legal representative can transfer a deceased person's securities or interest without being holder of those securities as long as transfer is properly executed. Default in compliance, penalty. What is the penalty? 50,000 rupees. These penalties when companies, when comes, failure to deliver within 2 months of incorporation, within 2 months of allotment, within 1 month of delivery of documents for registration of transfer or transmission, within 6 months of allotment of debenture. This is one case. Suppose transfer deed is improperly executed. It was not dated, it was not stamped, or company didn't receive that instrument of transfer within 60 days of execution, but still company negligently registering the transfer, then company and officer in default will get a punishment of 50,000. Everyone. In case of fraud, 447 comes into the picture. Money in bank account is also not safe. If you observe, if someone hack your account, if someone easily utilize money balance without your permission, also money in your account gets lost. Similarly, demat form also, if the depository is not providing services in a secured manner, someone can easily stole those securities. How? They will make count 0 in your account. They will make enter count in their personal account. Cyber hacking. So if depository is negligent, depository gets punishment under section 447. In case of forged transfer, you have to remember rights available to the original shareholder, rights available to the company, rights available to the innocent buyer. Simply remedies. Observe carefully. Forged transfer means it's a transfer where transfer signature got forged. If shares are still lying with forged transferee, then shares will be restored to transferor. Membership details are updated to transferor. Membership details are updated with transferor details. and what are all the benefits company paid to the forged transferee, company has to pay those benefits to transferor and company will claim those benefits from transferee. To avoid confusion, let's take three parties. O is a original shareholder, F is a fraud person, I is a innocent buyer, C Limited is a company. The transfer happened between OF is forged transfer. If shares are still lying with F, whenever original shareholder approaches company, company has to restore the membership of O. Company has to return the benefits that are paid to F to O. Next one, company will recover all the losses from F. Suppose F already transferred shares to I, who is an innocent buyer. In this case also, C Limited should take back shares from I and C Limited should give shares to O. Whatever loss happens to I, C Limited should compensate I. And C Limited can recover all those losses, damages from F. That is the concept of forged transfer. Nothing beyond that. For demat form of securities, these kind of things will not happen because shares are in electronic mode. Punishment for personation of shareholder. A person is changing his identity as if he is a original member of the company. He is not a member, but he is pretending to be a member of the company. Why he is doing that? In order to obtain or attempts to obtain security or interest. Security in case of company with share capital, interest in case of company without share capital, or any share warrants or any dividend coupons. Forgot to tell you, in case of transfer also, if you observe what can be transferred, first thing, who can transfer? I told you everything. What can be transferred in case of transfer? Securities of a company with share capital, interest of a company without a share capital. What can be transferred? Not that much important, but for transfer, what procedures to be followed, that is important. That's what second point is very important. Next, looking at punishment for personation of shareholder. Any person pretending himself as a member of company in order to obtain or attempts to obtain security or interest, receives or attempts to receive any money due to the rightful owner, then that person will get punishment. What is the punishment? Imprisonment 1 to 3 years and fine 1 lakh to 5 lakhs. So this concept is all about pretending himself as member of the company. Why is pretending himself as member of the company? To get benefits, either security or any money due. Next one, refusal of registration and appeal against refusal. Refusal of registration. Yes, company is having a right to refuse transfer of securities, but company can exercise that right only for genuine reasons. In case of non-genuine reasons, in case of other than genuine reasons, aggrieved party is having a right to file a petition with NCLT. Definitely here aggrieved party will be transferee only. Why? Transferee already paid consideration to transferor. Two parties, transferor, transferee. Transferee paid consideration to transferor. That's why transferor issued shares and transferor also signed a transfer deed. Once transferee receives these documents, transferee submitted these documents to the company C Limited for registration of transfer. Now C Limited is not registering the transfer. In that case, you need to find out the duties of company, the duties of the rights of the transferee. I repeat, duties of company, rights of transferee. Duties of company, company should give notice of refusal to the affected parties. Rights of transferee, first of all, notice of refusal within how many days? Within 30 days of delivery of documents. Within 30 days of delivery of documents for registration of transfer, company has to give notice of refusal. Whether it is a private company, a public company, 30 days is common. But from transferee point of view, if he belongs private company, if shares are involved in private company, shares are related to private company, then transferee should file a petition with NCLT within how many days? Within 30 days of notice of refusal. Within 30 days of notice of refusal. Sir, there is no notice of refusal, sir. Then within 60 days of delivery of transfer instrument. Within 60 days of delivery of transfer instrument. What he have to do? What he has to do? He has to file an appeal with NCLT. Suppose if the transferee and the shares involved belong to public company, then for filing appeal the time limit is 60 days of notice of refusal. If no notice of refusal, then 90 days of delivery of documents with a company for registration of transfer. So simple terms ma notice of refusal 30 days time limit. For private, for public, notice of refusal time limit is 30. No notice of refusal, it's not no notice of refusal. Now once notice of refusal has been received by the person, then for filing appeal, in case of private limited 30 days time limit is there, in case of public limited 60 days time limit is there. Suppose if there is no notice of refusal, in that case within 60 days of delivery of documents in case of private company, within 90 days of delivery of documents in case of a public company, they should file appeal with NCLT. Now NCLT is having power to pass any of the two orders. One is dismiss, other one is order. Order transfer transmission to be registered in 10 days. Direct rectification and pay damages to the aggrieved party. Non-compliance, defaulting person, imprisonment 1 to 3 years, fine 1 lakh to 3 lakhs. 5 lakhs. So section 58, once again let's look into the synopsis. Section 58, just once we'll see the summary of section 58 in the chart wise. Company has to give notice of refusal to the transfer or transferee, a person giving intimation for transmission within 30 days. Now transferee or a person intimating transmission can file appeal with NCLT within prescribed time limits. What are those time limits? If he receive notice of refusal within 30 days in case of private company, within 60 days in case of a public company. If no notice of refusal, within 60 days of delivery of documents for registration of transmission in case of private company, within 90 days of delivery of documents for registration of transfer in case of public company. NCLT either dismiss or order for registration of transfer. Now company shall comply with NCLT order within how many days? 10 days. Contravention, imprisonment 1 to 3 years, fine 1 to 5 lakhs. Next one, section 59, also small section in handwritten notes. Let's see here. Aggrieved person, member company. First of all, section 59, what is the main theme of section 59? I'm not the member of a company, but my name is wrongly entered in the register, or I'm the member but my name is omitted from the register, or company is making unnecessary delay in recording my name in the register of members. If I'm an Indian member, then I can go to NCLT. If I'm a foreign member, then I'll go to competent court specified by authority. So in this case, NCLT will have a power to either dismiss the appeal or order for rectification of register of members. So if NCLT passes an order for rectification of registers, yes, immediately the register shall be rectified. Next one, NCLT can also pass an order restricting the rights of transferee. Unless NCLT passes an order with respect to restriction of transferee rights, transferee can exercise all voting rights in the general meetings, in the members meetings. That is all about section 59. Clear everyone? 58, 59 are interconnected. 58 is all about refusal to register. 59 is all about rectification in the register. Both cases aggrieved party will go to NCLT. NCLT is having power to either pass either order for rectification or dismiss the appeal. That's it. Next one, authorized capital, called up capital, not that much important. Alteration of share capital. Alteration of share capital. 3 conditions to be satisfied for alteration of capital. What are those 3 conditions? AOA, ordinary resolution in general meeting, filing with ROC. I repeat, how many conditions a company should satisfy for alteration of share capital? AOA authorization required, ordinary resolution at general meeting is required. Once alteration is done, file copy of altered MOA with ordinary resolution with ROC. File altered copy of MOA and ordinary resolution with ROC. Now in how many ways I can alter capital clause? In 5 ways. First one is increase capital, last one is reduce capital. That means cancellation of what type of shares? Unsubscribed shares. Second one is consolidate and divide share capital into the shares of larger amount or subdivide the shares into smaller amounts. In second case, 10 rupee face value shares may be converted into 100 rupee face value by consolidating 10 shares. In case D, you can see 10 rupee face value shares can be split into 5 shares with face value of 2 rupees each. But in case 2, because of consolidation, if there is a change in voting powers, it requires prior permission of NCLT. And case D, in case of split, in which proportion you are reducing, in which ratio you are splitting face value, in the same ratio you need to split paid up value also. 1 share into 2 shares, then paid up value also 2 parts, 2 equal parts. And last one is conversion of shares into stock, reconversion of stock into shares. Here a question can be asked like this: can a company issue stock directly? No, company can issue only shares first. And a member can request company to convert shares into stock, but that request is with respect to only fully paid up shares, not partly paid up, fully paid up shares. Stock is bundle of shares. Stock is transferable even in fractions, whereas shares are transferable only in number 1, 2, 3, like this only. So tell me, alteration of capital, how many conditions company should satisfy? 3. What are those 3 conditions? AOA authorization, members approval. What kind of approval? OR. Last one, intimation with ROC. Clear, everyone? So next section is section 62, that is further issue of share capital and preferential allotment. Section 62. Just remember the order. Whenever company is making issue of shares, obviously it comes under further issue only. Why? Initial issue happens at the time of incorporation. This is further issue. First priority shall be always given to the existing members. That's why we call it as rights issue. It's a right of a member to subscribe additional share whenever company is planning to offer securities. Whenever company is planning to offer shares. Whenever company is planning to offer shares, it is the right of existing member to subscribe additional share. So this will be on proportionate basis. Like for every 5 shares you are holding, you will be given additional share of 1. Next one, before making rights offer, company should satisfy certain conditions. What are those conditions? Letter of offer. They should prepare a document called letter of offer. It contains details. And for issuing letter of offer, board resolution is sufficient. Ordinary resolution, special resolution, not at all required. Let me repeat. For making offer to the existing members, board resolution is sufficient. Members approval is not required. And that letter of offer shall be dispatched at least 3 days before opening of subscription list. And that subscription period should be minimum 7 days, maximum 30 days. That subscription period, that offer period should be minimum 7 days, maximum 30 days. During this period only, an interested person will file an application for additional share. And of course, this 3 days time limit for dispatch of notices, this 7 days offer period can be reduced only in private companies with a 90% consent of the members. With 90% members consent only, it can be reduced in case of private companies and IFSC companies, IFSC public companies. Clear? Unless AOA prohibits, renunciation default option is available. By default, they can renounce these rights in favor of their neighbors, their friends. Next one, yes, company can also offer shares to the employees, but for this special resolution is required. If it is a private company without default in 92-137, section 92 annual returns, section 137 financial statements, then such private companies ordinary resolution is sufficient. Even for IFSC public companies also ordinary resolution is sufficient. So a private company with the defaults and all public companies require special resolution for offering shares to employees. Next one, apart from existing members, employees, if you want you can go with others. Others means not existing, not employees. For that, 2 conditions to be satisfied: special resolution, valuation report. Special resolution 1 condition, valuation report 2nd condition. Valuation report is for fixing issue price And if you are getting any non-cash consideration, like amalgamation, merger, if you observe, so in the process of amalgamation, if purchasing company is issuing shares, so what is the worth of selling company? For that also registered valuer report is compulsory. But if you observe carefully, special resolution is not required if company is issuing equity shares to two persons. Who are those two persons? Convertible debenture holders, convertible preference shareholders. At the time of conversion, special resolution is not required, because special resolution is already passed at the time of issue of convertible debentures, issue of convertible preference shares. Next one, when there is a government order, when there is a CG order converting debentures into loans, converting debentures into equity, or converting loans into equity. Which debenture, which loan? Debentures previously issued to the government, loans previously obtained from the government. So if government decides to convert them into equity, government by passing an order converts debt into equity. But before passing an order, government considers public interest, financial position of the company, terms and conditions of the issue. So if company is not interested with government order, company can file an appeal with NCLT order within 60 days of CG order, and government order is said to be in force if NCLT dismiss the appeal, and government order is sufficient to increase authorized share capital automatically. Suppose my authorized share capital is 10 crores, my paid up share capital is also 10 crores. Now CG ordered to convert 4 crores debt into equity. If you observe the situation, authorized share capital was fully utilized. Now only by increasing authorized share capital we can convert this. But the answer is no need to increase this under section 61. CG order under section 62 is equal to deemed increase of authorized share capital to the extent of those 4 crores. Clear? So 10 plus 4, 14 crores. Just look at the material. So offer of shares is made to the existing equity shareholders in a ratio to the paid up capital on the shares held by them as on offer date, to the employees under ESOP. But for ESOPs, yes, what conditions company should satisfy? Special resolution. Whereas for two companies, private companies which has not committed 92-137 defaults, for them ordinary resolution is sufficient. For IFSC public company also ordinary resolution is sufficient. And for listed company, SEBI regulations are additionally applicable. Next, any other person authorized by a special resolution, shares can be issued even to those not covered under the above two categories. But for that, special resolution is compulsory, valuation report is also compulsory. Letter of offer. In letter of offer, you have to remember only two time limits. One is when we have to dispatch letter of offer. We have to dispatch letter of offer at least 3 days. Where is that condition? At least 3 days before issue opens. And that letter can be dispatched through registered post, speed post, electronic mode, courier, or any other mode. And offer period should be minimum of how many days? Minimum 7 days. Sir, here it is at least 15 days. No sir, as per rules this 15 days got reduced to 7 days. So minimum 7 days. Offer period cannot be less than 7 days, and it cannot be more than 30 days. And that letter of offer should also contain additional statements stating that if offer is not accepted within the specified time, we assume that they declined the offer. And all those remaining unsubscribed shares, board of directors can issue them in a manner not disadvantageous to the company, not disadvantageous to the shareholders. Clear? Everyone. Next. When determining the proportion of shares to be offered, the allocation shall be as fair as possible under the circumstances. Ratio, equal ratio. If you are holding 10 shares, if I am telling that one share will be given as right shares, some other holding 100 shares, they will get 10 shares. If some other holding 1000 shares, they will get 100 shares. But the point is, I told you 90% consent of the members. In case of private to public companies, yes sir, that period 7 days, the period 3 days can be reduced. Okay na? Exceptions important part. In section 62, exception is important part. And many do not think about the condition. Many think that conversion of debt into equity means they think about all debentures, but it's not all debentures. Debentures issued to the government, loan obtained from the government, only those loans, only those debentures will be converted into equity based on CG order. Clear? And what is the time limit for filing appeal with tribunal? 60 days. Tribunal will hear both the parties and pass an appropriate order. Okay. Next one, issue of bonus shares. Issue of bonus shares. One important condition in issue of bonus shares is bonus shares can't be issued in lieu of dividends. Bonus shares can't be issued in lieu of dividends. And remaining important conditions. First important one is sources. Tell me how many sources I'm having for bonus issue? 3. What are those 3 sources? CRR, securities premium, free reserves. And other conditions, AOA authorization required. Can a company utilize revaluation reserve for issuing bonus shares? No. In one attempt, question came like this. The question is, paid up share capital is 30 crores, reserves and surplus 40 crores. In this revaluation reserve amount is 10 crores. In this revaluation reserve amount is 10 crores. Now company is planning to offer bonus shares in the ratio 1:1. Whether adequate source available or not for making bonus issue, whether adequate source available or not. For that you have to check that total reserves 40. In that you need to exclude revaluation reserve. That means you need to exclude 10 crores. So total reserves, free reserves is 30. Either free reserves or securities premium, whatever it may be, total reserve balance is 30. Paid up share capital is 30. So if you observe the ratio, it is equal. That means yes, company can issue bonus shares in the ratio 1:1. Clear? So revaluation reserves are strictly prohibited. It will not act as a source. Next one, issue should be authorized by ordinary resolution in the general meeting. AOA condition. Second condition, what is the second condition? Ordinary resolution at general meeting. And third condition, company must not have defaulted on deposits, debentures. Deposits, debentures means 2, including interest on deposits, interest on debentures. Next one, employee statutory dues. Okay, now can a company issue partly paid up shares as bonus issue? No. Bonus issue completely fully paid up. And who is entitled to receive bonus shares? A person holding a fully paid up shares. Company can't issue partly paid up shares, and a person holding partly paid up shares can't receive bonus shares. So both should be fully paid up. Okay, na? So question will be tested only based on sources of funds. So far 3 times question came on source of funds. So they will ask you which sources are eligible, which sources are not eligible, and they will also ask you to fix the ratio, like 1:2 possible or 1:1 possible or 2:3 possible, or like that they can ask you. Next one, and if they want to make a question tough, what they will do, they will tell like this: C Limited is a company which has defaulted payment of interest on deposits. It made a default of interest on deposits payment last month, and the default is still continuing on. Current month, member asked board of directors about bonus issue. Board of directors passed board resolution to issue shares at free of cost. That means bonus issue. And members also passed ordinary resolution for bonus issue. So is company eligible to offer bonus shares? Answer is no. Why? Keeping interest on deposits default, how a company can issue bonus shares? Like that you need to write an answer. So defaults also important. What are the defaults? Interest on deposits, deposits. Interest on debentures, debentures. Next one, employee statutory dues. Next one, 64. On happening of any one of these 3 events, on happening of any one of those 3 events, company has to communicate the matter with ROC. Sir, what are those events, sir? Alteration of capital 61, redemption of preference shares 55, central government order to convert debt into equity. In these 3 cases, company has to communicate with ROC in which form? SH7. Within how many days? within 30 days. Within 30 days of event, company has to communicate with ROC. Or else punishment. What is the punishment? For company, 500 per day during such default continues up to 5 lakhs. For officer in default, 500 per day, but maximum limit is 1 lakh. Clear? Everyone? 64 completed. So next section is section 66, reduction of share capital. In how many ways reduction of share capital happens? In 3 ways. One is cancellation of uncalled capital. One way is cancellation of uncalled capital. Here, face value is 10 rupee, paid up value is 8 rupee. If I am cancelling this uncalled, that means if I am reducing face value to 8, paid up value already 8, member liability gets extinguished. This is one way of reduction of capital. So here compulsory I should alter MOA. Second way of alteration of capital is cancellation of unrepresented capital. Suppose if you look at the balance sheet, yes, paid up share capital is 10 crores, outstanding liabilities 20 crores, fixed assets are 10 crores, current assets 12 crores, and profit and loss account debit balance 8 crores. So if you observe, to this 20 crores, if you settle fixed assets and current assets some portion, remaining current assets is 2 crores and P&L debit balance is 8 crores, which is equal to paid up share capital. Okay, if you observe this balance sheet, it is very clear. 80% of paid up share capital of the company is not available in the form of real assets. It is available in the form of fictitious assets like profit and loss debit balance. Getting my point carefully? Now, whatever capital is lost because of accumulated losses, if I cancel that lost capital, it is also called reduction of share capital. And the last way is pay off any excess paid up capital. Suppose face value is 10 rupee, paid up value is also 10 rupee, and company is having a 2 rupee per share extra. Company doesn't want these funds. Now, if company wants, company can return this 2 rupee per share to the member. In that case, face value, imagine face value is 10, paid up value is becoming 8. There would be no reduction of members' liability. But if company is reducing face value to 8, revised paid up value 8, revised face value 8, revised paid up value 8, now member liability is getting extinguished. Getting my point? First, you need to understand in how many ways reduction of capital comes into the picture. One way is cancellation of uncalled capital. Second way is cancellation of unrepresented capital. Third way is return of excess paid up capital, and next cancellation of that portion. In these 3 ways, reduction of capital comes into the picture. But the point is, in this case, creditors, outsiders, debenture holders, creditors' interest gets affected because of reduction of capital. Yes or no? How? Just look into the balance sheet of a company. Suppose paid up share capital is 20 crores, outstanding liabilities is 20 crores, fixed assets 15 crores, current assets 25 crores, balance sheet tallied, no problem. In this situation, there is no problem at all. Outstanding creditors, there is no problem. For them, assets are available. For them, equity shareholders are also there. So their interest is not getting affected. Imagine face value per share is 10. Paid up value is 8. That means paid up share capital is 16 crores. 16 crores. 2 crore shares into 8 rupees. Paid up capital is 16 crores. Outstanding liabilities 20 crores. Fixed assets, for example, 10 crores. Current assets, for example, 20 crores. How much? 20. Just small modification. So now balance sheet liability side 36 crores. Asset side P&L debit balance, how much it is? 6 crores. So total 36 crores. Here also there is no problem to the outstanding liabilities. There is no problem to the outstanding creditors because assets are sufficient to discharge their liabilities. Let us take one more situation to understand the real sense. Balance sheet of a company, paid up share capital 8 crores, 1 crore shares into paid up value 8 rupee. Whereas face value is 10 rupee. Outstanding liabilities 10 crores. Fixed assets realizable value, current assets realizable value 8 crores. P&L debit balance 10 crores. So total it would be 18 crores. Clear? Now if this company enters into the liquidation, what happens? Existing assets are not sufficient to discharge existing liabilities. In that case, official liquidator will make a call amount. That call amount is, contribution amount, 2 per share. 2 into 1 crore, it would be 2 crores, sufficient to discharge outstanding creditors. But members intentionally they are planning to reduce face value 10 to 8. Before that, before going into liquidation, members made a plan stating that face value 10, paid up value 8. That's why we are getting a liability of 2. Let's reduce face value to 8. So 8 minus 8, it would be 0. So tomorrow no one can call for 2 rupees. No one can ask us to contribute 2 rupees. So in this way we can protect our 2 crores losses, excess losses. But if this thing happens, what happens? 8 crores not sufficient to settle 10 crores. Finally creditors will be at loss of 2 crores. So to protect the creditors and to check whether reduction is genuine or not, whether it is fair or not, an independent authority comes into the picture, and an independent authority verifies completely, thoroughly. That independent authority is nothing but NCLT, none other than NCLT. So here, company limited by shares, company limited by guarantee with share capital have to file an application with NCLT. Along with application, they need to submit the documents, special resolution, minutes of the meeting, list of the creditors, including nature of the creditors, secured, unsecured, contingent, actual liability, everything they need to mention. Next one, auditor certificate for accounting treatment. With respect to reduction of capital, whatever treatment happened into the books of accounts, is it as per accounting standards or not? Who should check? Auditor. And auditor should give a certificate. Now NCLT, after getting this application, NCLT forwards that application to 4 departments. One is regional director, ROC, SEBI in case of listed companies, and creditors. And NCLT wait for 3 months. NCLT wait for 3 months. Within 3 months, if these people make any representations, if these people make any objections, then NCLT will ask company to clear all those objections. Suppose within 3 months there is no objection from this fellow sir. Now NCLT observes whether creditor dues have been discharged or determined, secured, and finally consented or not. If these 2 conditions are satisfied, creditors consent is there, auditor certificate is there, then NCLT passes an order regarding reduction of capital. But in this entire process, this company should be free from one default. That one default is interest on deposits plus deposits. If there is any default with respect to interest on deposits or deposits, then company is prohibited from reduction of share capital under section 66. So once company receives the order, company has to publish that order in 2 newspapers, and company shall also file it with ROC within 30 days. What are the documents company should file with ROC? Certified copy of NCLT, minutes approved by the NCLT, share capital clause getting altered, right? So for that altered MOA, file altered MOA. But in that capital clause, you have to mention revised number of total number of shares, revised face value, revised paid up value. And a member is liable to the extent of difference between revised face value and revised paid up value, nothing beyond that. Next one, suppose creditor who is entitled to object reduction, if his name is excluded from the list of creditors, now that creditor can file a petition with NCLT. Clear? Now the officer who is responsible for such defaults, like officer who is misrepresenting the nature of creditor, amount of the creditor, or if he is a party to such a above concealment, then that officer will get punishment of 447. And members also get punishment, but not all members. Persons who are members at the time of registration of reduction of share capital, only those people will get the liability. What liability? Original liability. That means before reduction of capital, what is the original liability of the members? That liability gets attracted. Just look at the material ones, the points. Let's see. Ways of reduction. How many ways I can reduce the capital? In 3 ways. One is cancellation of unpaid capital, that means uncalled only. Second one is cancellation of unrepresented capital. Third one is pay off excess capital and cancelling that excess, return of capital. So for this, what approval is required? From whom we need to take approval? First from members, special resolution. Next from NCLT. Next one, for this, should I alter MOA? Yes, you are playing games with face value, you are playing games with paid up value. So if you are playing games with face value, you need to alter MOA. And I told you 61 is different from 66. Under section 61, that is alteration of capital, I will decrease share capital. I will decrease share capital. Whereas under section 66, I will reduce share capital. Sir, what is the difference? Decrease is subject to unsubscribed shares. No impact on balance sheet. No impact on balance sheet. But here reduction is all about share capital which is getting visible in the balance sheet. That means either paid up share capital or unpaid value or uncalled value. Getting my point? Next one, reduction is not allowed in one company. Which company? If company has defaulted in deposits, interest on deposits. So reduction is possible only with NCLT approval. For that, application has been filed with NCLT. NCLT forwards application to CG, ROC, SEBI, company creditors. If any of these creditors raise objection within 3 months, tribunal will consider them. If no objections, then within 3 months it is assumed that there is no objection to the reduction of the capital. Next one, order of tribunal. Once tribunal, before passing order, tribunal check 2 things. What are those 2 things? Auditor certificate with respect to accounting treatment, creditors approval. Once NCLT passes an order, it is the duty of company to file a copy of NCLT order with ROC. Along with NCLT order, you have to attach minutes stating that revised share capital, revised number of shares, revised face value, revised paid up value. And beyond that, member is not liable at all. Member's liability is revised face value minus revised paid up value. But in this entire question, this concept, this point can be tested. This point can be tested for 3 to 4 marks. What happens if creditor's name is not included in the list which company filed with NCLT? In that case, creditor can file a petition with NCLT. What NCLT can do? It will simply lift. It simply lifts reduction of capital. That means persons who are members at the time of reduction of capital will get original liability. Every person who was a member of the company at the time of registration of tribunal order shall be liable to contribute towards the debt. To what extent? To the original liability. It shall not exceed amount that would have been liable if company has been wound up immediately before the order date. Already company wound ups are no problem, even though company is not there, but we'll still find out the persons and we'll make them liable as if they are liable if company is in existence. And liability to the officers is 447, but this section is not applicable to buyback. This section is not applicable to this section is not applicable to 61 as well as 68. 61 I'm talking about unsubscribed shares. 68, here buyback, after completion of buyback, I will I will cancel the shares, and whatever amounts I used from the free reserves, I will create CRR. Since I am creating CRR in section 55 redemption of preference shares, in section 68 buyback of shares, 66 is not applicable to both the cases. Next one, 67, restrictions on purchase of its own shares. Restrictions on purchase of its own shares. No company can purchase its own shares to be held as investment in its balance sheet. Okay, na? But this rule is not applicable to 2 companies. What are those 2 companies? Nidhi company, 100% exemption. Private company also gets exemption provided 3 conditions to be satisfied. What are those 3 conditions? No other body corporate has invested in the share capital of this private company. That means if you take C Private Limited, if it wants to purchase shares from its members, in C Private Limited, open register of members. In register of members, there should be no body corporate, first thing. Second thing, total borrowings shall be less than twice of the paid up share capital or 50 crores, whichever is lower. And with respect to these borrowings, company should not commit any default. Company should not commit any default in repayment of those borrowings at the time of purchase. Next, this is all about subsection 1. Coming to next point, indirect purchase also prohibited. Indirect purchase means what? Providing financial assistance or providing guarantee, either financial assistance or guarantee or any security. It is also punishable offense. But to this rule, we had how many exceptions? 3 exceptions. One, banking company lending money in ordinary course of business allowed, no problem. Banking companies can lend money in the ordinary course of business. With that money, that person, even if he acquire banking company shares, or that banking company is holding company shares, not an issue. But that lending should be in what type? Ordinary course of business. Next one, employee share purchase scheme. So here, 3 conditions you have to keep in your mind. 3 conditions. What are the 3 conditions? Special resolution approving the scheme. Next, the scheme is for the benefit of employees. Benefit of employees. And next condition is with the amount financed, they should purchase only fully paid up shares. They should purchase either fully paid up shares, either purchase or subscribe. If these 3 conditions are satisfied, then employees share purchase scheme is allowed. Getting my point, students? Everyone, special resolution. Next one, the purchase, in case of listed companies, purchase should be through recognized stock exchanges. For unlisted companies, purchase can be done privately, but that purchase is subject to registered value or valuation report just to check independence of the price. Price is not influenced by the factors. Price is genuine price. And maximum purchase or subscription cannot exceed how much? 5% of company's paid up share capital and free reserves. Next one, company must disclose details about voting rights. Who are exercising voting rights? Employees or trustee. Those details also to be furnished for ensuring transparency, better transparency. Next one, employee loans. Employee loans. Here a small clarification I need to provide. So here employee excludes directors KMP. This is correct. This is condition 1. Condition 2, loan shall not exceed, the loan amount does not exceed 6 months employee's salary. 6 months employee's salary. Ignore this second point. Loan amount does not exceed 6 months employee's salary or wages. And loan is to enable purchase of fully paid up shares. Here also they need to add one more point. The point is, loan is for, same point here also, loan is to enable purchase or subscribe fully paid up shares. So I'll make a correction of these 2 points in the soft copy of the material. So you will get updated soft copy. Once you get printed copy, you just make corrections accordingly. Along with printed copy, I will issue a clarification sheet, some 1 or 2 pages. Next one, this section will not affect redemption of preference shares. In this entire section, this particular point is very, very important. 3 times a question came on this point. Suppose company C Limited financed its company secretary who is standing in the position of KMP in order to purchase shares of C Limited. Salary of CS is actually 70,000. Loan amount is 8 lakhs. And with the loan amount, CS acquired partly paid up shares. What type of shares? Partly paid up. Now tell me whether it is covered under exceptions or not covered under exceptions. Not covered, because 3 conditions violated. One is he is a KMP. Second one is 6 months of 70,000 means 5 lakh 60. But how much loan we gave? 8 lakhs. And with that amount, what he did? He acquired partly paid up. 3 conditions violated. Suppose if he is not a KMP and loan amount given is 4 lakhs. 4 lakhs means 7 lakhs into 70,000 into 6 means 420. But we are giving how much? 4 lakhs only. And with this 4 lakhs, he is purchasing fully paid up shares. Now there is no default at all. Covered under exception. Clear, everyone? So penalty for contravention, remember, for company 1 lakh to 25 lakhs, for officer in default imprisonment up to 3 years and fine 1 lakh to 25 lakhs. Next one is buyback of shares. Is buyback compulsory or optional? Optional. But if company decides to buy back, then it has to comply with the conditions specified under section 68. What are the conditions? First, you need to check sources. So how many sources are available to me? Two sources, internal source, external source. Internal source two types, free resources, securities premium. External source, proceeds of the issue of any shares or other specified securities. But if you utilize internal sources, nominal value of shares so bought back shall be transferred to CRR, which shall be utilized only for issuing fully paid up bonus shares. Fully paid up bonus shares. Getting my point, everyone? Next, if you select proceeds of issue, no need to create CRR because there will be no change in the capital base of the company. Capital base of the company is constant. Next one, important precaution is the shares involved in the issue, shares involved in the buyback, should they belong to same class or different class? Or different class. So cannot use proceeds from earlier issue of same kind of shares which are involved in buyback. Both should be different classes. If you are if you have decided to buy back differential rights, issue ordinary shares. If you decide to buy back ordinary shares, then issue differential rights. That's it. Next one, what are the conditions for buyback? AOA authorization. Next one, authority approval. Here authority means members, special resolution. But remember, if buyback amount involved in the buyback is less than or equal to 10% of paid up equity share capital plus free reserves plus securities premium, then no need of special resolution, board resolution is sufficient. Up to 10% of paid up equity share capital, free reserves plus securities premium, board resolution is sufficient. Any extra amount, special resolution is required. But with special resolution also, a company can make buyback of 25% of aggregate of paid up share capital plus free reserves plus securities premium. Getting my point, everyone? So these 2 points are talking about amount to be invested in buyback. Next one, post buyback, the ratio of debt to the equity must not exceed 2:1. Debt equity ratio when pre buyback or post buyback? Or post buyback. After completion of buyback, debt to equity shall not exceed 2:1. Next one, what kind of shares I can make buyback? Fully paid up shares. Fully paid up shares can be bought back. And for listed companies, follow SEBI regulations. Unlisted companies, Companies Act is sufficient. Lock-in period. Once buyback is completed, the next buyback can start only after completion of 1 year from the closure of previous buyback. So time gap between two buybacks should be minimum 1 year. So procedure for buyback, yes, if you want to take resolution from the members, you need to issue a notice calling for general meeting. Along with the notice, you need to attach an explanatory statement. In explanatory statement, you need to mention reasons for buyback, necessity of buyback, amount required for buyback, time frame to complete buyback. Getting my point? And shares involved in the buyback. All these points I need to mention. Next one, maximum 12 months time limit. Once board resolution or special resolution has been passed for buyback, within 12 months buyback should be completed. So for this, company has to prepare a letter of offer and it should be filed with ROC. It should file with ROC and issue letter of offer. Issue letter of offer to members within how many days? 30 days. First, file letter of offer with ROC. This is one point. Second one, issue letter of offer to the members within 30 days of filing with ROC. Getting my point? One point, you need to split into 2 points. One is first file it with ROC. Second, within 20 days of filing with ROC, issue letter of offer to the members. Which one comes first? ROC filing or issue to the members? ROC filing first, immediately issue to the members. Next, offer open for how many days minimum? 15, max 30. Within 15 days of closure, verification should be done. Within 7 days of verification, payment should be released. Or else within 21 days of closure, communicate about rejection. Your application has not been accepted. For you, take back your shares. So return unaccepted shares within how many days? 21 days of closure. This is simply with respect to communication of rejection. Communication of rejection shall be done within 21 days. Buyback from whom? Three options are available. One is open market, other one is on proportionate basis from all the members, or only from employees to whom we offered shares previously, either under ESOP or under sweat equity. Either of these three options you can select, and buyback should be completed only from the selected option. And before buyback, yes, it is a duty of a company, it is a duty of directors to file a declaration called declaration of solvency. So this declaration of solvency is all about two matters. One is, we have verified affairs of the company. Company will not liquidate within 1 year of buyback. Even if it gets liquidated, our assets are sufficient to discharge liabilities of the company. So it should be signed by two directors. One should be managing director. Next one, once buyback is completed, within 7 days of completion of buyback, cancel all the securities which company bought back. Cooling period on further issue. Once buyback is completed, for the next 6 months, how many months? Next 6 months. Tell me, is company permitted to make rights issue? No. Is company permitted to make private placement? Is company permitted to make public offer of same kind of shares which are involved in buyback? Tell me, same kind of shares involved in the buyback. Possible or not possible? Up to 6 months not possible. But same shares company can utilize for issuing bonus shares. Same shares company can utilize for discharge of existing obligations like conversion of warrants into shares, stock options, employee stock options, sweat equity shares, and conversion of preference shares, conversion of debentures. So for that you can utilize same kind of shares which you bought back within 6 months. Next, disclosures in the registers. Next one, filing of buyback returns with both the parties. For unlisted company, only ROC. For listed company, ROC and SEBI. Penalty for default, yes, for company 1 lakh to 3 lakhs. Officer in default 1 lakh to 3 lakhs. Okay, na? But in this entire concept, this is important point. In buyback, remember two concepts are important. One is sources for buyback. Sources for buyback. How many sources are there? Two, internal, external. Internal two, one is company profits, the other one is securities premium. External, issue proceeds of securities, but those issue proceeds of securities should be different kind compared with shares involved in the buyback. Securities, I am using word securities because it includes employee stock option, it includes sweat equity shares. So what are the situations where buyback is prohibited? Very simple to remember. Sources of finance. Just remember sources of finance. How many sources are there? 5 sources. What are they? Equity share capital, preference share capital, deposits, debentures, term loans. Equity share capital default may be non-payment of declared dividend. Preference share capital may be dividend or may be capital. Deposits may be interest or principal. For debentures, write only principal, not interest, only principal. Term loans, either interest or principal. Write all those defaults. If company has any one of these defaults, then company is prohibited from buyback. But after rectification, after completion of 3 years, after completion of 3 years of year of rectification, company can proceed with buyback. Of course, company is prohibited from buyback if it fails to comply with 92 annual return, 123, 127 dividends, 129 financial statements. Clear? Everyone? Last concept of share capital and debentures, that is debentures. In debentures, you have to remember some key points. Can a company issue debentures with voting rights? No. Can a company issue convertible debentures? Yes, with a special resolution. Are you getting my point? For issue of convertible debentures, special resolution is compulsory. Next one, how long company can use debenture funds? That means, what is the maximum redemption period? 10 years. For all companies, 10 years. Whereas for infra companies, infra debt fund companies, infra finance companies, 30 years. And there is no partial payment like 21st year onwards pay 10%. There is no such condition, which is similar to preference shares. Next one, debenture trustee appointment. But before that, limits on borrowings from debentures. Let me make this point very clear. Existing debt plus proposed NCD, non-convertible debt, less than or equal to 100% of paid up share capital plus free reserves plus securities premium, then issue of this proposed NCD means what? Non-convertible debentures. Issue of non-convertible debentures requires board resolution. Suppose if it is exceeding the limit, special resolution. If it is convertible debentures, then also special resolution. Clear? This is connected with borrowing powers of the company. Can I proceed? Debenture trustee, remember all these points. And one more point is, when debenture trustee is required, whenever company is issuing debentures to the public, or whenever company is issuing debentures to the members exceeding 500, then trustee is compulsory. Without trustee appointment, company cannot make public offer. Company cannot offer debentures to its members exceeding 500. Who can be debenture trustee? Any person other than following persons. Who are the following persons? Beneficial shareholding person. Beneficiary with respect to shares, beneficiaries are disqualified. Next one, officers of the company, simply promoter, director, KMP, officer, employee of a group companies, that means company, associate, subsidiary, holding. Next one, relative of these above people are also disqualified. Relative of above people with respect to our company, disqualified. Next one, beneficially entitled to receive payments, he is none other than creditor is disqualified. But if he is entitled to remuneration as a debenture trustee, no problem. So he should receive only remuneration from company. Apart from remuneration, any other any other receivable is there to that person is disqualified. Next one, anyone indebted to the group companies, that means debtor is disqualified. Anyone who has furnished a guarantee for the principal debt secured by the debentures, that means surety, is also disqualified, because independence gets affected. Next, a person having financial relationship with company. What kind of financial relationship? Material, that means pecuniary relationship. How much it is? 2% of the turnover or total income or 50 lakhs. Whichever is lower. Any condition is satisfied. That means any of this, suppose 2% of the turnover satisfied or 50 lakhs satisfied, that's it, disqualified. So that kind of relationship he should not possess, not only in the current financial year but also 2 immediately preceding financial years. He should not have such kind of relationship. So in case of casual vacancy of what? Debenture trustee. Who appoints casual vacancy of debenture trustee? Board of directors. But if that casual vacancy arises due to resignation, then majority of debenture holders must give consent for filling casual vacancy. Next one, a trustee can be removed with the consent of how many debenture holders? 3/4 of the debenture capital holders. Debenture trustee must protect the interests of the debenture holders and can convene the meetings whenever required, or when there is a requisition from at least 1/10 of the value of the holders. Next. So next important condition in debentures is all about reserves, debenture redemption reserve. And what is the limit? 10%. It is applicable to unlisted companies where those debentures are issued, either publicly placed debentures or privately placed debentures. And creation of reserve alone is not sufficient. They need to invest that funds in the liquid securities. And how much they should invest? 15% they should invest. 15% of what? 15% of the debentures maturing during the financial year ending on the 31st March of the next year. So liquidity, to overcome liquidity problems, yes, they should make investment in the following securities. That means deposits with scheduled bank, unencumbered securities. And next one, these investments shall be utilized only for one purpose. What is that one purpose? Securing, these investments are used only for one purpose. What one purpose? Repayment of debentures, redemption of debentures. And whenever the limit falls below 15%, necessary measures should be taken to increase it to the 15%. And for partly convertible debentures, reserve investment portion is not required with respect to convertible portion. It is required only for non-convertible portion. Clear? With this, share capital and debentures completed. Let's continue revision with the next chapter, acceptance of deposits, section 73 to 76. In this chapter, the expected questions or repetitively asked questions are amounts not considered as deposits. Amounts not considered as deposits. Next one, relaxation to private companies from complying section 73, as well as limits to what extent they can accept deposits. And for few private companies, there is no limit at all, like startup private companies or a private company which satisfy 3 conditions. For them, limit is not applicable. And next one, what is an eligible company? To what extent it can accept deposits from public, from members. And last, punishment for default. So these are the expected questions from this chapter. So here you can see term deposit. Deposit means any money received by a company as a deposit, loan in any other form except amounts excluded by the rules set in consultation with Reserve Bank of India. So only with the consultation of RBI, CG will mention, CG Government of India mentions amounts not to be treated as deposit. Until then, all loans, all deposits are deposits. First of all, what are the exempted deposits or what are the amounts not considered as deposits? Let's see. So to remember this, I had one chart. So just I'll go through the chart. Following amounts are not considered as deposits even though company receive in the form of loans, in the form of deposits. First one, if you are receiving amounts from these parties, it is not a deposit. Who are the parties? Government, CG, SG, local authority. Foreign sources, foreign government, foreign banks, foreign multilateral financial institutions, foreign credit agencies, etc. from foreign. Next, financial institutions like LIC, public financial institutions, banks, SBI, S Bank, Canara Bank, Bank of Baroda, all these from banks. If you are getting money, it is also not treated as deposit. Intercompany deposits. If one company is giving loan to another company, this is just a loan, this is not a deposit. And amount is received from these companies, AIF, REIT, IIT, venture capital funds, mutual funds, they are also not considered as deposits. So these are from receiving point of view. If you receive amount from these persons, not a deposit. Next one, if you are falling in this category, then also it is not a deposit. So here I'm talking about recipient point of view. Nidhi company, any advances received from members, any deposit received from members, it is not a deposit. Chit fund company, trust, collective investment scheme. But coming to trust, the amount they received, it should be non-interest bearing deposit. Non-interest bearing, that means company should not pay any interest on the amount which it is holding as a trustee. Next one, by issuing these securities, if company is getting loan amount, then that loan amount is not treated as deposit. First one, commercial papers, security application money pending for allotment. Pending for allotment up to 60 days is not a deposit. After 60 days, if you refund within 15 days, then also not a deposit. But if you fail to refund within 15 days, after expiry of 60 days, it becomes a deposit. Sir, I'm not refunding that amount, I'll make adjustment against some other due, sir. Adjustment is not treated as refund, therefore it becomes deposit. You have to refund them. Next one, secured debentures not a deposit, convertible debentures not a deposit, listed debentures also not a deposit. Amount raised by issuing these 3 types of securities, not a deposit. Amount raised through issue of convertible note, which will be converted within 10 years of issue, and through issue of this note, if company is receiving 25 lakhs or more under a single transaction. Next, if that company is a startup company, if all these conditions are satisfied, then also it is not a deposit. First of all, I am talking about startup. Security, convertible note. When it should be converted? Within 10 years. How much amount to be received? In excess or equal to. That means at least 25 lakhs under single tranche. Next one, if amount is received from these 3 persons, then also not a deposit. Who are the 3 persons? Employees not exceeding annual salary. Employees not exceeding annual salary as a deposit, plus company should not pay any interest on the deposit. Suppose if company is paying interest, or if company is accepting 12 months instead of 12 months, if company is accepting 14 months salary as a deposit, then it becomes deposit as per this chapter. So 12 months salary, no interest on the deposit. Directors, private company can take loans from directors including relatives of the directors, whereas public companies can take loans only from the directors, and that loan is not considered as deposit only if it is supported with a declaration. This declaration is stating that, no, in the declaration the lender has to state that the amount lent to the company is not out of borrowed funds but out of savings. Promoter is giving loan to the company if that loan is unsecured loan, and if that loan is given because of stipulation imposed by financial institution, then also promoter loan is not treated as deposit. Until when promoter loan is not treated as deposit? Until lending financial institution loan gets repaid. Once loan gets repaid, then promoter loan becomes deposit. Next, business advances. All trade advances which should be adjusted within 365 days, not a deposit. Advance for immovable property, not a deposit. Security deposit for services, for goods, not a deposit. Next one, long-term project advances, not a deposit. Advances against annual maintenance contracts, not a deposit. Advances with the sectoral regulators. For sectoral regulator companies, it is also not a deposit. Advances for subscription for publication in media, that is also not a deposit. So very important, first three they will not ask. They will particularly ask the seventh point. Particularly they will ask seventh point. When share application money is treated as deposit, if not refunded within 15 days after expiry of 60 days. Even if it is adjusted with some other lawful use, it is also treated as a deposit. Loan from director, when it is not a deposit, that loan should be taken from director in case of companies, or from relatives in case of private companies, supported with a declaration, then only not a deposit. Next one, this can be tested for 2 marks. Secure debenture, not a deposit. Convertible debenture, not a deposit. Non-convertible securities listed on recognized stock exchange, not a deposit. Next one, this one also can be tested. This one also can be tested. Maximum amount shall not exceed annual salary. If it exceeds, what happens? It becomes a deposit. Next one, non-interest bearing security deposit. So far, these points never tested. Chance is there. Chance is there. These points can also be tested. Simply, they will illustrate a situation and they will ask you, write the definition of deposit and identify out of the following which are deposits which are not treated as deposits. Each point 2 marks, that's it. Next one, if any amount becomes refund, refund should be done within how many days? 15 days of becoming due. If not refunded within 15 days, it becomes a deposit. And this also, recent exams, this point also tested for 2 marks. Amounts brought in by promoters or his relatives as unsecured loans due to stipulations of lending institutions. This is not a deposit until financial institution loans are repaid. That's it. Startup company is also important. Out of 18 points, 1, 2, 3, 4, 5, 6, 7. 7 points are very important for short practical questions. Startup companies, how much amount? 25 lakhs or more as a convertible note, and it should be repayable within 10 years. Either convertible or repayable. Convert it into equity or return that money within how many years? 10 years. Then also it is not a deposit. Next one. Yes, this point. This chapter is not applicable to 4 companies. What are those 4 companies? Banking, NBFC, HFC, prescribed other companies. So to these 4 companies, acceptance of deposits, this chapter applicable or not applicable? Not applicable. Next one, yes. What are the conditions a company should satisfy for acceptance of deposits from members? What are the conditions? First thing, ordinary resolution. For accepting deposits from members, ordinary resolution is required. If a company is accepting deposits from public, then special resolution. For that, section 76 is applicable. Here we are discussing only 73 companies. Section 73 companies can accept deposits only from members. Next one, preparation of circular, issuing circular to the members. But before you issue circular to the members, file a copy of circular with ROC. Clear? So looking at the contents of the circular, very easy to remember: financial position, credit rating, total outstanding number of depositors, amount due to the depositors, and other prescribed details. And how can I send circular? Through post or electronic mode, and publish it in two newspapers: English newspaper, vernacular newspaper. Auditor's certificate. When auditor certificate is required? Every time, whenever company is issuing circular, every time auditor certificate is required. With respect to what? Last 5 years company have not committed a default, or if default has been if there is a default, company has rectified it, last 5 years there is no default at all. First of all, company has not committed a default. If committed, the default was rectified and 5 years have been passed since rectification. Next one, validity of the circular. How long circular is valid? It is valid up to 30th September of every year, or due date of AGM if AGM is not conducted, or AGM conducted, sir, then actual date of AGM. Actual date of AGM where financial statements has been placed, whichever is earlier. Once financial statements are adopted in the general meeting, the financial position of the company gets changed, yes or no? So that means you need to prepare a fresh circular containing latest audited financial information of the company. Next one, a company must file a copy of circular with ROC within 30 days before issuance to the members. DRR, how much amount I should create for DRR? 20% of the deposits maturing the year following year. Certificate of no default, just now I told you. Next, yes, this can be tested for 3 marks. Relaxation for private company. Above mentioned points like preparation of circular, filing of a circular, depositing certain amount in a reserve, certifying no default do not apply to how many private companies? 3 private companies. One is a private company which is accepting up to 100% of the paid up share capital plus free reserves plus securities premium as a deposit. That means outstanding deposit plus proposed deposit less than or equal to 100% of paid up share capital plus free reserves plus securities premium. Yes, for them above 4 conditions are not applicable. Second company, startup. Up to 5 years from incorporation for startup, even without any limit, above conditions are not applicable. Next one, a private company which can satisfy these 3 conditions. What are those 3 conditions? This is neither an associate nor subsidiary to any other company. Total borrowings from the financial institutions, banks, it's wrong. You should not write not exceeding. Less than is the correct amount. Less than is the correct point. Total borrowings less than twice of the paid up share capital or 50 crores, whichever is less. And no default with respect to repayment of such borrowings at the time of accepting the deposits. Clear? So how many private companies are exempted from above mentioned conditions? 3 private companies. One is accepting up to 100% of the capital plus free reserves plus securities premium. Second one is startup up to 5 years. Third one is neither associate nor subsidiary. Total borrowings less than twice of its paid up share capital or 50 crores, whichever is less, and no default in repayment of above borrowings. To these 3 companies, exemptions. But these companies has to file a DPD3 form every year by 30th June with ROC. Next one, what would be the tenure of deposits? Can company accept demand deposits? No, acceptance of demand deposits is not allowed. Minimum tenure is 6 months, maximum tenure is 36 months. But if company want to accept deposits for shortest tenure possible, that is up to 3 months, for that there is a ceiling limit. The ceiling limit is 10% of paid up share capital plus free reserves plus securities premium. Next one, All these special points are similar for private company, public company. That means companies accepting deposits from members, companies accepting deposits from members plus non-members. All these special points are similar. Next one is eligible public company. So which company can accept deposits from public? The answer is eligible company. Eligible company should satisfy either of these two conditions. Condition 1 is compulsory. Condition 1 is it should be a public company. Condition 2, net worth 100 crores or more, turnover 500 crores or more. Condition 1 compulsory. Condition 2, either of these two things should satisfy. Getting my point? Then only it becomes eligible company. Only eligible company can accept deposits from its members as well as non-members. See, what is the maximum limit a company can accept deposits? What is the maximum limit? 35% of paid up share capital plus free reserves plus securities premium. But for IFSC companies, the limit is 100%. And these limits will not apply in two private companies. How many companies? Two private companies. But general limit is 35%. For IFSC companies, by default 100%. But these two limits are not applicable to private companies. For public companies, always limit applicable. There is no exception to the public companies. Whether it is eligible or ineligible, forget about it. See, for avoiding clarity, just observe carefully. Company, two types: private, public. Public again, two types. One is net worth 100 crores or more, or turnover 500 crores or more. This kind of public companies becomes eligible company. Eligible company. Now listen carefully. Private company, ineligible public company. Ineligible public company. For these two companies, they can accept deposits only from members, whereas eligible company can accept deposits from members, non-members. Okay na? Up to here it is clear. Now look at the limit. From members, what is the limit, sir? What is the limit? Individually if I write, ineligible public companies, the limit is up to 35% of paid up share capital plus free reserves plus securities premium. You know, this is including outstanding deposits. Outstanding deposits plus proposed deposits. Proposed deposits. Clear? Next one, IFSC public companies. IFSC public companies, all private companies, these two categories, for them the limit is up to 100% of paid up share capital plus free reserves plus securities premium. Clear? Everyone? But this 100%, this 35% not applicable to two private companies. So it is very important to remember 35% is applicable only to public. 35% is only applicable to public companies. For private companies, default 100%. IFSC public companies default 100%. Whereas if a private company, which is a startup, up to 10 years of incorporation, I repeat, up to 10 years of incorporation, there is no limit at all. There is no limit on acceptance of deposits. And next one, a private company which satisfy three conditions. One is neither associate nor subsidiary. Total borrowings, TB, total borrowings, it's not less than or equal to, less than 2 times of paid up share capital or 50 crores, whichever is less. Third condition, no default in above borrowings, no subsisting default. No subsisting default in above borrowings. For this also, no limit. For this also, no limit. That means no limit condition, no limit privilege is not available to public companies. Getting my point? Next, now coming to eligible companies, from members they can accept up to 10%, from non-members they can accept up to 25%. This classification is not applicable to government company. Understood? Everyone? Is it clear with respect to the limits? Clear? For government, consolidated 35%. They can go with members, they can go with non-members. That's it. Whereas for other than government company, members max 10, non-members 25. Suppose sir, from members I'll go with 5%, sir. From non-members I'll go with 30%, sir. Possible or not possible? Interchange not possible. For government company possible. For government company overall ceiling limit is 35%. Understood? Next, special points. If you look at special points, ceiling on interest rates, brokerage rates is prescribed by RBI. Application form, along with application form, the depositor should submit a declaration stating that deposits is not made out of borrowed funds. Joint names possible are possible but not exceeding 3. Deposit receipt. What is the time limit for issuing deposit receipt? 21 days from the receipt of money. Within 21 days from receipt of money, company should issue deposit receipt. And what is the penal interest rate for overdue period? 18% per annum. As on maturity date, company has to repay deposits, or else for overdue period, interest rate of interest is 18% per annum, penal rate of interest. And any default with respect to complying these provisions, like non-filing of circular with ROC, issuing circular directly to the persons, in that case, the punishment is 5,000 rupees to the company as well as officer in default. If it is a continuing failure, then 500 per day is added extra, 500 per day. Clear, everyone? 76, yes, I told you public company. 73 OR is sufficient. Differences I am telling you. 73 OR is sufficient. 76, yes sir. But proposed deposit plus existing debt, if it is up to 100% of paid up share capital plus reserves plus securities premium, then OR is sufficient. Credit rating is compulsory. Every year company has to obtain credit rating. And if company fails to disclose anything about secured or unsecured, by default it becomes secured. If company is planning for unsecured deposits, it has to specifically disclose the point. These deposits are unsecured deposits. Next one, depositor trustee, you can say disqualifications. Disqualifications important. Director, KMP, officer, employee of cash company, relatives of this company, disqualified. Depositor of a company, disqualified. Debtor, disqualified. Material pecuniary relationship with company, disqualified. Surety also disqualified. All these people are disqualified to act as depositor trustee. For removal of depositor trustee, all the directors present at meeting, whoever present at the meeting, all the directors should pass should be in favor of removal. Then only that removal is valid, or else removal is invalid. Suppose 15 directors are there, 9 directors attended the meeting. Now 9 should pass votes in favor for removal, then only removal is valid. Suppose if company is having any independent director, then that independent director should also attend the meeting, should also exercise voting right in that meeting. Maximum amount of deposits, I told you 10% from members, 25% from public. So when you are calculating 10%, 25%, it is also including outstanding deposits. Suppose outstanding deposits full sir. Now proposed deposits will be 0. Next one, register of deposits. Within how many days register of deposits shall be updated? 7 days. Authentication by the director or secretary or any authorized officer. And how long I should preserve these registers? 8 years from the date of latest entry. That means once you repay those deposits, you will update that entry in the register. From the latest entry onwards, within 8 years, you have to preserve that register. After 8 years, you can scrap it. For premature repayment, 1% rate cut is there. Okay, na? And punishment for contravention. Punishment for contravention of 73 subsection 2 76. For company, what is the fine? Minimum 1 crore. Maximum? No. It's not like that. Minimum 1 crore or 2 times of deposits accepted, whichever is less. That is minimum punishment. Maximum 10 crores. In minimum we are having 2 limits. Out of 2 limits, whichever is less is the minimum. Maximum 10 crores. Officer in default, both imprisonment and fine. Imprisonment 7 years, minimum fine 25 lakhs, maximum 2 crores. If it is a defaulting purposes, 447. It's not defaulting purposes. If it is fraudulent purpose, If it is for fraudulent purposes, they are using this mechanism, then they get punishment under section 447. One last section in deposits is repayment of old deposits. When should I repay those old deposits? You should repay those old deposits as per the original tenure, or within 3 years from the commencement of this section, whichever is earlier. Whichever is earlier out of two dates. Which two dates? Original due date or 3 months from the commencement of this section. But before that, within 3 months of commencement of this section, file details with ROC regarding quantum of deposits accepted so far, number of depositors, terms and conditions, everything you file a copy with ROC. If you want time extension, go and take approval from NCLT. And any default, that means if you are not repaying within the 3 years, or if you are not repaying within the extended due date of NCLT approval, or if you are not filing these forms with ROC, then the punishment is for company 1 crore to 10 crores, imprisonment up to 7 years, or 25 lakhs to 2 crores, or both. Remember, for old deposits, either imprisonment or fine or both. But for new deposits, it's imprisonment and fine. No confusion at all. This is with respect to new deposits. This is with respect to old deposits. Clear? And old deposits, if company wants to renew, that renewal shall compulsorily be done according to the provisions of New Companies Act. Clear? Clear? So what is the time limit for issue of deposit receipt? 7 days. What is the time limit for 7 days or 21 days? 21 days. What is the time limit to update the register? 7 days. How many maximum number of names can be incorporated on one deposit receipt? 3. Okay, now. So DPT1 is a form for circular. DPT2 is for deposit trust deed. 7 days before issue of circular, you have to execute deposit trust deed. And every year by 30th June, company has to file a form with ROC. It is DPT3, return of deposits. So with this, deposits marathon completed. So let's continue revision with the next chapter, chapter 6, registration of charges, section 77 to 87. First of all, what is a charge? It is an interest or lien created on company properties or company assets or any of its undertaking. Undertaking means group of assets or group of properties as a security, and charge includes a mortgage. Suppose company C Limited went to bank SBI for the want of loan of 20 crores. Bank is asking a security. Now what company is doing? Company is having one land and building, and this land and building value is 30 crores. Now what company is doing? It is creating an interest over this land and building as a security in favor of SBI. So any property which was provided as a security to other party, it may be either loan purpose or maybe a guarantee purpose. Suppose government of Tamil Nadu came to me, my company C Limited filed an application with government of Tamil Nadu for a contract. Government of Tamil Nadu told you need to deposit 20 crores as security deposit. Only after completion of contract we will release that funds. See, company is not having money. That's why company what it created? It created an interest on one property or a lien on one property, and it transferred that interest or lien in favor of government of Tamil Nadu. Sir, what interest or what liens are? Tomorrow, if C Limited fails to pay money, or tomorrow, if C Limited fails to fulfill the contract, the other party can occupy this property, can sell this property. That's what interest or lien means. Under charge, we are not transferring ownership, but we are transferring certain rights. Upon fulfillment of conditions, we will get back our property along with interest, along with the rights. On default of any condition, like failure to repay loans or failure to fulfill the contracts, what other party can do? He can enforce the charge, he can occupy our property, he can sell the property. Now any charge means what? Any interest or lien created on company properties, company assets, or group of properties, group of assets, which we call it as undertaking. As a security, it is charge, and charge includes mortgage. Mortgage is a term used for immovable properties. Mortgage is the term used for immovable properties. In recent examination, a question was asked like this. So what is the time limit for registration of charge? What is the time limit for registration of charge? 30 days. 30 days of creation of charge. It is the duty of company to register charge with ROC. Now 30 days starts from which date? Is it creation of charge or is it withdrawal of loan amount? For example, in that examination, the question is like this: C Limited created a mortgage deed in favor of State Bank of India on 1st April 2025. What is this mortgage deed? Mortgage deed, the term charge includes mortgage, that means it is also a charge. And SBI sanctioned loan as on 1st April 2025, but C Limited started using the funds from 1st October 2025 onwards. Now the point is 30 days time limit will start from 1st April 1st October. That means date of utilization of funds or date of mortgage deed. Answer is date of mortgage deed. So when you created charge, the material point is when you created charge. It's not when you started utilizing the funds. So what is the time limit for registration of charges? 30 days from the date of creation. And this charge is of two types: fixed charge, floating charge. Fixed charge is a charge created on identified specific fixed assets like land and building, plant and machinery. If charge is created on assets which are fluctuating in nature, we call it as floating charge. For example, stock, book debts. Under fixed charge, we can use the property, but we cannot sell the property. If you want to sell the property, you have to take consent of charge holder. Who is charge holder? In favor of whom we are creating charge, he is known as charge holder, money lender, for example. Whereas under floating charge, we can use the assets, we can sell it, we can make it money. With the money, we can also acquire new raw materials, we can also produce them into new finished goods. Fixed charge is restricted to identified asset, whereas floating charge is extended to future assets. Okay, na? Who will get first priority? Creditor under fixed charge. But creditor under floating charge can convert floating charge into fixed charge upon happening of certain events, certain conditions, like companies stopped paying installments, companies stopped carrying business operations, or on happening of certain event like debt equity ratio exceeded 2:1. On happening of any such things which were already recorded in the charge document, on happening of those things, charge holder can convert floating charge into fixed charge. We call it as crystallization. What is the effect of crystallization? Floating charge gets converted into fixed charge. Once it gets converted into fixed charge, company cannot use that property, company cannot sell that property without consent of charge holder. So terms conditions violated, company stops its operation, company goes into liquidation, or creditor enforce security covered by floating charge. Next one. So in this chapter we are having how many sections? 11 sections. 77, it is a duty of company to register charge. But if company makes default, charge holder can register charge under section 78. Registration of charge provisions applicable not only at the time of creation but also at the time of modification, 79. Once charge is registered, it becomes constructive notice, it becomes public notice, section 80. Let's see. So whose duty to register charge ma? It's the duty of company to register the charge with ROC. And who can also register the charge? Charge can also be registered by charge holder, and then purchaser of a charged asset. Suppose Reliance Industries Limited created charge on one of its factory, and my company V Industries Limited acquired the charged property. Now V Limited is bound to register charge with ROC. Okay, now so who can also register charge apart from company? Company, charge holder, purchaser of the charged property. If purchaser is a company and the property is already charged property. Next one, applicable form CHG1. And what is the time limit for registration of charge? 30 days of creation of charge along with the prescribed fees. And this document shall be duly signed by the company. Company means representative of the company as well as a charge holder. So CHG1 shall be signed by both company and charge holder. Verification of instrument of charge. Instrument of charge. I'm not talking about form. I'm not talking about application form for registration. I'm talking about instrument of charge. That means mortgage deed or agreement, loan agreement. So how that verification part will happen? If a property is located outside India, sir, if I create charge on a property outside India, is there any obligation on me to register charge in India? Yes. Whether property is located outside India, in India, whether property is a tangible or intangible, whether property is a immovable, once you create charge, it's your duty to register charge with ROC. But if the property is located outside India, that instrument of charge can be signed under company's common seal, no problem. Directors, CS or authorized officer will also sign. Next one, charge holder authorized officer will also sign. Next one, any person interested in the mortgage or charge, who might be the owner of the charged property which was located outside India, that person can also sign instrument of charge. Simply mortgage deed can be signed by, if company common seal is there, fix it, or else director CS is sufficient. Director CS not there, sir, outside India, then person whose interest is involved in the, or whose interest is included in the charge, that person can sign it. Suppose if property is located in India, then director CS charge holder signature are sufficient. If you look at the sanction document, sanction letter, company banking company official stamp and manager signature you will find on a sanction letter. That sanction letter is valid. That means, unsigned sanction letter, is it an instrument of charge? No. Unsigned unregistered mortgage deed, is it a valid? No. Verification should be done. How it will be done? Someone should sign it. Someone means authorized person, CES, director, or any person whose interest is included in the, whose interest is involved in the charge. Next one, registration time limit for charges before 2nd November 2018. That means new charges or old charges are old charges. What is the time limit? 30 days with normal fees. 30 days completed, sir, then 300 days. Within 300 days of creation of charge, normal fees plus additional fees. Sir, 300 days also over, sir. By 2nd November 2018, 300 days also over, sir. No problem. 6 months time I am giving you. Within 6 months after commencement of this ordinance, that means from 2nd November 2018 onwards, if you register charge within 6 months, then we assume that you complete with the provisions of this chapter. For new charges, only 3 time limits. One is normal time limit 30, normal fees. Next, additional time limit of 30 days with additional fees. Further 60 days with ad valorem fees. Ad valorem fees. In all cases, normal fees is applicable. Okay, now, so what is the total duration, ma? What is the total time limit? Maximum time limit for registration of charge, 120 days. If charge is registered within 120 days by paying additional fees or ad valorem fees, what happens? The charge holder becomes secured creditor. If charge is not registered, he will not get any security, he will not get any priority, even though the charge was registered under Transfer of Properties Act. Transfer of Property Act, we had one act. For transfer of immovable property, we had one act, Transfer of Properties Act. Even though charge was registered under Transfer of Property Act but failed to register under Companies Act, we assume that there is no charge at all. You will not get any priority upon selling that asset. You will be treated as unsecured creditor. Okay, na everyone? See, as per book like this, ma, practically I can register charges which were created 1 year back also. Practically is different. Practically rules follows. As per book, act, we are reading what? Act. Rules different. Rules allowing. Next one. So now normal time limit, how many days? 30. Further 30. Additional 60. Total 120. Procedure for extension. So if you want any extension, if you are not able to register within 30 or next 30 or additional 60, then just file an application with ROC. Application shall be signed by CS or director, stating that belated filing will not affect the rights of intervening creditor. Suppose, before registration of charge with ROC, same property, I created mortgage in favor of another banker and this charge was already registered. That means first charge registered later, second charge registered earlier. Now who gets priority? First charge holder gets priority. Second charge holder gets priority. Second charge holder. That means whose charge registered first, that person gets priority over the property. Suppose property value 3 crores. First charge holder 2 crores outstanding. Second charge holder 2 crores outstanding. Upon selling this asset, 3 crores first I will pay to second charge holder. Balance amount I will pay to first charge holder. Intervening creditor's interest will not be affected, first of all. Next one, ROC grant extension only if it is satisfied that company had a valid reasons for belated filing. Next one, further additional fine or ad valorem fees as applicable shall be paid. So once filing completed, ROC registers the charge document and ROC issues a certificate of registration in form CHG2, and this certificate of registration is a conclusive evidence that you have complied with all applicable provisions and rules made thereunder. That's it. Subsequent registration. Any charge registered within extended period, that is beyond original 30 days, will not affect any rights acquired over the property before charge was actually registered. So intervening creditors' rights are protected. Intervening, that means middle, date of creation of charge, date of registration of charge. In this middle, if anyone acquires that property or if anyone lends money on that property, their rights are safe. That means who is at risk? Charge holder is at risk. Registration is merely a legal formality, meaning concept of charge remains valid despite late registration. Tell me, in case of late registration or in case of non-registration, do you think company is exempted from repayment of debt? No, company is liable to pay debt. But if charge is registered, what happens? If charge is registered, the charge holder gets priority over other creditors. Upon selling this asset, first his debt will be repaid. Yes or no? Did I cover all these points in the regular class? Covered? Fine, then respond. However, failure to register may prevent the creditor from gaining legal priority or advantage. Consequences of non-registration. Creditor, even though he himself is a secured creditor, as per Companies Act, he is a unsecured creditor and he loses priority. He loses priority to other creditors with a earlier registration. Understood this point? Company C Limited, land and building. First time it took loan from SBI. Date 1st April 2025. So date of creation of charge. Date of creation of charge is 1st April. C Limited, again showing same property. It took loan from Axis Bank. And date of creation of charge is 1st May 2025. But date of registration of charge is 1st June 2025. Example. Whereas charge in favor of SBI, date of registration is 10th June 2025. Now tell me, who gets priority? Who gets priority? Axis Bank or State Bank of India? Na? Tell me, who gets priority? Who gets priority, ma? First creation is in favor of SBI on 1st April. Second creation in favor of Axis on 1st May. Axis charge registered on 1st June. SBI charge is registered on 10th June. Now who gets priority? Axis Bank. That means it's not date of creation, it's date of registration. It's date of registration. Following next one. Exemptions. Yes, CG is having power to grant exemptions. Specifically, the charges created by the banking companies under section 17, subsection 4, clause D of RBI Act. For these charges, no need to register those charges with ROC. So CG will prescribe such kind of charges in consultation with RBI. 77 over. Next one, 78. What is section 78? What is section 78? Charges registration by charge holder. So first, whose duty to register the charge? Company. If company fails, then charge holder can register the charge. So first, charge holder, he will file an application for registration with ROC. ROC will not grant certificate of registration immediately. First, ROC intimates a company. Either if company files form for registration of charge on its own, or if company shows sufficient reason why not to register the charge, only in these two cases ROC rejects this application. Suppose if there is no response from a company within 14 days of intimation, if there is no response, then ROC allows that application. He issues certificate of registration in favor of charge holder, in favor of company. And whatever fees paid by the charge holder for registration of the charge, who need to reimburse that amount? Company need to reimburse that amount. Okay, na? Everyone. So if company fails to register charge within 30 days, then charge holder may apply to ROC. But ROC will give one intimation to whom? Company. ROC wait for 14 days. Within 14 days, either company should register the charge or company should intimate why not to register the charge. So ROC will not permit registration if company registers the charge or provides sufficient cause why charge should not be registered. Recovery of fees. Whatever fees paid by the charge holder for registration of charge, he can recover that amount from company. Company acquiring a property already subject to the charge. That means one company is acquiring what property? charged property or free from charge property? Charged property. Charged property means company already created charge in favor of a banker, and that property another company is acquiring it. Now we assume that the acquirer is having knowledge of the charge, because registration of charge means filing a documents with ROC for registration. Any document you file it with ROC, it becomes public document. Anyone dealing with company, we assume that they had a knowledge of public documents. So now yes, acquirer should register a new charge with a ROC. The earlier charge should be vacated and new charge shall be registered by acquiring a company. Next one, modification of charge. So yes, terms and conditions are subject to mutual consent. They can be modified. Terms and conditions can be modified through the mutual consent of the parties. For example, loan enhancement, increase in rate of interest, increase in tenure, change in securities. Previously I gave one land and building. Right now instead of land and building, I provided factory. Or change in parties. Suppose SBI is not giving good treatment to me. Imagine, suppose I want to shift my loan profile to Union Bank. Now what happened? Charge holder is getting changed. Previously who is charge holder? SBI. Now who is charge holder? Union Bank. All these are examples for modification of charge. In case of modification, section 77 shall apply. That means what? Within 30 days of modification, company has to register modification of charge with ROC. If not 30, then additional 30. If not additional 30, then additional 60. And modification will come into force only after completion of registration. Until registration, modification will not have any effect. Demood notice of charge. Any person dealing with company properties, whether it is charged or charge free, we assume that he is having a knowledge of charge. So subsequently he cannot claim, or rule of estoppel, he cannot claim protection under rule of estoppel. Sir, I don't know about creation of charges, sir. So that means he is subsequently liable to the charge holder. Understood? Everyone? Reporting of satisfaction of charge, section 82. Section 82 is all about intimation for satisfaction. Satisfaction means what? When the purpose of creation is satisfied, we call it as satisfaction of charge. Within how many days company should file satisfaction of charge with ROC? Same time limit, 30 days. If not, additional 270 days. That means total 300 days extended time. For extended time, of course, additional fees is applicable. But here, declaration, why late, why belated, all these are not applicable. Just pay normal fees and additional fees. First, upon receiving this application, ROC will not issue certificate of registration of satisfaction of charge. First, he asks charge holder, is it true? And ROC wait for 14 days. If there is no response from charge holder, or if charge holder already filed NOC with ROC, then ROC enters satisfaction of charge in the register and issues certificate of registration of satisfaction of charge. So ROC enters memorandum of satisfaction in the register and ROC issues a certificate of satisfaction of charge to the company. From that date onwards, the property is the property is free from charges. Subsequently, if company want to make fresh loan on the same property, yes, it can make fresh loans. Everyone getting my point? But section 82 will not affect section 83. Section 82 will not affect section 83. But before section 83, important time limits, 14 days. What is this 14 days? ROC intimates charge holder and ROC waits for 14 days. Within 14 days, if there is any show cause from charge holder, ROC stops registration. If there is no response, or if there is a positive response, yes, loan already discharged, then ROC enters memorandum of satisfaction of charge and issues certificate of registration of satisfaction of charge. 82 is not getting affected by 83. What is section 83? Let's see 83 first. What is 83? Powers of ROC to make entries of satisfaction. Suppose company created charge on land and building. Company repaid that loan. Registration of charge happened, repayment of loan also happened. So if I take property documents, if I take encumbrance certificate, that property is free from charges. I don't know about Companies Act. I'm a natural person. I don't know about Companies Act. Under Transfer of Properties Act, loan was repaid, mortgage deed also cancelled. So what I did, later I acquired property. After acquisition, I came to know that company previously registered charge on that property. Now already satisfied, that is satisfied, but company forgot to file form with ROC. Now when I file application with ROC, what ROC do? ROC conducts a reasonable inquiry. If ROC comes to a conclusion that yes, debt has been wholly or partially repaid, or part of the property or undertaking or has been already released from the charge, or property has ceased to be formed part of company assets. Yes, company already sold property to me. That property is not part of company properties. In that case, tell me what ROC will do. ROC enters memorandum of satisfaction of charge and issues certificate of registration of satisfaction of charge to all the affected parties within 30 days of making entry in the register. Okay na? So difference between 82 83. 82, when you file application, ROC will respond. 83, suo motu basis, on its own motion it will respond, but the ultimate effect is satisfaction of charge only. Next one, 81 85. What is 81 85? Registers. One is maintained by company, other one is maintained by ROC. What is the specialty of company register? Company maintains details of all charges, whether it is a fixed, floating, whether it is inactive, modified, satisfied, everything will be recorded in one register, maintained at registered office of the company or at any other place as decided by the board. Kept at the registered office. See, every company shall maintain register of charges at its registered office. The register shall include all charges, including floating charges, affecting any company properties, assets, undertakings, along with the prescribed particulars. Now, very important point. Instrument of charge different to register of charges different. Instrument of charge, you know how long company should preserve? It should preserve 8 years till from the satisfaction. Register permanent till liquidation. It's similar to the incorporation documents. Once you file incorporation documents with ROC, so you need to preserve them at registered office till liquidation. Here also register shall be preserved only at registered office till liquidation, but instruments creating charge, they should be preserved till 8 years. 8 years from creation, 8 years from satisfaction. Satisfaction. Okay. And who will record entries in the register? Company register. Who will record entries? Either CS, if CS is there, CS, or director, or any person authorized by the board. Entries shall be recorded immediately after creation, modification, satisfaction of a charge. Okay na? Next one, register of charges by the registrar, section 81. In this register you will find charges of all companies falling in the jurisdiction of that ROC, whether it is fixed or floating, everything is available. Upon payment of nominal fees, how much? 100 rupees per company. You can download all these documents and you can view these documents, you can go through these documents. So MCA website, MCA domain is deemed to be register of charges, which is maintained under section 81. Okay na? So for this physical place is not available. Registered office, you know, public domain, right? It is accessible from everywhere. 81 85 also completed. 83 completed. 84, intimation of appointment of receiver. You know, to manage charged property. What? To manage charged property, if charge holder is appointing any receiver or any liquidator at the time of appointment, at the time of termination, that person has to make communication with two people. Who are those two people? Company or ROC. Within how many days? Within 30 days of appointment or within 30 days of termination. So this is all about filing requirements, communication requirements, intimation. Name itself is telling intimation. If any receiver has been appointed, or if any receiver tenure comes to an end, that means termination happened, within 30 days of event, communication with company and ROC is compulsory. Both the cases ROC records the matter. That's it. Next one, punishment for contravention of this chapter. Which chapter? Charges chapter. So the punishment is for company 5 lakhs, officers 50,000. Punishment means improper maintenance of registers, non-maintenance of registers, non-preservation of the registers or non-preservation of the instruments of deeds. Next one, non-filing of the forms. Sir, fees is, you already told no, that is fees for late filing. But you contravened provisions, right? You contravened provisions, this is the punishment. For late filing, you pay additional fees. That fees is for late filings. But you contravene that 30 days time limit, for you also this punishment is applicable. Okay na? And you know, any person who is involved in the fraud, the punishment is 447. Section 87. Remember, only two things. Section 87 is all about powers of CG. When CG exercise powers under this chapter, when there is a misstatement in the filings with ROC and register. Misstatements means what? Unintentionally only, due to inadvertence, certain filings happen wrongly, or statements recorded in the register wrongly. Next one is, for satisfaction of charge, we are having a time limit of 300 days. Actual time limit is 30 days. Additional time limit, 300 days. Time limit is over. Delay is there. So to condone the delay, that means to remove that condonation of delay. Simply, for condonation of delay also, central government permission is required. So central government permission is required in how many cases? Two cases. One is misstatements in the register filings with ROC. Next one is delay in registration of satisfaction of charge. So if central government is satisfied that yes, that defaults or the delay is completely unintentional, it's not intentional things. So CG, by passing an order, allows company to register satisfaction of charge after time period, also allows company to rectify its previous filing, rectify its registers. Clear? With this, registration of charges completed. Let's continue revision with the next chapter, that is chapter 7, management and administration, section 88 to section 122. The expected weightage of this chapter in your examination is 10 marks. Last 3 attempts, if you observe, on an average 10 marks coming from this chapter. And if you look at the important concepts of this chapter, annual returns, time limit for filing annual returns and signing of annual returns. Who signs annual return? That is important. Closure of registers, particularly period of closure. How long registers can be closed? Next one, preservation of registers. How long company shall maintain registers? Next one, AGM, EGM. In AGM, EGM, day, time, place are important. Day of meeting, commencement time of the meeting, venue of the meeting. These three factors are very important with respect to AGM and EGM. Next one, notice calling for general meeting. In notice, about omission, if it is accidental omission, what would be the effect? If it is intentional omission, what would be the effect is important. Next one, quorum. So what is the effect of lack of quorum? Meeting stands adjourned. But there, we had one type of meeting which is called because of requisitionist. If EGM is called because of requisitionist, if there is no quorum, meeting stands cancelled. It's not adjourned, meeting stands cancelled. That particular point is very important. Next one, limitations in proxy. Proxy cannot represent 100% of the members. He can represent maximum 50, or he can represent maximum 10% of the paid up share capital. Okay, so those factors are very important. Proxy, limitation factors are very important. And then minutes, contents of the minutes, particularly appointments happened at the general meeting, are deemed to be valid, whatever names are recorded in the minutes, and what type of contents, what contents can be excluded from the minutes. So all about, minutes contents is important. And next one, so far not tested, but chance is there, a probability is there, significant beneficial owner, limits and timelines for complying those provisions. So these are few important concepts in management and administration chapter. Now let's continue revision. Yes, management and administration, you can see this chapter I divided into two parts: registers and returns, general meetings. Registers and returns 88 to 95, general meetings 96 to 122. Now registers and returns once again classified into two parts, or categorized into two categories: registers, returns. Yes, company has to maintain registers with respect to all its members. For beneficial owners also separate register. For significant beneficial owner also separate register. For remembering section numbers, I am telling you, actual section reference is different. Section 90 means declaration of significant beneficial ownership interest. But for remembering section numbers, I am telling you, registers for members 88, beneficial owners 89, significant beneficial owners 90. And these registers can be closed under section 91. Annual returns to be filed with ROC 92. Changes in promoter stake, yes, that is also one return 93, but in our syllabus 93 is not there. Next one, these registers and returns are available for inspection, and these registers and returns will act as an evidence 94, 95. Next one, coming to the general meeting, again two parts, types of prerequisites. Yes, we are having how many types of general meeting? AGM, other than AGM, we call it as EGM. AGM by company, NCLT, EGM by NCLT, these three are mandatory. No one can escape from these meetings. If NCLT calls for EGM, if NCLT calls for AGM, and company, AGM by company, this is also mandatory. So any default happens in these three meetings, punishment is under section 99. And company, if it wants voluntarily, it can have a EGM under section 100. Now coming to prerequisites, yes, 4 prerequisites we need to satisfy: properly convened, constituted, conducted, concluded. Properly convened, under properly convened, we have to check 2 conditions. One is notice calling for meeting, and second one is if in that notice any special business is mentioned, then explanatory statement is mandatory. Without explanatory statement, if you issue notice calling for meeting and in that notice if there is any special business, then that special business item becomes void. That means discussion of special business at general meeting becomes void. Even you got unanimous approval, even you got unanimous resolution, but that proposal can't be implemented. So for calling a meeting, notice explanatory statement compulsory. Now constitution of meeting. For constitution we check quorum. Who check quorum? Chairman. While checking quorum, chairman has to exclude proxy, chairman has to include a representative of a president or governor, representative of a body corporate. So quorum 103, chairman 104, proxy 105, and president, governor 2 parties. President 1, governor 1, total 2 parties 112. Representative of a body corporate 113. Next one, in meeting the proceedings shall be properly conducted. So for that, we need to check voting, and the result of voting is resolution. So voting, yes, on members voting we can impose restrictions. Yes or no? What are the restrictions we can place on members voting? We restrict him from casting his vote in case calls are in arrears, his calls are in arrears, or he is having some lawful dues to the company. So with AOA authorization, we can impose restrictions on those members. Types of voting, yes, we are having 4 types of voting. Yes, E, P square. Yes, show of hands, e-voting, poll, postal ballot. 107, 108, 109, 110. Next, resolution, just remember CT, SAR. CT, SAR, C stands for circulation, T stands for types. Yes, special notice, A, adjourn meeting, or what is R? ROC filing. And finally, properly concluded. Yes, company has to maintain minutes with respect to meetings, and that minutes is available for inspection. That minutes can be maintained in electronic mode. So 119, 120. Finally, after completion of meeting, file a report on AGM, section 121, relaxation to OPC 122. Clear, everyone? Next, management and administration, section 88. So every company without any exceptions, okay, every company shall maintain register of members, debenture holders, other security holders. What is the form for register of members? MGT 1. And what is the form for debenture holders or other security holders? MGT 2. Clear, everyone? One register for all members, separate register for separate security, different security holders, separate register. One register for equity, one register for preference, one register for debenture holders, one register for other security holders. And what is the time limit for recording entries in these registers? What is the time limit? 7 days after board approval. The event date is board approval. Sir, why board gives approval, sir? Board, in which situation board gives approval? At the time of allotment, board approval is required. Board or committee approval is required. For transfer, transmission, issue of duplicate shares, in all these cases, mergers, acquisitions, yes, the cutoff point is board resolution or committee approval. From that date onwards, within 7 days, register shall be updated, or else punishment, default, we call it as default. Next one, place of maintenance of these registers. So tell me, where can I maintain these registers? First priority, registered office. But after passing special resolution, I can maintain them at any place in India. At any place in India where more than 1/10 of the total registered members reside. Or at any place in the city, town, village where registered office is situated. Any other location within the same city, town, village as registered office. Getting my point? That means within the same city, town, village where registered office is situated, any location. Next one, Next one, other information to be recorded in the register. What is that other information? These 2 points are very, very important, ma. Promoters, if they create any charge on their investments, on their securities held in the listed company. Suppose my company is a listed company, my company is having promoters, and if those promoters create any pledge on those, on their holdings, the same shall be recorded within 15 days. The same shall be recorded in the registers within 15 days. That pledge may be, financial pledge. For getting a loans, he might have pledged those securities, or in connection with a joint venture. So listed company or promoters entered into a joint venture agreement arrangement with some other company, and for funding the joint venture arrangement, yes, they pledged securities of listed company. Now both these events, both these cases shall be updated in the register within how many days? 15 days of the event. And if you observe carefully, this point is applicable only to listed companies. Clear? Next, any authority passing an order imposing restrictions on transfer of securities, transmission of securities. Okay, like example, insolvent of a person. A person got disqualified because he became insane. Like that, any such orders passed by the authority shall also be updated in the register. Particulars of register, just give one time reading. What is the format of registers, ma? Members MGT1, debenture holders or other security holders MGT2. Index of names, tell me when index is required. When index is required. Exactly, sir, in my company there are 50 members, sir. How many? 50. Now index required or not required? Required. Less than 50, not required. That means 49, 48, not required. 50, 51, index is compulsory. Next one, yes, non-compliance punishment. What is the punishment? 3 lakhs for company, 50,000 for officers. And all the offenses under this section are compoundable. That means no need of court judgment. Yes, they can be compromised. They can be settled even out of the court also. Next, authentication of entries. Tell me, who record entries in these registers, or who verifies the recorded entries in the register? If company is having CS, or person authorized by the board. That authorization, is possible by board resolution. Getting it? Next one, foreign register. Tell me, foreign register, is it applicable to all companies? That means company without share capital? No, it is applicable only with to company with the share capital. Our company issue debentures. Of course, which company can issue debentures? Only which is with a share capital only. A company with share capital only can issue debentures. Okay, now if they want to maintain, they can maintain foreign registers. That means registers outside India. Now tell me, in foreign register, how many registers we see? 3 registers. What are those 3 registers? Register at India, at registered office, we call it as principal register. Register outside India, it is a foreign register, and exact same copy of foreign register we need to maintain at registered office, we call it as a duplicate register. And what is the format for foreign register? That is similar to principal register. If the foreign register is for members, MGT1, foreign register is for debenture holders, MGT2. Okay, na? But whenever you open foreign register, or whenever you modify, that means change the address where foreign register is placed, or whenever you close foreign register, 3 cases. What are those 3 cases? Opening, change, close. In these 3 cases, within 30 days of event, company has to communicate with the ROC. Okay, na? Form number MGT3. And important point you have to remember is, the particulars or the details mentioned in foreign register shall not form part of principal register. Suppose in a company there are 1000 members. Out of 1000 members, 50 members details are already included in foreign register. Now principal register shall only contain 950 members details. It's not 1000. And these 50 members details you will also find in one more register. We call it as duplicate register. Clear, everyone? Next one. Within 15 days of making entry in the foreign register, the same shall be updated with a company. That means that regarding the transaction or the entry happened in the foreign register shall be updated with the company within how many days? 15 days. Now company immediately records the same in its duplicate register. Now inspection of foreign register, rectification of foreign register, okay, closure of foreign register. What are all the provisions applicable to Indian register? Same provisions are also applicable to foreign register. If there is any mistake in foreign register, who files application with whom? Aggrieved party files application with the tribunal or competent court? Competent court, because they are outside India. If there is any error in Indian registers, aggrieved party can file application with NCLT. But right now here, competent court is sufficient. Next one. If you decided to discontinue foreign register, then all the entries in foreign register shall be either transferred to principal register in India or another foreign register maintained by company outside India. Clear? Everyone? Next one. Declaration of beneficial interest. Declaration of beneficial interest. Simple point. Just observe this chart. A registered holder, beneficial owner. Registered holder is a person without beneficial interest. Beneficial owner, he is having benefits in that shares which are held by registered holder without any legal interest. Are you getting my point? Generally, legal owner is presumed to have beneficial ownership. But if legal owner is having just legal interest but beneficial interest is with some other party, then only this section is applicable. Which section? Section 89. Now both registered owner and beneficial owner has to communicate the same with the company. Within how many days? Within 30 days of the event. 30 days of the event means what? For registered holder, acquiring shares without beneficial interest. When he acquired shares without beneficial interest, yes, within 30 days he has to communicate with company. Beneficial owner, once he acquires beneficial interest in the shares held by other person, within 30 days of acquiring that beneficial interest, he has to file a form with company. Form MGT4 for registered holder, MGT5 is for beneficial owner. And subsequently also any changes in beneficial interest, same shall be updated with a company. Getting my point? Suppose you are holding shares on behalf of me. One day I transferred this beneficial interest to some ex party. I took from under private under private settlement, he paid me money, and I told you that so far you are holding securities on behalf of me. Now from today onwards you are not holding securities on behalf of me, you are holding securities on behalf of Mr. X. Now there arises changes in beneficial ownership. So all changes, yes, again registered holder, beneficial owner has to communicate with company. Company shall communicate with ROC. In which form? MGT6. Within how many days? 30 days. Punishment, default attracts punishment. What is the punishment? For registered owner, beneficial owner, punishment is 50,000 for first contravention. If that contravention is in continuing nature, add 200 per day. But maximum liability is 5 lakhs. Until declaration of beneficial ownership, beneficial owner is not entitled to his rights. That means he cannot even claim dividends on behalf of registered owner. But nothing prevents company from paying dividends to the registered holder, because section 123 to 127, if you observe carefully, company is required to pay dividends to the registered owners. Okay, now everyone? Next, if company makes default, for company 1000 per day up to 5 lakhs is the punishment. For officer in default, what is the punishment? 1000 per day up to 2 lakhs. Exemptions, this section will not apply to mutual funds, venture capital funds, SEBI approved funds, government companies which has not committed default under section 90 to 137. Next one, section 90. What is section 90? Yes, in 89, yes, we are having one more point. With respect to filings with ROC, one person should be designated. Who is that one person? CS or KMP. No CS, no KMP, then director. Exemption, you can see beneficial interest. Beneficial interest means what? Either receiving dividends or exercising voting rights. So because of this declaration, what is the main objective? What is the main objective of this declaration? With respect to this point, we can observe who is actually controlling the company. With respect to this point, who is receiving the dividends amount? Who is receiving the dividends amounts? One is a case of tax evasion, other is a case of control. Are you getting my point? Everyone? In movies also you can see binamis. So public point of view, binami is the original owner, but binami is under the control of that beneficial owner. Similarly, to know who is actually controlling the company, yes, we need this declaration. And next one, to know who is getting the benefits from the company. For this also we should know, for this also company should receive information from the registered owner and beneficial owner. Next one, SBO. This concept is similar to BO, beneficial owner. But what is the difference between SBO and BO? SBO, significant. Significant means how much, sir? As per Act, it is 25%. Tell me, as per Act, it is 25%. But you know, in Act, it gave powers to CG to prescribe any other percentage or any other prescribed percentage. You know, as per rules, central government fixed that amount as 10% of the shares, 10% of the voting rights, or 10% of the distributable dividends, or has significant influence or control. So observe carefully, SBO can exercise, significant beneficial owner can be exercised. SBO can be exercised in 4 ways. One is 10% of the shares. Second one is 10% of the voting rights. Third one is 10% share in the distributable dividends. And fourth one, it's not 10%, significant influence or control, either directly, indirectly. And remember, if any person is directly holding 10%, it's not SBO, direct owner only. Legal owner is equal to beneficial owner. Here 10% holding means what? Either totally indirect or partly direct and partly indirect. Okay, now direct holding means I will hold the shares. Indirect holding means my relatives, my nominees, my interested entities. Suppose I'm a partner in one firm and that LLP, no, I'm a partner in LLP and that LLP is holding some 6% share capital in the company. I'm holding 5% share capital in the company. Now total aggregate, if you aggregate it, how much it is? 5 plus 6, 11% is. 10% condition satisfied or not? Not satisfied or satisfied. So what is the main objective of this section? Same, to know who is actually controlling the company. But somewhat this is a material concept compared to beneficial owner. Okay, na? So tell me, within how many days they should comply with these provisions? Within how many days they should comply with the provisions? You remember the time limit? What is the time limit to comply the provisions? From the commencement of rules within 90 days. If you are an existing SBO, that means by the time rules got commenced, you are already SBO. Within 90 days of commencement of rules, file forms with SBO, file form with company files forms with ROC. No sir, I became SBO after commencement of the rules, sir. Then within 30 days of acquiring significant beneficial ownership. Sir, suppose if I acquire SBO, significant beneficial ownership, after commencement of the rules, sir, but within 90 days after commencement of the rules. I repeat, see, this is a point before commencement of the rules. Before commencement of the rules. In that case, within 90 days after commencement, yes, SBO has to file a form with company has to file a form with ROC. Suppose I got SBO, significant beneficial ownership, after commencement of the rules, sir. After commencement of the rules, then within 30 days of acquiring SBO, that means within 30 days of getting SBO, I need to communicate with company, and company within 30 days communicate with ROC. Suppose I got SBO exactly within 90 days after commencement. When? Within 90 days of the commencement of rules. Then for me, it's not 30 days from acquiring SBO, it's 30 days from which date onwards? 90th day onwards. Tricky point I'm telling you. Total how many limits are there? 2 limits, but internally third limit is there. Before rules are within 90 days you comply after commencement of rules. Sir, after rules only, sir, then within 30 days of getting a significant beneficial ownership, comply with SBO rules. Sir, I got a significant beneficial ownership exactly after commencement, but within 90 days after commencement, sir. Then for you, the triggering point is not acquiring SBO, the triggering point is 90th day of commencement of rules. From 90th day onwards, within 30 days, you comply with filings. Okay, na? But in this entire SBO, if you observe, whose duty to identify SBO? Company's duty. For that company, if company is having any doubt, company should issue a notice to the identified person, and company should ask that person to comply with the SBO rules within how many days? Within 30 days. Within 30 days. Observe carefully, ma. It's the responsibility of the company identifying SBOs. Ensure they file a declaration. A notice shall be sent to a person suspected of being SBO or having a knowledge of one. Okay, na? Okay, now that person should respond within how many days? 30 days. If that individual fails to provide information within 30 days of the notice, or information is filed but it is unsatisfactory, then company shall file the tribunal within how many days? 15 days after expiry of 30 days of sending notice. Next, why company is filing application with tribunal? So that tribunal imposes restrictions on the shares held by the person on behalf of another person. Now tribunal may restrict rights attached to the shares within how many days? 60 days after receiving application from the company and after giving an opportunity of being heard. If tribunal is satisfied that that fellow is not coming and that fellow is not filing any application to lift the restrictions within 1 year from the order date, then tribunal will order for transfer of shares to the IEPF authority. Okay, na? So in this entire SBO, you have to remember eligibility criteria of SBO. That is 10% of shares, 10% of the dividends, 10% of the voting power, significant influence. And time limit for commencement, time limit for complying these rules, 90 days for existing SBO, 30 days for new SBO. Next one, this SBO concept is not applicable to IEPF authority, holding companies, companies held by CGSG local authorities, entities body corporates controlled by CGSG. Next one, investment vehicles regulated by SEBI, investment vehicles regulated by RBI. Punishment part, just give one time reading, that's it. And all the offenses under section 90 are also compoundable in nature. That means by compromise you can settle these disputes. Next one. So section 90 is not applicable to government companies. Which government companies? Which is regular under section 92 as well as 137. That means no default under section 92, no default under section 137. Can I proceed? Next one, power to close register of members or debenture holders or other security holders. Why company close registers? The reason may be for payment of dividend, who are the eligible members. For voting rights at general meeting, who are the eligible members. For issue of bonus shares, who are the eligible members. For offering rights shares, proportionate offer of shares to the existing members. So in all these cases, to identify the eligible persons, what company do? Company close registers. That means during closure period, nothing will be updated. No transfer shall be registered, no transfer shall be updated in the register. As on cutoff date, who are the members? They get dividend rights, voting rights, bonus issue, as well as rights issue. That's it. Now, it is an obligation of company. It is obligation on the company to give notice of at least 7 days before closure. Of course, SEBI may prescribe shorter period also. SEBI may prescribe shorter period. But as per Act, what is the time limit? 7 days. And registers can be closed for a maximum of 30 days at a time, 45 days in a year. You can close it for 3 days, 4 days at a time. During the year, suppose you close that register for 5 times. Each time 5 days. Now 5 into 5 times, 5 days into 5 times means how much? 25. So it is within the limit of 45 days. Suppose if company issues a notice about closure of registers for a period less than 7 days, or if registers are closed more than 30 days at a time, or 45 days throughout the year, more than 45 days throughout the year, then for extra day of default, this is the punishment, 5,000 per day. Maximum fine is 1 lakh rupee. Who gets this punishment? Company and its officers in default. Clear? Everyone. Next one, advertisement in one vernacular newspaper, other one is in English newspaper, and notice must be published on company's website. But this advertisement concept is not applicable to private companies because it is having only 200 members and all transfers are subject to board approval. So board knows about it. Board knows about the transfers, and communication with 200 persons is comparatively easy when compared to public company. So advertisement not required. Next one, annual return. Remember the form of annual return. What is the form of annual return? MGT 7 for all companies and MGT 7A for OPC and small companies. Okay, now contents, just give one time reading. Contents, just give one time reading. Here important task is signing of annual return. Who signs annual return? Director and CS. If company is not having CS, then director and practicing CS, practicing professional available in market, so you can take his signature. But in case of OPC and small company, a return should be signed by CS. If CS is not there, then director is sufficient. No need to go with outside CS, practicing CS. That is the point. Either CS or director. Next one, certification of annual returns. This is not applicable to all companies. This is applicable only to 3 companies. What are those 3 companies? First one is listed company. Second one is company with paid up share capital 10 crores or more. Third one is company with turnover 50 crores or more. Listed company, by default certification of annual return required. And other companies, either paid up share capital 10 crores or more, turnover 50 crores or more. For them also annual return is certification of annual return is applicable. And what is the form for certification of annual return? MGT 8. Next one, what is the deadline for filing annual returns? What is the deadline for filing annual returns with ROC? Whether it is a OPC, small, private, listed, public, ignore. Even for OPC also same time limit, because for OPC in accounts of companies under section 137 clearly mentioned within 180 days of closure of financial year, but that point is not there here. And practically, yes, we also observed this situation in my company filings. In my company filings, OPC I filed within 60 days of due date of AGM actually. Sir, for OPC AGM is not applicable, no sir. AGM not applicable, but when member communicated with the company, when member communicate with company with respect to resolutions, that itself is sufficient for date of AGM. Date of AGM is communication between director and member, that's it. Okay, fine. So for whether it is a OPC, a small company, a private, a public, a listed, unlisted, for all companies, the deadline of filing annual returns with ROC is 60 days from AGM. Okay, na. Here adoption of annual return concept is not there. For financial statements, we had a concept of adoption of financial statements. Here adoption is not there. So whether adopted or unadopted, immaterial. Within 60 days of AGM, file it. Sir, AGM not conducted, sir. Then within 60 days of due date of AGM, also file reasons why AGM not held. Okay, now everyone. And also remember the penalties. Penalties for CS is important. What is the penalty for CS? If he wrongly, incorrectly certifies annual return, for him the penalty is 2 lakhs. And whereas delay in filing observed, then penalty for company and officer, contravention, first contravention 10,000. If it is continuing in nature, 100 per day, maximum 2 lakhs for company, 50,000 for officer in default. Can I proceed? Next, place of keeping and inspection of registers, returns, etc. Registers, returns can be maintained either at register office or at any place in India where 1/10 of the members reside. More than 1/10 of the members reside. For that, SR is compulsory. Tell me, for maintenance of registers and returns at registered office, SR required or not required? Not required. SR is not required for maintaining registers at a registered office. Other than registered office, SR is required. Can company maintain registers and returns outside India, in Australia, China, Korea? Possible or not possible? Not at all possible. Compulsory, it should be in India where more than 1/10 of the members reside, subject to special resolution. Next one, inspection. Tell me, inspection, all days are working days? Working days. All hours are business hours? Minimum how many hours company should allow for inspection? 2 hours. For members, for debenture holders, security holders, free of charge. Outsiders, 50 per inspection. After completion of exams, if you have no time, if you have plenty of time, if you don't know what to do, go to the nearest company registered office, pay 50 rupees, inspect all the documents. Observe whether they are following provisions or not. If they are not following, you just tell me, we'll blackmail them, because look at the punishment. So are you ready to pay this much punishment, or will you give us some small gift? Gift, right? These people will think it is a bribe. It's not a bribe, actually it's a gift. What is the difference between gift and bribe? Gift is a voluntary. Bribe is a don't write all these things in examination. Next one, extracts and copies. If you want, you can take pics, that means photos of the registers. If you want total copy of the registers, you can also take it, but for that, how much amount you need to pay? 10 rupees per page. upon written request and payment of fees within 7 days, it is a duty of company to send the documents. Okay, now next one, tell me how long I should maintain registers and returns. If it is for members, permanently. That means till the death of members or till the death of company. Yeah? Think and tell me. Death of members or death of company? Yeah? Death of company. Preference shares, debentures, up to 8 years after redemption. Next one. Register of members permanently, whereas debenture holders other securities shall be present for 8 years from the redemption date. So of course preference shareholders are the members of the company, so they comes under here, register of members, permanently. With respect to preference shareholders also permanent only. With respect to debenture holders other security holders, shall be present for 8 years from the redemption date. Next one, foreign register must be preserved permanently unless discontinued and transferred. If you discontinue it, no need to maintain, because why? The entries in foreign register shall be transferred to some other principal register. That's what. Next one, notice of a meeting, section 101. Section 101, tell me what is the length of notice? 21 clear days. Clear days means it excludes date of issue of notice, date of meeting. If notice is sent through post, 48 hours shall be added to the time period to know whether, just to ensure that notice was sent into notice was kept into the transmission. Next one, notice shall be sent to whom? All members. In case of deceased members, legal representatives. In case of insolvent members, assignee, official assignee, and to all the auditors and directors of the company. Next one, for section 8 companies, yes, it's not 21 days, it's 14 days, 14 clear days, provided it has not committed any default under section 137(92). Omission, important part, omission. Now omission, if it is intentional omission, now tell me, is that notice valid or invalid? Invalid. If notice is invalid, proceedings held at general meeting, enforceable or not enforceable? Not enforceable. If it is accidental omission, it will not affect the proceedings happened at the meeting. Next one, meetings held at shorter notice. Shorter notice means what? For section 8 company, less than 14 clear days. For other companies, less than 21 clear days. So shorter notice is valid only with the consent of the members. How much consent? If it is AGM, 95% of members entitled to vote. Who? 95% of members entitled to vote should give consent for shorter notice. Suppose in my company, 1000 equity shareholders are there and 500 preference shareholders are there. Okay, now 95% consent means whom I should consider? I should consider only equity shareholders, because preference shareholders generally not entitled to vote at AGM. So 95% of 1000, it's not 95% of 1500. It would be 95% of 1500 when preference dividends not paid for 2 years or more consecutively. Clear? Next one, other than AGM, that is EGM. EGM with respect to companies with share capital, two conditions to be satisfied. One is majority of members holding at least 95% of paid up share capital shall give right to give consent for shorter notice. Whereas it is a company without share capital, and if it is a EGM, then members having at least 95% of the voting power. Other than AGM, the general meeting is known as AGM. The other name for AGM is, it's a meeting between two AGMs, or it is a meeting where only special business items will be transacted. Okay, now everyone. Next point. For AGM, whether it is a company with share capital or without share capital, immaterial. All members will get equal rights. 95% of members entitled to vote should give consent for shorter notice. Next one. Authority to call general meeting. Okay, contents you all know: day, date, time, place, and agenda. Authority. Who is having authority to call for general meeting? Board of directors. Board resolution is compulsory. Suppose without board resolution, company secretary fixed day, time, place, and agenda of general meeting, and company secretary issued notice calling for general meeting. Now tell me whether this notice valid or invalid? Invalid. But if it is ratified by the board, then it becomes valid. Mode of sending notice you all know. It can be manual or it can be registered. It can be electronic mode. In case of electronic mode, comply with these conditions. Subject matter, what should be the subject line? Company name, meeting type, date, place. Next one, notice shall also be placed on company website. Ensure that emails are sent via secured programs. Email failure beyond company's control absolves liability. That means what? Is this an accidental omission or intentional omission? Tell me, is this accidental omission or intentional omission? Accidental omission, because beyond the company's control. Next one, email shall be sent to the persons entitled to receive it as per the company records provided by the depository. The company must also give members an opportunity of at least once in a financial year. What is the frequency for updation of mails? What is the frequency for updation of email IDs? Once in a year. One attempt, this question asked for 2 marks. I think 1 mark MCQ or maybe 2 marks. Not sure. But the point is, frequency of updation of mails, it is given to the members whose mail ID is not yet registered. And what is the frequency? Once in a financial year. Next one, notice is sent by post. It will be considered served 48 hours after the letter is posted. Explanatory statement. Tell me, when explanatory statement is required? For all ordinary business items, only for special business items, special business items. First of all, what is a special business item? It is an item other than ordinary business. What is ordinary business? 4 matters: adoption of financial statements, CFS, board report, audit report. Declaration of dividends, appointment of directors in the place of those retiring one. Next one, appointment of auditor and fixation of the remuneration. In these 4 cases, explanatory statement not required as per Companies Act 2013. Remaining cases, explanatory statement is required. In that explanatory statement, along with justification, you need to disclose the interest of directors, manager, KMP and their relatives in the proposals. In the proposals, you have to disclose the interest of simply KMP, directors, managers or their relatives. Non-disclosure, if they get any benefit, can they enjoy with the benefit? No. For that benefit, they will be called as trustee. Trustee can see the property, but trustee can't enjoy with the property. What trustee should do? Trustee should return that property to the company. Along with that, these people will get punishment. What is the punishment? Penalty or fine. How much? 50,000 rupees or 5 times of the benefit accrued, whichever is higher or lower. Higher or lower? Tell me, whichever is higher. 50,000 or 5 times of the benefit, whichever is higher. And if a company is entering into a contract with another company which requires members' approval, in that another company, if our promoters, directors, managers, if they had any holding less than 2% of paid up share capital of the second company, disclosure is not required. Tell me, when disclosure is not required? Less than 2%. If it is 2% or more, extent of shareholding shall also be disclosed. And you need to mention time and place for inspecting the documents, because all these items comes under related party transactions. So we should ensure that these related party transactions are happening at a arm's length price. What is arm's length price? It's a price between unknown buyer and unknown seller. Is it clear? It's a price between unknown buyer and unknown seller. So in between related parties, definitely price might be influenced. But in company, who are the beneficiaries? Members are the beneficiaries. But who are entering into the contracts? Directors are entering into the contracts. If directors are getting benefited, it would be at the loss of members only. Clear? Materiality concept, very important, 2% remember. Next, quorum of the meeting. So tell me, what is the quorum? So small change in the material. The change is AOA may prescribe higher number for quorum. Higher number for quorum. Okay na? Everyone? Now tell me, what is the applicable quorum for the companies? For private companies, minimum 2 members personally present. For public company, 5, 15, 30. When 5? Up to 1000 members. When 15? 1001 to 5000. When 30? Above 5000. That means 5001 and above. Okay na? Half tickets not possible. In bus, half tickets possible. But in company, half tickets not possible. Why? Minor cannot hold shares directly in his name. Through guardian, minor can hold shares. That too fully paid up shares, not partly. Why? Minor is not liable under any agreement. Minor is not liable. Minor's liability is not enforceable, first of all. That means minor can acquire shares through guardianship provided those shares are fully paid up. Example, suppose I'm holding 10 shares of Reliance Industries Limited. I want to transfer these shares to my daughter who had not yet got contractual capacity. Now, who holds those shares on behalf of my daughter? I, as a legal guardian. Okay, what is the time limit for checking quorum? Within what time quorum should be present? 30 minutes of commencement of the meeting. Schedule from the schedule time, 30 minutes, half an hour. Who check quorum? Chairman. If there is no quorum, then what would be the effect? You have to observe whether it is a general meeting called because of requisitionista or others. General meeting called because of requisitionist, sir. EGM called because of requisitionist. Then meeting stands cancelled. Then meeting stands cancelled. Other meeting stands adjourned to the same day, same time, same place in the next week. Clear? Next one. If quorum is not present at adjourned meeting, then whoever present shall form the quorum. Tell me, one member quorum, allowed or not allowed? Not allowed. But in one case allowed. In which case? If, no. If meeting is called because of NCLT order. Under 97 or 98, NCLT is ordering for a meeting. In that meeting, whether member personally presents or member presents in proxy capacity, so both the cases, one member quorum would be valid. Also, if 100% capital is held by one person, for example, company issued preference shares, 100% of preference shares held by me. Now company is conducting a class meeting, not general meeting, class meeting for preference shareholders. Who can attend the general meeting? Only preference shareholders. I am only preference shareholder. Now if I attend the meeting, no need to check the quorum. Okay, na? And one more thing, in regular class, I didn't stress this point. The point is, if all alive members attends general meeting, I repeat, all alive members attends general meeting, then it would constitute quorum. For example, in a public company, what is the minimum quorum? 5. In a public company, minimum number of members is 7. So applicable quorum is 5. Imagine out of 7, 4 members died in an accident. Of course, we are having 6 months time to increase that number. But within these 6 months, yes, general meeting has been called, and to this general meeting, only 3 members were personally present. What is the required quorum? 5. But how many attended? 3. It is not possible to bring deceased person alive. It is not possible. That's why these 3 members personally present shall constitute quorum, even though the 3 is less than 5. That's what I am telling you. If all alive members attends meeting, they constitute quorum. Now tell me next one. Representative of a body corporate, representative of a president, representative of a governor. Considered for the purpose of quorum or not considered for the purpose of quorum? Considered. They are deemed to be members of company. They can exercise all the rights as if they are members of the company. Next one. Chairman in the meeting. Tell me, if AOA is silence, who can be chairman of the meeting? Members personally present shall elect one among themselves to act as a chairman. And that election can be conducted either under show of hands or through poll. Suppose show of hands over, X has been appointed as chairman. Now members demanded for poll. Now immediately conduct poll. You remember the time limit for conducting of poll. What is the time limit for conducting of poll? Immediately for adjournment of meeting, appointment of the chairman. So until another chairman got appointed under poll, the chairman appointed under show of hands will be the in charge of the meetings. Okay, now what are the responsibilities of chairman? He maintained decorum at meeting. Next one, he finalized the minutes, he signed the minutes, he announced the results of the resolutions, everything. Next one, casting vote. Tell me, casting vote, is it a additional voter or existing voter? Additional vote available to the member, second vote of the member. When casting vote is available, in case of OR, yes or in case of OR, when there is a deadlock, like votes in favor is equal to votes against, yes, casting vote right comes. Who can exercise casting vote? Chairman. But for that For that AOA authorization required or not required? Required. AOA silence, resolution is said to be dropped. So definitely company AOA authorizations, company AOA articles of association specifically allow it. Okay now. Next, proxy. Who is proxy? Representative of a member to attend the general meeting. In the entire proxy, first of all tell me what are the advantages available to proxy? He can attend general meeting. He can also demand poll. He can also exercise voting rights under poll. Then what are the limitations? Limitation factors of the proxy. Counted for quorum or not counted for quorum? Not counted. Not counted. Can he speak at meeting? No. Can he cast voting rights under show of hands? No. And the biggest limitation factor, he cannot represent members exceeding 50. Max he can represent 50 members. Or he can represent 10% of the paid up share capital holders, whichever is less. Are you getting my point? But if any single member is holding more than 10% of the paid up share capital, that member can appoint one person as a proxy, and the appointed proxy shall not represent other persons. Okay, now 3 days back we discussed these concepts. Retention capacity is very important. Cycle is important. Which cycle? Retention cycle. Next one. Who can be a proxy? Who can be a proxy? Any person, even a non-member can become proxy. Whereas for Section 8 company, proxy should be a member of the company. Next one. To which companies proxy benefit is available? To all companies proxy benefit is available, but proxy benefit is not available to companies without share capital, provided AOA is silent. Suppose if AOA allows proxy in case of company with share capital, then they also had a benefit of proxy. Okay now, next one. Proxy limitations I told. Maximum he can represent 50, or he can represent 10% of the voting power, that means voting share capital. Any member holding more than 10% of the share capital can have one proxy, but the appointed proxy cannot be proxy for others, cannot act as a proxy for others. Next proxy benefit available to member. How member knows about this benefit? Through notice only. If company makes any default in disclosing this benefit in the notice, then you know that responsible person, that the responsible officer will get a punishment. What is that punishment? 5,000. 5,000 for non-compliance with proxy disclosures in the notices. Next, in proxy we had total 3 time limits. How many time limits? 3. What are those 3 limits? So for the valid appointment of proxy, proxy form should be deposited at least 48 hours before meeting. 48 hours before commencement of meeting, before meeting start time. This is what? Deposit of proxy form. Deposit of proxy form. Now for inspection of proxy forms, a member is entitled to inspect proxy forms, but for that he need to deposit his intention of inspecting proxies. So that notice shall be filed at least how many days? Notice of inspection shall be filed at least 3 days before meeting, and that inspection will be carried out immediately. That inspection carried out immediately. No, that inspection starts before 24 hours. Before 24 hours of commencement of meeting, and it ends with a conclusion of meeting. Remember 3 time limits. Notice of inspection 3 days. Deposit of proxy form 48 hours. Notice inspection of proxy forms 24 hours before commencement of the meeting. It concludes with the conclusion of the meeting. Inspection will be end with the conclusion of meeting. Next one. Appointment of proxy. Is it a benefit available to the member? Yes or no? Complete freedom or restricted freedom? Complete freedom. Any person can choose any other person to become a proxy of him. Member can choose any person he need. But if that member is not sure to appoint which person as a proxy, then that person can request company, so I need a list of persons willing to act as a proxy. Apart from this situation, if company sends any invitations to appoint proxies, in that case the defaulting officer will get a punishment of 50,000 rupees. Okay now, everyone, voting rights restriction. Tell me, when voting rights will be restricted? If member has not paid calls, or if member is having some dues to the company. Company exercised lien right over the shares. Only in these two cases, voting rights can be restricted. Other cases, company had no right to restrict voting rights. Okay na? Okay na? Next one. But for this also, AOA authorization is required. If AOA is silent, or if AOA permits members to cast voting rights irrespective of calls in arrears, then also they can exercise voting rights even with calls in arrears also. In case of joint shareholding, tell me, in case of joint shareholding, who cast vote? Who will cast vote? Senior member. Senior member means in the share certificate you need to observe the order. The senior most person who attended the meeting can cast vote. How many types of voting we are having? 4. Show of hands, poll, postal ballot, electronic voting. Show of hands, electronic voting, poll, postal ballot. Show of hands. What is the specialty of show of hands? Every member equal voting rights. Every member differential voting rights. Equal. One person, one vote. That's it. Sir, I am holding 1000 shares, sir. One vote. You are holding one share, one vote. So under show of hands, which one will act as an evidence whether resolution is passed or not? Declaration in minutes. Whose declaration in minutes? Chairman's declaration in minutes is a conclusive evidence whether resolution is passed or not. Can an installment member exercise vote under show of hands? Yes, if name is available in register of members. If name is still available in register of members, he can exercise voting rights. But dividends are paid to whom? Official assignee or trustee. Any person, in case of insolvency, court appoints official assignee who can also be a trustee. So that person receives dividends, and that person utilizes dividends for repayment of loans. In e-voting only 2 points important. E-voting 2 points important. Applicability exempted. Applicability exempted. Tell me, e-voting is applicable to which companies? All listed companies, or companies whose equity shares are listed on recognized stock exchanges. Second one is companies having 1000 or more, greater than 1000. 1000 members or more. That means even if a company is having exact 1000 members, e-voting is mandatory. If e-voting is mandatory, then show of hands can't be applied. Show of hands is not applicable if e-voting is applicable. Okay, fine. Next, exempted. Who are exempted from e-voting? Nidhi companies exempted. I told you to remember easily. 1000 or more members. For that, exemption is Nidhi. Next, for listed company, exemption is SME. Companies whose securities listed on SME trading platforms, institutional trading platforms. Okay, na? Everyone. An important point in e-voting is cutoff date. Cutoff date should not be older than 7 days before event. It should not be older than 7 days before general meeting. Procedure, just give one time reading. Procedure, here, who appoints scrutinizer? Small questions. Who appoints scrutinizer? So that scrutinization of e-voting happens. Board of directors. Who is scrutinizer? Independent person who scrutinizes voting process. Independent person means employee, outsider. Outsider. Maybe a CA, CMA, CS, or any advocate. Okay, fine. Now, you are following e-voting. This matter, how members know about this? How members know about this matter? Only through notice. In notice, clear-cut disclosure of e-voting should be done. And e-voting is of 2 types. How many types? 2 types. One is remote e-voting, other one is e-voting. Remote e-voting, second one is e-voting at AGM. E-voting at AGM or e-voting at EGM. Now the point is, remote voting shall be open for minimum how many days? 3 days. Ends with 5 p.m. on the day before meeting. And e-voting at AGM, it is applicable to all persons. Only persons attended the meeting. Only members attended the meeting is also wrong answer. Only members attended the meeting and who have not exercised voting under remote e-voting. Okay, na? Sir, a person already exercised voting rights under remote e-voting, attended the meeting. Can he be considered under quorum? Can he be considered as a part of quorum? Yes, counted for the purpose of quorum. But he cannot exercise voting one more time at general meeting. and to that general meeting he is not entitled to appoint a proxy, because proxy, who can appoint proxy? Two conditions to be satisfied: member who is entitled to attend and vote. If these two conditions are satisfied, then only he can appoint a proxy. Clear? All these are interconnected. Next one, publication of notice at least 21 days before the meeting. Scrutinizer, qualifications of the scrutinizer: he should not be an employee. He can take help from a non-employee expert familiar with the electronic voting system. And e-voting results announcement, to unblock remote e-voting, it requires a scrutinizer plus 2 independent witness who will also sign scrutinizer report. And within 3 days of completion of the AGM general meeting, prepare a consolidated scrutinizer report and file it with chairman announce the results. Next one, poll. In poll only one point is important, demand for poll. First, who implements poll? Chairman, either on suo motu basis or demand by specified persons. Here specified persons means not only members but also proxy. There is a practical question, where members and proxy demanded for poll. Chairman rejected the poll because proxy had no right to demand for poll. Do you agree with chairman? Answer is no. Member is also entitled to demand for poll. Proxy is also entitled to demand for poll. But to demand for poll, they should have a status. What is the status? At least 1/10 of the voting power or paid up share capital 5 lakhs. Any condition satisfied, they can demand for poll. For other companies, ignore paid up share capital. It is at least 1/10 of the voting power. And one more important point you need to remember. Yes, the persons who demanded poll can withdraw poll at any time. But the point is, sir, already show of hands conducted, resolution declared. Now when poll can be demanded? Either at the time of declaring the result or before declaring the result. After declaring at the time of declaring the result also you can demand for poll. Once poll is demanded, the resolution passed under show of hands is invalid. If poll is withdrawn, once again pass resolution through show of hands only. Next one, another important point: who appoints scrutinizer in poll? Chairman. For e-voting, for postal ballot, tell me, for e-voting, postal ballot, who appoints chairman? Board of directors. Who appoints chairman or scrutinizer? I told you. Who appoints scrutinizer? Board of directors. Whereas for poll, who appoints scrutinizer? Chairman. Next, procedure, just give one time reading, nothing new, no points are new. And this time limit also you remember. Scrutinizer submit a report in form MGT13 within 7 days from the date of poll. Next, postal ballot. In postal ballot, 3 points remember: mandatory postal ballot, optional postal ballot, prohibited postal ballot. Mandatory postal ballot, for 10 items. For these 10 items, mandatory. Optional, any other matters also, if you want, you can discuss through postal ballot. But 6 items are prohibited under postal ballot. What are those 6 items? Ordinary items, all ordinary 4 items. Next, matter where auditor is having a right to be heard, like removal of auditor. Next one, matter where director is having a right to be heard, nothing but removal of director. All these 6 matters you can't discuss, you can't pass resolution through postal ballot, only through meeting, only at meeting. Now postal ballot can be conducted in 2 ways: manual mode, electronic mode. If you are following manual mode, 110 is applicable. If you are following electronic mode, 110 plus 108 also applicable. Sir, how 110 is applicable? Postal ballot can be exercised within how many days? 30 days of dispatch of postal ballot notices. So that means if you are following electronic mode for postal ballot, that electronic mode of voting, that remote e-voting shall be open for how many days? 30 days. Clear, everyone? You remember these points, that's it. One more point, notice shall specifically mention the point that if any person is sending postal ballot paper after 30 days, it will be considered as invalid. It is considered as if that member has not casted the vote. Next one, circulation of members resolution. For this, remember the eligibility criteria. If your time is too bad, a question can be asked on this point also, because so far this point not yet tested. So if your time is bad, question may come on this. In this question, you have to remember criteria. What criteria? Who can file a requisition? Who can file a notice? Who? In case of company with share capital, members holding at least 1/10 of the paid up share capital. In case of company without share capital, members holding at least 1/10 of the voting power. And what is the time limit for deposit of members resolution or members statements with a company? And the time limit is, if member is intending to pass a resolution at general meeting, it should be deposited at least 6 weeks before date of general meeting. No sir, just a statement to discuss sir. At least 2 weeks before date of general meeting. Okay na? Okay, fine. Good. Next point. Suppose after deposit of members resolution copy, company issued notice calling for general meeting. Now period of 6 weeks. Required or not required? Not required. Next, special resolution for versus ordinary resolution. If your time is too comedy, a question can be asked on this matter. Too comedy. So differences between resolutions ma. Ordinary, tell me, 2 conditions to be satisfied. Special, 3 conditions. Ordinary 2 conditions, notice section 101 shall be complied. Votes in favor greater than votes against. Special 3 conditions. Same 2 conditions ma. Notice should be valid. Votes in favor greater than or equal to 3 times of votes against. The third condition is, notice for general meeting or any other communication to members must clearly state the intention to propose resolution as a special resolution. Disclosure is required. This is a additional condition you have to check. Suppose if this condition is not satisfied, then that special resolution passed at general meeting is not enforceable. Can I proceed? Okay. Special notice. Who sends notice to whom? Company sends notice to the members. What is the length of the notice? At least 21 days. But if any member, if he is thinking that existing auditor should not be reappointed, existing director should not be reappointed, or appointment of another person as a director in the place of retiring director, appointment of another person as an auditor in the place of a retiring auditor, in that case, members satisfying criteria. What is the criteria? 1% of the voting power or 5 lakhs paid up share capital. Either of these conditions satisfied, that person can send special notice to the company. And what is the time limit for sending special notice to the company? At least 14 days. Ma, in special notice, remember 3 time limits ma. It's multiples of 7. 7 threes. Take calculator, calculate 7 threes. Sure? Pakka? Can I lock it? 7 threes 21 only, not 22, not 20. Okay, fine. 21 days for what? Examination. 21 days for notice. 7 twos 14 for what? Sending special notice by members to company. 7 days for circulating the special notice company to other members. And I told you in Audit and Auditors chapter, before sending this notice to the other members, if company receives any written representation from the retiring auditor, the same shall be attached to the notice. Yes or no? So in this section, 2 conditions important. One is, what is the criteria for sending special notice, and what is the time limit for sending special notice? What is the criteria? 1% of the voting power or paid up share capital 5 lakhs. Ma, do you think only single person should hold all this? No. Either single person or group of members who are planning to issue special notice. Next one, 7 days notice not possible sir. Then advertise it in 2 newspapers. That's it. Also publish it on the company's website. Next one ma, resolution passed at adjourned meeting. Resolution passed at adjourned meeting. Tell me, what is the effect of resolution passed at adjourned meeting? When it is effective, I'm sorry. When a resolution passed at adjourned meeting is effective, is it from date of original meeting? Is it from the date of adjourned meeting where resolution has been passed? Adjourned meeting. The resolution is said to be effective not from the original general meeting date. It is effective from the date of adjourned meeting where resolution has been passed, not earlier date. If your time is too tricky, this point will come in the examination. 2 marks MCQ. They may give you dates. Original date 20th September. Adjourned date 27th September. Now with respect to the resolutions passed at adjourned meeting, they are effective from 27 September onwards. That's what, if you observe adopted financial statements at adjourned meeting, those adoption will be valid not from original general meeting date. It is enforceable from adjourned meeting. That's why they ask you to file adopted financial statements within 30 days from adjourned meeting, not original meeting. Next, filings with ROC. Tell me, what should be filed with ROC? All special resolutions, all class resolutions, agreements with managing director, whether appointment or reappointment or modification or variation or whatever it might be. Next one, board resolutions with respect to exercising borrowing powers. Next one, resolution for voluntary winding up. Resolution for voluntary winding up. All these shall be filed with whom? ROC. So note point here, I need to mention one more point. The point is form, applicable form is what? Applicable form MGT 14. And what is the time limit for filing these forms? Time limit is 30 days. 30 days of resolution or agreement. Okay na? Next one, exemptions. Exemptions to whom? Banking, housing finance, NBFC. Not from this section. Not from this section. Exemption is with respect to resolution passed under 179 subsection 3. So remaining resolutions, even it is a banking company or non-banking company, everyone should file a copy with ROC within how many days? 30 days. Can I proceed? Next, minutes. Minutes. Applicable to all companies where meetings have been conducted. 1 minute for all meetings, 1 minute for general meeting, 1 minute for board meeting, 1 minute for creditors meeting. I mean 3 I told you, right? 3 members, directors, creditors. So 1 minute for all these 3 separate minutes, separate 1 minute for each. 1 minute for each. Okay. Minutes shall contain fair and correct summary of the proceedings of the meeting. Only important points I will highlight. Minutes shall contain fair and correct summary of the proceedings of the meeting. And within how many days minutes shall be finalized? Within 30 days of the meeting or resolution in the books. And those minutes shall be consecutively numbered. For board meetings, committee meetings, important point for board meetings, committee meetings, minutes shall also contain the details of directors present. The details of directors who are against to the proposal or who are not giving consent to the proposal. That means those who are giving acceptance to the proposal. Those who are giving acceptance to the proposal, those director names to be included in the minutes or not to be included in the minutes are not to be included. Whose names are included? Only who have exercised voting against to the resolution or not giving consent to the resolution. Next one, all the appointments made at the meeting, yes, you have to incorporate that information in the minutes. So minutes shall contain fair and correct summary of the proceedings happened at the meeting. All appointments happened at the meeting. And exclusion from minutes. What can be excluded? Defamatory content, irrelevant immaterial content, detrimental to the company interest. But this is absolutely at the discretion of chairman. Chairman has absolute discretion in deciding what to include, what to exclude from the minutes with respect to above matters. Legal presumptions, yes, minutes is an evidence of the proceedings. Valid meeting and resolutions are presumed unless proven otherwise. All appointments are valid unless proved otherwise. So can a company circulate minutes? Not required. But any person requests for minutes, send a copy of it by charging a nominal fees. Soft copy, it is available up to 3 years. Last 3 years minutes can be sent upon written request. Any charge? No charge, because soft copy. Non-compliance, company 25,000, officer in default 5,000, tampering of minutes, imprisonment up to 2 years and fine 25,000 to 1 lakhs. Now where minutes can be kept, minutes of members meeting should be kept at registered office and preserved up to 8 years or permanently. Whereas board meetings, committee meetings, either at registered office or another location decided by the board. Clear? Next one. Inspection of minutes, yes, any member can inspect minutes at free of cost only during working days, that too during business hours. And company should allow minimum 2 hours for inspection each business day. Responsibilities, if your time is too bad, a question can be asked on this point. Responsibility for maintenance and security of electronic records. Whose responsibility? MD, CS, director or officer. Okay na? In the entire minutes part, one more point is very very important. That point is signing of minutes ma. Signing of minutes. Board meeting minutes signed by the chairman of the present board meeting or next board meeting. General meeting minutes signed by the chairman of the meeting or director authorized by the board within 30 days of general meeting or resolution passed through postal ballot. That means this point is applicable to next one also. Signed by the chairman of the board or authorized by the director within 30 days of the resolution passed through the postal ballot. Clear? Signing, generally signing, when it should be done? Within 30 days. But if minutes belongs to board or if minutes is related to committee meetings, then 30 days time limit is not there. Why? It can be signed by the chairman of the present meeting or it can also be signed by the chairman of the next meeting. Next meeting can be conducted within 3 months or within 2 months. So with respect to board committee meeting minutes, signing within 30 days not applicable, whereas for general meetings, postal ballot resolutions, signing should be done within 30 days. So I told you, right, whose responsibility to maintain electronic records? MD, CS or any other director or officer designated by the board, and he should observe all these conditions are satisfied or not, like protecting records from unauthorized access, preventing data loss, ensuring backup is there or not, ensure that only signatory, ensuring that signatory cannot deny the validity of the signed electronic records. Authenticity means validity. Maintain secure and validated computer system software. Ensure system can detect invalid records, altered records. Maintain records in accurate, accessible and reproducible manner. Non-rewritable, non-erasable format. And backup. What is the frequency of the backup? Once in a day. Daily backup is compulsory. Access should be restricted. Access is restricted to only authorized person. Access is not given to all the persons. Here access is limited to the authorized persons. Physical, ensure that conversion from physical into electronic records and organize and index records, take necessary security measures to ensure integrity and confidentiality of the records. Okay, last concept, types of general meeting. How many general meetings we are having? 2 types, AGM, AGM. What is the time limit for AGM? So first we need to observe which AGM, first AGM, subsequent AGM. First AGM shall be held within 9 months from the closure of first financial year. Is it compulsory to conduct AGM in the year of incorporation? No, not required. Next, the subsequent AGM shall be held within 6 months from the closure of financial year, and the maximum gap between 2 AGMs are 15 months. The gap between 2 AGMs shall not exceed 15 months. Tell me which AGM can be extended, first AGM or subsequent AGM? Subsequent AGM. For that, whose approval is required? ROC. Up to how many months ROC can grant extension? So board of directors filed an application for extension of first AGM. Whether ROC had power to extend first AGM? No. Time and place of AGM. Tell me, time and place of AGM. Time. Commencement time should be during business hours, 9 to 6. And place, either at registered office or at any place in the city, town, village where registered office is situated. But yes, they had exemptions, unlisted company with the consent of all members are 95% members are all members. With the consent of all members, AGM can be conducted at any place in India. For Section 8 companies, yes, time of meeting, last attempt, January attempt, question came on this point. AGM of a Section 8 company can be pre-decided, that is at previous AGM itself. Time, date, place, everything can be decided by the members in the AGM, and board of directors will also fix it. Government company, for government company, place of AGM relaxation is there. Central government can fix any other place for AGM of government company, provided government company has complied section 137 or section 92. Next one, if 96 not happened, 96 means what? AGM as by company not conducted, then any member holding single share can file application. Then tribunal either it will call for a general meeting or it directs company to call for a general meeting. Any general meeting conducted because of tribunal order is deemed to be a valid general meeting. That means 97 is equal to 96. Effect of 97 is equal to 96. An AGM under tribunal direction as per section 97 subsection 1 shall be deemed to be an AGM of the company subject to the directions of the tribunal. I told you. Next one, 98 is also equal to 96. What is 98? EGM by NCLT. So if it is impracticable to call for a general meeting because board of directors are not there or there is a deadlock, I told you to fix date, time, place and agenda of general meeting, board resolution is compulsory. Board resolution means votes in favor greater than votes against. Votes in favor greater than votes against. Suppose votes in favor is equal to votes against. This is the situation. 5 directors want meeting, 5 directors don't want meeting. There is a deadlock. Now any director can file an application to the tribunal. Sir, please call for a meeting. Or a member can file an application for calling for general meeting other than AGM. Or tribunal on suo moto call for AGM. Now any AGM conducted as per tribunal orders, it is valid general meeting. Even a single person attends the general meeting. Okay, now punishment for default 1 lakh rupees plus 5,000 per day for each day such default continues. Both company and office are in default, same punishment. Next, EGM. EGM, if it is called by board of directors, I repeat, EGM if it is called by board of directors, it can be conducted on any day including national holiday. AGM, no on national holiday. EGM, any day on national holiday also. Any time, need not be 9 to 6. Any place in India. But if you are a company which is subsidiary to company incorporated outside India and not normal subsidiary, wholly owned subsidiary, that means 100% of capital is held by outside person, then in that case EGM can also be conducted outside India. Getting my point? EGM can be conducted at any place in India, but for a company which is wholly owned subsidiary to another company which got incorporated outside India, this company can conduct EGM at any place outside India. In one attempt, the question is like this, the question is like this. A Limited is an Indian company. A Limited registered in Delhi. Registered office is at Delhi. It is having a subsidiary B Limited. B Limited is registered in Singapore. Now can A Limited conduct EGM in Singapore? B Limited, 100% paid up share capital is held by A Limited. 100% capital is held by A Limited. Now can A Limited conduct general meeting in Singapore? No, because we need to check reverse. That means what? Suppose if B Limited is an Indian company which is subsidiary to A Limited and A Limited is outside India, 100% of capital is held by A Limited, then B Limited EGM can be conducted outside India. Exactly reverse they asked for 3 marks. Reverse they asked for 3 marks. So don't get confused. Even IFSC companies also, they can conduct meeting at any place either in India or outside India with the consent of all members. Now next one, EGM by directors based on requisition. Now tell me who can file requisition? Members holding at least 1/10 of the paid up share capital with voting rights. If it is a company without share capital, then members holding at least 1/10 of the voting power. That's it. Now once company receives requisition, company should make all arrangements in calling general meeting within 21 days from the receipt of valid requisition, and EGM shall be held within 45 days. How many days? 45 days. Suppose if board fails to call meeting within 21 days, or if board fails to conduct meeting within 45 days, failure to call within 21 days, failure to conduct within 45 days, then who can conduct EGM? Members can conduct EGM. Within how many months? Within 3 months of requisition. Of course, for that, they are entitled to receive register of members and they are entitled to send notice to the members at least 21 days before meeting. Only one important point you have to remember, whether explanatory statement required or not required here. Explanatory statement generally required for special business items. But if it is a EGM because of requisitionist, if it is a EGM because of requisition is? Tell me. Explanatory statement, mandatory or not mandatory? Not mandatory. And what are all the expenses incurred for conducting this EGM by requisition is? Company will reimburse reasonable expenses. And company will deduct that expenses from the remuneration of the directors. Clear? Next one, report of AGM. Applicable to all companies or listed companies? Listed companies. Within how many days they should file report on AGM? 30 days. And that contents, if you look at the contents of the report of AGM, you know, it's all about a day of meeting, time of meeting, place of meeting, everything. Quorum present or not. Postponement. Regarding postponement. Next. Punishment you can see. Next one, relaxation to one person company. Relaxation to one person company you can see. So which provisions are exempted to OPC? 98 and 100 to 111. All these are exempted. Minutes also required only if there is more than one director. For member meetings, minutes not required. For board meetings, minutes required only if there is more than one director. And this is section 20, already covered in Incorporation chapter. So with this, management and administration completed. Let's continue revision with the next chapter, chapter 8, declaration and payment of dividend. In this chapter, we are having only 5 sections, 123 to 127. And coming to the concepts, sources for payment of dividend, time limit for deposit of dividend, time limit for payment of dividends, companies prohibited from payment of dividends, transfer to unpaid dividend account. Next one, transfer to IEPF. Next one, IEPF authority. Last one, punishment if dividends are not paid within the prescribed time period, that is 30 days. But in this also one important concept, payment of dividends in case of absence of the profits or inadequacy of the profits. That is most important. So these 7 concepts are very, very important. Let's see. First of all, dividend means, is there any definition to the dividend? Yes, there is a definition to the dividend. Dividend includes interim dividend. That means what are all the provisions that are applicable to final dividend are equally applicable to interim dividend. But the only difference between final dividend and interim dividend, if you observe, final dividend is something recommended by board, approved by the members at the AGM. Interim dividend is recommended by board of directors and approved also by board of directors. Getting my point? Interim dividend recommended and approved by board, whereas final dividend recommended by board, approved by members at AGM. So it's a dividend between 2 AGMs. I can also call like this. Next one, sources for interim dividend. What is the source for interim dividend? The source is opening balance of profit and loss account. Opening balance of profit and loss account. The second one is profits of the financial year to which interim dividend relates to. Suppose I am declaring dividend on 30th April 2025 and this interim dividend belongs to financial year 24-25. I can utilize financial year 24-25 profits. Suppose I am declaring dividend on 31st January 2026. In that case, I can utilize profits up to Q3 of financial year 25-26. Why Q3? What is the immediately preceding quarter? What is the immediate preceding quarter? The preceding quarter is immediate preceding quarter is 31st December 2025. So I can utilize quarter preceding the declaration date, or I can utilize profits of the current year, or I can utilize surplus in the, that means opening balance in the profit and loss account. And you know, interim dividend is recommended and declared by board of directors. Finally, ratification will happen at AGM. So do you think members ratify at AGM? Obviously. Why? They already claimed that amount, they already spent that amount, so ratification is inevitable. Suppose sir, members are not ready to ratify, sir, in that case members should return interim dividend to the company. Getting my point? So definitely they will ratify it. Interim plus final dividend, consolidated basis, they will pass one ordinary resolution. Next one, yes, preference dividends, 2 types, cumulative, non-cumulative. What is the difference between cumulative preferentials, non-cumulative preferentials? And what is the similarities? The similarity is for both preferentials, whether it is cumulative or non-cumulative, in the presence, you know, if profits are there, if profits are sufficient, we pay dividends. If profits are not there, profits are insufficient, then we don't pay dividend to both cumulative preference shareholders, non-cumulative preference shareholders. Getting my point? But what is the difference? In case of cumulative preference shares, if dividend is not paid in this year, that dividend amount will be added to the next year dividend dues. So cumulation is possible. Name itself is telling cumulation is possible. Current year, if we are not paying dividends, that amount will be added to next year dividends. Cumulation is possible. Whereas for non-cumulative, upon expiry, upon completion of year, that amount will also get expired. No cumulation. Clear? Everyone. For preference shareholders, dividend is predetermined. At the time of issue only, dividend rate will be fixed. Whereas for equity shareholders, dividend will be recommended by board every year. The rate need not be same. And finally approved by members at AGM. So that approval, that recommendation will not be there in preference shareholders. But the point is, who will be paid first, sir? To whom dividends will be paid first? Preference shareholders, because they carry preferential rights. Next one, sources of dividends. Tell me, how many sources are available for declaration and payment of dividends? 3 sources, but 1 and 2 combination, so total 4 sources. First one is current year profits after providing for depreciation. Second one is undistributed previous financial year profits after adjustment of depreciation. Both, that means current year inadequate, sir, current year insufficient, sir, then whatever amount is there in current year plus undistributed profit of previous years you can utilize. That means combination of both. Next one, money provided by the central governments or state government in pursuance of a guarantee given by the government. So any funds given by the government in pursuance of guarantee. That means government is giving guarantee to the investors. You make investment in this company, company will pay dividends regularly. If company is not having money, we will give funds to the company and company will pay dividends out of those funds. That means guarantee assurance. So these 4 amounts can be utilized. Actually how many? 3. What are those 3? Current year profits, previous year accumulated profits, both after adjusting depreciation. Next one, money provided by the CG. If current year profits are inadequate, then I can also utilize current year profits and previous year accumulated profits. That is what combination. Next one, very important. Tell me, is there any condition on company to transfer certain portion of profits to the reserves before declaration and payment of dividend? No. Transfer of profits to the reserves is completely discretionary powers of the directors. If they want, they can declare 100% profits in the form of dividends. Okay, na? Next, coming to the free reserves. Free reserves are the reserves that are available for dividend distribution. So how to calculate free reserves and what are the items excluded from the free reserves? Let's see. Free reserve means reserve available for dividend distribution as per latest audited balance sheet of the company. But while calculating free reserves, revaluation reserve shall be excluded. Fair value adjustments, any foreign current asset, any foreign current liability is there. As on 31st March, that means year closure date, if you are revaluing them, any reserve is created because of revaluation as on 31st March. Those revaluation reserves, foreign currency revaluation reserve and immovable properties revaluation reserve shall not be included in the free reserves. Clear? And one more important point, dividends are paid on face value or paid up value. Paid up value or face value? Face value if AOA is silent. If AOA authorizes company to pay dividend on paid up value, then dividend will be paid on paid up value. Clear? In that case, dividends on calls in advance possible or not possible? Suppose on face value, if you are considering face value, I am paying dividend on complete share. That means calls in advance will not play a role at all. Extra dividends on calls in advance, not at all possible. With respect to calls in advance, voting rights available or not available? Not available. Next one. So why we charge depreciation? You can see reasons. Very simplified, in a simplified form. Yes, I wrote this matter. Simplified form. Depreciation is a notional estimate. Is it a cash expense or non-cash expense? Non-cash expense. But why we are recording it, sir? At one point of time, due to these reasons, wear and tear, afflux of time, improvements in technology, we cannot use existing assets further. At the time, replacement is compulsory. For replacement, we should have funds. To have funds, we have to save funds over a period of time. When you are charging depreciation, what happens? Cash profit comes down. It's not cash profit. Profits of the company will come down. Are you getting my point? Profits will come down. Is it a cash profit coming down or book profit coming down or book profit coming down? That means that portion which was reduced, we are maintaining in the form of cash, in the form of assets. So once replacement is required, we utilize that money for replacement of asset. So in this way, going concern affected or not affected? Not affected. If depreciation is not provided, what would be the consequences? Asset value may be overstated. Profits of the company may be overstated. Next one, depreciation can't be provided according to your will and wish. Depreciation shall be provided only as per, come on, tell me, as per schedule, which schedule? Schedule 2. Depreciation shall be calculated, shall be provided as per schedule 2. Next, important, very very important concept, declaration of dividends in case of inadequacy of profits. Simple 4 conditions you remember. In fact, 2 conditions only, but internally 2 conditions come. Condition number 1, average rate of dividend. How many years average rate of dividend? Last 3 years. If company not paid last 3 years dividends, rule not applicable. Period of existence, suppose 2 years, average of 2 years only. Okay. Condition number 2, withdrawal limit. How much amount I can withdraw? It's 15% of paid up share capital plus free reserves. Next, condition 3, post withdrawal. Post withdrawal, free reserves should be greater than or equal to 15% of paid up share capital. That means I consider this as A. Next one, oh, just wait. It's not 15 actually, it's 10%. Maximum withdrawal is 10%, correct. Maximum withdrawal is 10%. I consider it as amount A. And post withdrawal free reserves balance shall be at least, that means it shall not fall below 15% of paid up share capital. So in equation form it would be like this, free reserves minus 15% of paid up share capital. This is B. Out of A or B, whichever is lower I have to take. Out of A or B, whichever lower I have to take. And from this, A or B, whichever is lower, from this first I need to adjust current year losses, including depreciation. Balance leftover or rate of dividend, average rate of dividend. Out of these two, whichever is less, only that amount I can pay as a dividend. One example, paid up share capital 100 crores, free reserves 25 crores, average rate of dividend, for example last 3 years, in examination, to kill your patience, they will give like this. For example, 2021 6%, 2022 8%, 2023 9%, 2024 10%, 2025 11%. Now which 3 years you have to take? First 3 years or last 3 years? You have to take this. In one attempt what they did, reverse they gave 25, 24, 23, 22, 21 like that. In that case first you have to take, you should not have to take last. Getting my point? So simply to kill you psychologically, not physically, to kill you psychologically, like these points they will ask you. So latest 3 years average means how much it is? 10%. Next one, based on this, let's see, average rate of dividend. What is condition number 1? 10%. Condition 2, 10% of 100 plus 25, that is 12.5 CR. What is 100? Paid up share capital. What is 25? Free reserves. Condition 3, free reserves balance should not fall below 15% of the paid up share capital. That's why 15% of paid up share capital, just insert figures. What is free reserve? 25 crores minus 15% of paid up share capital, that is 100 crores. So it would be 10 crores, right? 25 minus 15, 10. Now you observe 12.5 or 10, whichever is less means 10. Suppose current year losses, some 6 crores is there. Current year losses how much? 6 crores. So from this 10 you deduct 6 crores, balance would be 4 CR. So amount point of view you are having a 4, but rate point of view 10%. 10% on 100 means how much? 10 crores. Either 10 or 4, whichever is less, that means 4 crores is final. So that year how much dividend company can declare? 4% only. Understood? Now look at the point. Dividend rate less than or equal to latest 3 years average rate of dividend. Amount of profit shall not exceed, amount of withdrawal shall not exceed 10% of paid up share capital and free reserves. Set off losses from the current year, and after withdrawal balance of reserves shall not fall below 15% of paid up share capital. Exemption, yes, this is also very important part. This is also important part. To kill you second time psychologically, they may ask you this question. So this is a company in which 100% of capital was held by central government, and that company is not in profits, company is in losses. Company wants to declare dividends out of accumulated profits. So tell me the conditions for declaration of dividend, like that they may ask you. In that case, write conditions. Last you write the above conditions are not applicable to 100% government company. 100% government company means 100% of the capital held by CG or SG, partly by CG or partly by one or more ESG. Clear? Everyone. Next one, deposit and payment of dividend. What is the time limit for deposit of dividend? 5 days of declaration. And what is the time limit for payment? 30 days. 5 days from declaration, 30 days is also from declaration. Suppose this is the declaration date. Within 5 days, transfer amount to separate bank account. And within 30 days, payment of dividend should be done. If not, from here onwards, within 7 days, to understand this, let me write. So what is this? DOD. DOD means date of declaration. From here onwards, within 5 days, transfer to separate bank account. That means deposit of dividend should be done. And from here onwards, within 30 days, payment to shareholders, members or bankers of the shareholders should be done. Now this will be the center point. From here onwards, within 7 days, this is the center point, means what? 30 days is the center point. Within 7 days, transfer amount unpaid or unclaimed amount shall be transferred to unpaid dividend account. And when you transfer that amount, from that date onwards, you will have 90 days time limit. Why this 90 days? Statement, preparation of statement containing latest known address is also important. Address, amount of dividend unclaimed or unpaid. Next one, first of all, members details of the members. Latest, last known address is also important. That statement shall contain members details, those whose dividends are unclaimed or unpaid. Next one, latest known address. Next one, amount of dividend pending. And from this date onwards, wait for 7 years. How many years? This date onwards means what? When you transferred amount to unpaid dividend account, from that date onwards, within 7 years, if no one is coming and claiming those amounts, after expiry of 7 years, transfer amount to IEPF account. If dividends are not claimed 7 consecutive years, along with dividends, shares shall also be transferred to IEPF account. Getting my point? Suppose if company makes any default in transferring the amount within 7 days, within how many days? Within 7 days. Interest shall be added. How much? 12%. And that interest shall be distributed among the eligible members, claimants. Clearer? Limits clearer? I'm just pointing out the limits. 5 days deposit, 30 days payment. But these deposit rules are not applicable to 100% government companies. Dividend shall be paid only to the registered shareholders, orders, bankers. Dividend can't be paid by a purchaser. Dividend can't be claimed by a transferee. Simply purchaser means transferee until his name is registered. Correct. Next one, dividend on partly paid shares. Yes, proportionate dividend company can pay subject to AOA. Next one, dividends payable in cash, not in kind. Correct. Can I pay dividends in kind? No, only in cash and through banking channel only. Within how many days? 30 days from declaration. Of course, I can utilize profits for capitalization purpose. That means bonus issue also permitted. For Nidhi companies, If not claimed within 30 days of declaration, transfer that amount to member account. That means in book record that entry. That amount make member as a creditor. Whenever member comes, pay that amount. Prohibition on dividends. Two companies are prohibited from declaration and payment of dividends. Which two companies? Section 8 companies, Section 73, 74, 76 default companies. Section 73, 74 default companies. Company defaulted in repayment of deposits, prohibited from payment of dividends. Section 8 companies are prohibited from payment of dividends. They will not ask you, write this answer. They may narrate a story. A company which committed default has passed a resolution to distribute certain portion of profits in the form of dividends. Whether the action of company valid or invalid. Now you have to write invalid. Okay, now next one, unpaid dividend account. Yes, within how many days? Within 7 days from expiry of 30 days, transfer to unpaid. Fails, interest shall be added. How much? 12% per annum. Company shall add this interest. Next one, statement to be prepared within how many days? 90 days of transferring to unpaid dividend account. Names, last known address is also important. Without this matter, if they prepare statement, it is not a valid statement. This matter is also important. Next one, unpaid dividend. Statement must be published on company website as well as website approved by the government. And finally, 7 years if the dividend is not claimed or unclaimed, transfer the unclaimed dividend or unpaid dividend to unpaid dividend account. Okay, na everyone? If dividends are not claimed for 7 consecutive years, then shares shall also be transferred. But within these 7 consecutive years, any year if he claims dividend, then shares shall not be transferred. During this period, when as long as amount is in unpaid dividend account, you can claim that amount by filing application with the company. Suppose amounts transfer to IEPF. Now by filing application with IEPF, you can also claim those amounts. Punishment for contravention, any delay happened in transferring amounts, any default happens in preparation of the statement, filing of the statement with publishing statement on CG website or company website. The punishment would be, for company the penalty is 1 lakh rupee and 500 per day during continuing failure, during contravention continues up to 10 lakhs. For officer in default, 25,000 plus 100 per day up to 2 lakhs. Next one, IEPF credits, debits, just give one time reading. Credits, common credits are from repayment date or from refund date. Next 7 years if not claimed, transfer to IEPF. Also remember government grants, donations. Okay. Next one, refunds. Utilization of the fund, you all know. Refund of the above mentioned amounts. Awareness programs, protection, legal expenses. Next one, distribute discharged gains, incidental activities. You remember utilization of fund. No need to remember sources. Sources, deposits, debentures, preference shares, security application money pending for allotment or pending for refund. All these monies, if it is, if company is having these monies for the 7 years, company shall transfer all these monies to the IEPF. Next one, IEPF authority. Who appoints authority? Central government. And who is the chairperson of authority? Secretary of MCA. Other members not exceeding 7. Okay, now who maintains books of accounts? IEPF authority. But form of maintenance, preservation of books of accounts, authority shall take care of it, but all this authority will do in consultation with C&AG. At the end, C&AG prepares annual report and audit report. All these C&AG will not prepare annual report. C&AG will issue audit report. Who prepares annual report? IEPF authority prepares annual report. So this annual report, audit report shall be placed in both the houses of the parliament. Okay, now next one, section 126. This is all about shares held in abeyance, rights, bonus, dividends held in abeyance. When company announced a cutoff date, at that point, company received application for registration of transfer, but that registration didn't happen due to some reasons, like shares involved are partly paid up, intimation not yet received. Now in that case, intimation from a transfer is pending. In that case, don't pay dividend to either transferor or transferee. Keep it hold. Directly transfer amount to unpaid dividend account. But if there is a declaration, if there is an authorization from the transferor, pay dividend only to the transferee, then pay dividends to the purchaser. Until then, everything will be hold. Next one, punishment for failure to distribute the dividends. So what is the time limit for distribution of dividends? 30 days. 30 days completed, but company didn't pay dividends to the members. Then what is the punishment? Company should add interest 18% per annum. Okay, in entire dividends, 2 rates of interest. For unpaid dividends, 12%. For non-payment of dividend within the due date of 30 days, 18% interest. And officer in default, what is the punishment? Imprisonment up to 2 years and fine 1,000 per day during such default continues. Punishment okay, but you need to remember exemptions. What are those exemptions? 5 exemptions are there. That means under these exemptions, even if company is not paying dividend within 30 days, no default. No default, no punishment. What are those 5 exemptions? Operation of law, dispute of ownership, some failure beyond the control of company. That means last point, external factors. Next one, adjusted against lawful dues. Shareholder direction important. Shareholder direction, unable to comply, not sufficient. Communication with shareholder is also required. Okay, na? Out of these 5 points, shareholder directions, adjustment against dues. These 2 points were tested 3 times. So can company adjust dividends against lawful dues? Yes. No punishment under section 127. Finally, for Nidhi companies, instead of following this procedure, if the dividend amount is 100 rupees or less, advertise in one newspaper, local newspaper, publish it on the notice board for 3 months. So person going through notice board or person going through the newspaper will come to the company, Nidhi company, and they will claim dividends. Or else that amount will be shown as a loan from the member. That means creditor. For that amount, member becomes creditor. Whenever he comes, we will pay the amount. With this, dividends completed. So let's continue our revision with the next chapter. Chapter 9, Accounts of Companies, section 128 to section 138. The average expected weightage of this chapter is 6 to 8 marks. But if any multiple choice question, case scenario based multiple choice question comes from this chapter, then the weightage will go up to 12 marks. Clear? So the expected weightage of this chapter, minimum 6 marks. If any case scenario based multiple choice question comes from this chapter, then weightage will go up to 12 marks. So in this chapter, total we are having 11 sections, including section 129A, 12 sections, periodical financial statements. In this chapter, the expected areas of questions, corporate social responsibility with respect to the limits. Next one, NFRA governed entities, which are the entities governed by NFRA. Next one, filing of financial statements with ROC. Last attempt, they asked this question only, filing of financial statements with ROC. Internal audit limits also equally important. Clear? Let's see. Key definitions in this chapter, books of accounts. Books of accounts includes 4 items. What are those 4 items? Receipts, payments, sales, purchases, assets, liabilities, cost records. For all companies, for all trading companies, first 3 items will apply, whereas companies covered under section 148, for them 4 records. Receipts, payments, sales, purchases, assets, liabilities, cost records. Next one, financial statements. Financial statement includes 5 components: balance sheet, profit and loss account, cash flow statement, statement of changes in equity, explanatory statement, explanatory notes. Explanatory notes, simply notes to accounts. But cash flow statement is not required to these companies. Remember this point. Every time when they ask a small company or when they ask about OPC, they will also they will consolidate question, or they will ask 2 questions like this: define OPC, or whether company is falling under small company category or not, whether company is exempted from preparation and presentation of cash flow statements in their financial statements or not. So cash flow statement is not applicable to OPC, small company, dormant company, and private company which is a startup without default under section 92, section 137. Clear? Remember these 4 companies: OPC, small company, dormant company, private company which is a startup with no defaults under section 92, that is filing of annual returns. Section 137, that is filing of financial statements with ROC. Next one, financial year. Financial year with respect to company is different. Financial year with respect to LLP is different. How it is different? With respect to company, And with respect to LLP, the similarity is financial year start date is 1st April, ends with 31st March. But first financial year part is different. First financial year closure date is different for LLP and for company. What is the difference? In case of company, if company is incorporated on or after 1st January, then financial year closure date shall be 31st March of not relevant year, 31st March of following year. So if a company is incorporated on 1st January 2025, then financial year closure date shall be 31st March 2026. And for LLP, the cutoff date is not 1st January, the cutoff date is after 30th September. If LLP is incorporated after 30th September, financial year closure date shall be 31st March of following financial year. Clear? Okay, LLP we will see in LLP chapter, but in company, as per Companies Act, first financial year closure date shall be 31st March of following year in case company is incorporated on or after 1st January. Clear? Everyone? So if any body corporate, any company which is having a holding company or subsidiary company or associate company outside India, for the purpose of preparation and presentation of consolidated financial statements, if such holding companies or subsidiary company or associate company following different period as a financial year, then our Indian company can also follow different period as financial year. For that, whose approval is required? CG approval is required. CG approval is required. Suppose our company C Limited, it is having a holding company in Singapore. Singapore based company, they are following January to December as a financial year. Now C Limited, Indian company, can file an application with central government. Once they get permission, C Limited will also prepare financial statements for financial year, that is Jan to December. Here reporting year will be Jan to December. Clear? Everyone? Next, startup company. Yes, a startup. Which one is a startup company? Only a private company recognized as startup by Department of Commerce and Industry under Companies Act 2013 or Companies Act 1956. A company which is working for innovation or improvement in the existing products or existing services, they can make an application with this department. Once they get recognition of startup, then that private company becomes a startup company as per Companies Act 2013. Next one. Company's financial statements must comply with, tell me, company financial statements shall comply with FAT. FAT stands for F, Form Schedule 3, A, Accounting Standards, T, True and Fair View. So coming to the accounting standards, coming to the Schedule 3 requirements, in Schedule 3 we are having two divisions. One division is for companies following accounting standards, another division is for companies following Ind AS. What is the difference between Schedule 3? Schedule 3 and AS. When we use Schedule 3, when we use AS, AS we use in preparation of financial statements. And presentment of financial statements is in Form Schedule 3. The format is Schedule 3. But while preparing financial statements, one company has to comply with accounting standards. IFSC companies, yes, they can align their financial year along with their holding company even without tribunal approval or central government approval. So IFSC companies, they can follow different period as a financial year even without CG approval. Other entities, other body corporates, they need to make an application with CG for following different period as financial year. Next, section 128, books of accounts. Applicable to all company. Section 128 is applicable to all companies, and that books of accounts shall be prepared in such a way that they should express true and fair view as to the state of affairs of the company, as to the state of affairs of the branch office. That means transactions both at registered office as well as branches shall be recorded, and books shall be maintained on accrual basis, shall be maintained in a double entry system only. So can a company maintain books of accounts on cash basis? No. Can a company maintain books of accounts in single entry system? No. Place of keeping books of accounts. So tell me, where to keep books of accounts? At registered office, or with the board resolution you can maintain books of accounts at any place in India, but intimation shall be given to ROC within how many days? Within 7 days. Within 7 days company shall intimate ROC indicating the address of such place. Which place? Where books of accounts are maintained. Books of accounts at branch office. Yes, if company is having branches, books of accounts related to the branches can be maintained at branch office, but periodically returns shall be submitted to the head office. It must maintain proper books of accounts at that office, which will comply with section 128 subsection 1. That means branch office books of accounts also shall be on accrual basis, Branch office books of accounts shall also be maintained on a double entry system, and they should exhibit a true and fair view. And if a branch is located outside India, then quarterly summary returns shall be sent to the register office. These must be kept open for director's inspection. So tell me, who can inspect books of accounts of the company? Director. Any director, or is there any restriction on director? Any director, whether executive or non-executive, anyone can inspect books of accounts. Can he delegate this power to someone else? No. Only he can inspect books of accounts. Now, who can inspect subsidiary books of accounts? Director authorized by the board. Point 1, any director, any director can inspect companies books of accounts. But subsidiary books of accounts, coming to subsidiary books of accounts, holding company must pass a board resolution authorizing particular director to inspect subsidiary books of accounts. Next one, in that case, officers and employees must provide reasonable assistance. Whatever help they can do, they should provide that assistance during the inspection of books and papers. Next one, financial information maintained outside India. So if a director needs financial information which is maintained outside India, suppose companies having branches located outside India, if director requests for financial information which was maintained outside India, now employees, officers shall furnish that information within how many days? Within 15 days of the request. Within 15 days of director request, employees, officers who are maintaining those books of accounts outside India shall furnish that information. And director can seek information either individually, not through attorney. On this point, question has been asked in September attempt. Some 4 marks question came. So who can carry inspection? Director. As per ICA books, as per ICA suggested answers, only director can carry inspection. And board authorized director can carry inspection of subsidiary books of accounts. Next one, how long books of accounts shall be preserved, ma? At least 8 years. Suppose, sir, period of existence is less than 8 years, sir, then maintain books of accounts for entire period. Sir, central government ordered me to maintain books of accounts for 16 years, sir. Now I should maintain books of accounts for 16 years. Ma, books of accounts means simply, registers, sir. Registers supported with vouchers, sir. Register supported with vouchers. So simply 8 years I need to maintain books of accounts means it's not a assets and liabilities register. It's not only assets and liability register but also assets related invoices. Getting my point? Next, sales and purchases registers. Not only sales and purchase register but also supported by purchase invoices, sales invoices. Everything I should maintain for 8 years. But if period of existence is less than 8 years, then maintain books of accounts for entire period. Next one. Who is responsible for maintenance of books of accounts? Managing director, whole-time director in charge of finance, CFO, or any person charged by the board to comply with section 128. In one attempt, these 2 points were tested for 4 marks. These 2 points, who are responsible for maintenance of books of accounts and what are the consequences if they violate applicable provisions of Companies Act 2013. Now you have to write 4 person names: MD, whole-time director finance, next CFO, any person authorized by the board, charged by the board. And punishment, what is the punishment? Non-compliance, that means accrual basis not followed, double entry system not followed, or periodical updation is not happening, regular updation is not happening. Company officers are not allowing for inspection. Suppose non-executive director came for inspection of books of accounts, MD is not allowing. In that case, all these defaulting persons will get a punishment. How much is the punishment? Minimum 50, maximum 5 lakhs. And if you observe this first point, all these are executive body only. All these are part of executive part only. Executive directors only. Next one, can a company maintain books of accounts in electronic form? Yes. Then conditions to be satisfied. In one attempt, this question came for 5 marks. State the conditions for maintenance of books of accounts in electronic mode. So what are the conditions company should satisfy? Remain accessible in India. The books of accounts in electronic mode must remain accessible in India. Or else they may ask you true or false like this. Can a company maintain books of accounts in electronic mode, remain accessible outside India? Answer is false. Should be in India. Audit trail compulsory from 1st April 2023 onwards. So edit log must track changes. Whatever happened, whatever changes happen to the recorded entries, all those changes shall be tracked. That means recorded. Who is modifying the entry, when modification happened, what is the original entry and what is the modified entry, everything shall be recorded. Yes, it is possible only when audit trail is there, and audit trail can't be disabled. Books must be retained in original format and format that accurately presents the information. So in what base, in how you are giving input. Sir, in English language I am giving input, sir. Output should also be in English language only. It should be in original format. Branch office data should remain unaltered and reflect what was originally received. Next one, electronic record must be legible and capable of being displayed clearly. Suppose you can see this material on the screen. So this is a electronic record. For example, this is an electronic record, soft copy only. So when I'm opening this document, you can see it, whatever I wrote, whatever I typed, only that information you can see, not altered information. Next one, proper system must exist for storage, retrieval, display, printout of the records. Records must not be disposed of unless permitted by the law. So storage facility we need to check, and retrieval, that means whenever we want to view the data, yes, the data should be viewed, displayed. Printout capability should also be there. So this material I can make a printout like that, books of accounts in electronic form. If you want to take any printout option should be enabled. Backup should be maintained in India. And what is the frequency of backup? Daily once. One attempt, this point came for 2 marks. What is the frequency for backup of books of accounts maintained in electronic form? Daily. Can I maintain backup outside India? No, backup should be maintained in India. Next one, filing with ROC with respect to the service provider details, who is providing facility to maintain books of accounts in electronic form. Next one, financial statements. Section 129. Tell me, applicability. Every company, any exemptions are there? Section 129, financial statements applicable to all companies, or is there any company exempted from preparation and presentation of financial statements? No, exemption is there from cash flow statement point of view. But financial statements compulsory for all companies, every company. Financial statement shall give true and fair view, must comply with accounting standards and Schedule 3. For presentation format, Schedule 3. For preparation, accounting standards. Of course, these rules, form, Schedule 3, accounting standards, true and fair view shall not apply to big companies, banking, insurance, generation and distribution of electricity, and certain other companies which are prescribed by the central government. And listed companies must comply with SEBI regulations in addition to section 129. Next one, all the financial statements prepared by the company, all the documents, that means financial statements, audit report, board report, must, company must lay those financial statements before AGM for each financial year for adoption by the members. Next one, CFS. Tell me, CFS is applicable to all companies, companies having subsidiaries and associates. Companies having subsidiaries and associates must prepare CFS, consolidated financial statements. Why? To give true and correct picture about the investment of the public. Suppose you observe, suppose company, for example, TCS company is there. In TCS, paid up share capital of the company is 390 crores. And out of these 300 crores, it made investment in one subsidiary. Investment in subsidiary, for example, 100 crores. Now, if you look at TCS profit and loss account, P&L of TCS, the turnover of TCS is 1.7 lakh crore and the net profit is some 60,000 crores. Net profit 60,000 crores, turnover 1.7 lakh crores. But if you observe carefully, this turnover I didn't generate through 390 crores investment. I didn't utilize the entire 390 crores for my business. I utilized how much amount only? 390 minus investments in subsidiary minus 100. That means I utilized 290 crores to generate turnover of 1.7 lakh crores to generate net profit of 60,000 crores. Then what about the position of these 100 crores? Where this, what is the financial position of these 100 crores? Or what is the financial performance with respect to these 100 crores? That's why you add subsidiary company figures to holding company figures. Adding subsidiary figures to holding figures is nothing but consolidated financial statements. Applicable to which entity? All companies having subsidiaries. But a few companies are exempted from CFS preparation. What are those companies, sir? Any company satisfying these 3 conditions are exempted from preparation of CFS. First one, it should be neither listed nor in the process of listing. Next one, take approval from the members in writing that they had no objection, even if company didn't prepare CFS. And the ultimate holding company or intermediate holding company files consolidated financial statements with ROC. Suppose C Limited is our company. C Limited is having a holding company. C Limited is also having a subsidiary company. Generally, every holding company is required to prepare CFS. But C Limited may get exemption when C Limited gets exemption, if C Limited is an unlisted company, first of all. Next one, C Limited members. Who are the members of C Limited? H Limited and all other members. If they give NOC to the companies, or even if you don't prepare CFS, no problem to us, no problem, no objection. And third condition is H Limited shall prepare CFS considering the figures of H Limited plus C Limited plus S Limited. If H Limited prepares CFS considering the figures of C Limited, S Limited, then that company is exempted from preparation and presentation of CFS. Suppose if C Limited is in the process of listing, or C Limited is a listed company, then this exemption available or not available? Not available. Even one member objects, even if one member gives objection, even if one member files objection, no, company should prepare CFS, then also company should prepare CFS. Next one, manner of consolidation. Manner of consolidation, it should be as per Schedule 3 and applicable accounting standards. Simply, Schedule 3 accounting standards are applicable to standalone financial statements. Similarly, they are also applicable to CFS. A company without subsidiary but only having the associate or joint venture is exempt from consolidating the financial statements. Are you getting my point? So no subsidiaries, sir, only associate, only joint ventures, sir. No need to prepare consolidated financial statements. Consolidated financial statements comes into the picture only when you had subsidiary and associate. Either subsidiary or subsidiary with associate. In case of no subsidiaries, no need to prepare consolidated financial statements. Just value the investments as per applicable accounting standards. Investment in other company, like that. Next one, non-compliance. Non-compliance with AS or Ind AS. If you are not complying with AS or Ind AS, then report the deviations. Which standard you deviated and what is the reason of deviation. Reasons. Next one, financial effects of the deviation. As I told you, valuation of inventory shall be at cost or NRV basis. Cost, imagine 8 crores. NRV, imagine 5 crores. Now how much how much value I should record in balance sheet? How much value I should record in profit and loss account? 5 crores. But I'm not showing 5 crores. I'm showing it as 8 crores. So in that case, I'm not complying AS2. Deviation, not complying AS2. Reason. So sir, in this industry, valuation of inventory will go up and down, sir. Within 1 or 2 months, after balance sheet date, for example, if you take 30th July or 30th June, again the value of inventory came back to the cost, sir. So in our industry, it is very common that inventory will be, the value of inventory may go up, may go down. Next one, financial effect. Because of deviating AS2, 3 crores closing stock has been overflated, 3 crores net profit has been overflated. So indicate these 3 things where when if financial statement deviates with AS. So reports, reports shall form part, this reporting will be in board of directors report. In board report you can see director responsibility statement, whether applicable accounting standards have been followed or not. If not, mention these 3 things. Next, special exemption. CG may grant exemption from compliance of specific class of companies in public interest subject to the conditions. And exemptions are for government companies that comply with requirements under section 137 and 92. So company which is regular in complying with 137, filing of financial statements, 92, filing of annual return with ROC. So government companies can get exemption from the aforesaid provisions. Penalties. First, who are responsible for this section? Same 4 people, same 4 people which you studied in 128. Extra 1 person. Who is that 1 person? Director. Who is the director, sir? All the director. Let's see. First, MD, whole time director in charge of finance, CFO, any person charged by the board. Up to here, common for 128, 129. In 129, in the absence of these people, then all directors will get punishment. What is the punishment? Imprisonment up to 1 year. Fine, 50,000 to 5 lakhs, both. So if you observe carefully, 128 only fine. 129, it's fine and imprisonment. Okay, now next, periodical financial results. Periodical financial results. It is applicable to all unlisted companies. Who prescribe this section? Who prescribe the company's list? CG. CG is having power that to frame that, to decide that unlisted companies to prepare periodical financial results. So what is the frequency, sir? No, for how many months we should prepare periodical financial results? Is it quarterly, or is it half-yearly, or is it monthly? Who will decide? CG decides. Format of financial statements, CG decides. Frequency, CG decides. Frequency means monthly, 2 months, 3 months, 4 months, 6 months once, like that. The board of directors must approve the periodical results. Yes. Even financial statements also approved by the board only. Later adopted at AGM. And these periodical results, periodical financial statements must undergo either a full audit or limited review. Sir, full audit or limited review? It will be decided by CG. CG in future it may prescribe whether full audit required or limited review required. If full audit required, which entities require full audit? Which entities require limited review? All these things CG may prescribe. CG. Filing with registrar. A copy of periodical results must be filed with ROC within how many days? 30 days. In which form? Prescribed form. How much fees? Prescribed fees. If it is annual financial statements, AOC 4. Yes or no? Yes or no? And AOC 4, financial statements are prepared for complete financial year. Now frequency of periodical results, form for presenting, filing periodical results. Who prescribe? CG prescribes. Clear? Everyone? So next section, section 130, reopening of accounts on court order or tribunal order. Is it a voluntary revision or compulsory reopening? Compulsory reopening, you can see there is a court order, there is a tribunal order. First of all, who can file application with court or tribunal? Either CG or income tax authorities or SEBI, any statutory body or any concerned person, maybe a member or maybe an independent director. So they can file application with whom? Court or tribunal. If court or tribunal is satisfied that earlier accounts were prepared fraudulently or company's affairs are mismanaged, that means directors using company funds for their personal purposes. Directors using company funds for their personal purposes, or some money laundering activities are happening, or company is receiving money from the debtors but they are showing it as a deposits in such a way that tax evasion will happen. For example, sale 10 crores and we received that amount from debtor. As a result, what happens? Suppose in a balance sheet, if you observe turnover 100 crores, expenses 70 crores, what would be the net profit? 30 crores is the net profit. On this, if you apply 30% rate of taxation, for example, so tax would be 9 crores. Now to avoid taxes, what management is doing? One particular sale, for example 10 crore sale, they are cancelling this sale. Sale invoice they can cancel, but the point is bank receipt they cannot cancel. In bank statement that receipt is there, 10 crores receipt is there. So that's why what they are doing, they are showing it as a deposit receipts. Deposit is not a turnover, deposit is not an income, deposit is a loan. On loans no need to pay tax. Taxes should be paid only on incomes. So they are showing it as a deposit. Is it an actual deposit? No, it's a turnover. So to avoid taxes, simply on 10 crores, 30% if you apply. To avoid 3 crores tax, what they are doing? They are showing a receipt from debtor as a deposit receipts. So that means accounts were prepared fraudulently or affairs were mismanaged. In these two cases, or in either of these two cases, court, after considering the representations from the applicant, will order for opening the books of accounts. But that opening of books of accounts is limited to how many years? Earlier 8 financial years. Why? As per section 128, company maintain books of accounts only for 8 financial years. Yes or no? Yes. Only for 8 financial years they maintain books of accounts. Suppose if that company is maintaining books of accounts for a period longer than 8 years, then court may order for reopening of books of accounts for a period exceeding 8 years. On this point, 2-3 times question came. Remember this time period of 8 years. Excluding this year, right now we are in the financial year 25-26, right? Financial year 25-26. Excluding this year, last 8 years, that means 24-25, 23-24, like that, last 8 years books of accounts we need to maintain. Can I proceed? Next one, voluntary revision of financial statements or board's report. Voluntary revision of financial statements or board's report. Name itself is clear, voluntary. That means there is no order from authority. We are revising. Why? We are revising financial statements. Why? My company financial statements not complying section 129, or my company board report is not complying 134. Why? Suppose wrong classification of an expenditure. Wrong classification of expenditure. I should charge that expenditure. For example, you take research and development. For example, expenditure incurred during research phase shall be charged to P&L account. Expenditure incurred in the development phase shall be capitalized. Yes or no? Wrongly, research expenditure I created asset in the balance sheet. Instead of charging to profit and loss account, I created as an asset. Now because of this, what is the financial effect? Profit increased, assets increased. So next year, I found that yes, incorrect classification of expenditure I observed. Now what I did, what I can do, I can revise these financial statements, but before revision I need to take approval from independent authority. Why? Transparency, disclosures. Everyone should know why we are revising the financial statements. Suppose in board report also, suppose CSR related policies, CSR committee details, I forgot to include CSR details in my board report. Now I want to revise my board report. Can I revise it? Yes. But before that, prior approval of NCLT is required. Prior approval of NCLT is required. In this entire section, important point, revision is limited to how many times? Can I revise one company 1 year financial statements for more than one time? 2 times, 3 times, possible or not possible? Revision is permitted only up to 1 year. And revision is limited to last 3 years financial statements, last 3 years board report. Suppose now we are in the financial year 25-26. Last 3 years means 24-25, 23-24, 22-23. Correct? So can I change financial statements of 22-23? Can I revise financial statements of 22-23? Yes, only once. Once again, can I revise financial statements, sir? No. Another instance, can I revise board report of financial year 22-23? Yes. Can I revise it once again, sir? No. Revisions are limited to last 3 financial years and only once in a financial year. Once you revised, subsequent revision allowed with respect to that company financial statements? Not. Sir, one instance I revise financial statements, sir. Another instance I want to revise board reports, sir. Possible? Yes, possible. Yes, possible. That means only one time revision is happening to financial statements, one time revision is happening to the board report. Clear? Next one. For getting approval from NCLT, file NCLT 1 with or NCLT within 14 days and file tribunal order with ROC within 30 days of the receipt of NCLT order. But before NCLT give approval, tribunal will notify CG, SEBI, tax authorities, any other relevant party. That means party having interest in that company financials. Suppose if you take tax authorities, yes, because of wrong classification, a profit will change. If profit changes, tax impact will also be there. So income tax authority interest is there. Public interest is there. That's why CG, SEBI will also come. So prior intimation is given to these parties. Who will give intimation to these parties? NCLT. And NCLT will also consider representations from these parties before issuing an order. Only one revision is allowed. A revised statement or report can be filed only once in a financial year. Revision can be done only once in a financial year. Once revised, it can't be revised again for the same period. Next one, detailed revisions for the revision must be disclosed in the board report. What areas you revised. Suppose P&L, research and development expenses. Wrong classification. We capitalized as an asset. Now we are bringing that asset back to profit and loss account. And you need to mention the reasons, overlook. Or we thought that asset, we thought that research is successful. That's why we capitalized it. Later we came to know that the research is not successful. Now we decided to write off that asset in that year only, not in the current year, that year only. Limits of revision. Corrections required to comply with section 129, 134. Non-compliance of AS, non-compliance of schedule 3. Only these revisions are allowed, not other revisions. 134 is all about contents of the board report. If any matter is missing in the board report, you can revise them subject to section 131. So CG is having power to frame rules with respect to how to replace the documents, how to supplement the documents with respect to the revisions, and defining the auditor duties with respect to revised documents, and With respect to directors also the duties. So CG is having power to prescribe rules with respect to replacement of documents, with respect to duties of auditor for revised documents, duties of the director with respect to the revisions. Next one, when you are filing an application with NCLT, that application must include financially related to the accounts, contact details, that means CEO, CFO, no, director, CFO, CS contact details. In case of any discrepancy or in case of any violation they observed, NCLT observes, NCLT will call them for further clarifications. Auditor details, board resolution copy for voluntary revision of financial statements, board report, grounds for revision. So all this information you file it with NCLT, and NCLT will fix a date of hearing. So on that day we will give judgment, for example, whether to approve or not. So 14 days before hearing date, advertise that application in 2 newspapers. Next one, tribunal shall issue notice to the auditor and heard him before passing an order. After approval, general meeting may be called. Reasons for revision must be published in English as well as vernacular languages. At the general meeting, revised financial statement, board report, auditor statement will be considered. Approved revision shall be filed with ROC within 30 days of the general meeting approval. Is this an AGM? No, this is a EGM. And is this a general meeting for adoption of current year financial statements? No, for adoption of revised financial statements related to any one of the preceding 3 financial years. Clear? Everyone? Next, NFRA. In the entire NFRA, I will revise only important points. Just by giving one time reading, you can understand all these points. The role of NFRA in checking the accounting standards, in verifying the standards on auditing, and ensuring that auditors work is getting improved. Auditor is performing his duties effectively and efficiently. Everything, it's like just. So the role of NFRA is to ensure that auditors are complying with sufficient, NFRA observes that whether auditor is complying applicable standards on auditing or not. If any auditor is negligent, NFRA will immediately question that auditor, will immediately remove that auditor from the audit office. Why? Because in a company, public interest will be there, employees, next debtors, creditors, investors, government, all these people are connected to the company. So any fraud happens in the company, and if auditor is negligent, definitely all these people interest is getting affected. So simply NFRA is like a similar to auditor. NFRA is not an auditor, but similar to auditor, like it's a watchdog. It observes that whether all the auditors are complying with applicable SAs or not. That's it. So composition of NFRA. So who is having power to appoint members to the NFRA? CG. The head of the NFRA is chairperson, and other members not exceeding 15. That means total 15 members, including part-time, full-time. But in executive body, you will find only full-time members. Next one, part-time members include following people. Just give one time reading. CG may also appoint a secretary and other employees as needed for efficient functioning of the NFRA. So meetings of NFRA, books of accounts of NFRA, everything, who will prescribe? CG prescribes. Headquarters of the NFRA is at New Delhi. So in this entire section 132, this point you have to remember. So which are the companies governed by NFRA? What are the companies governed by NFRA? Let's see. First one is listed company. Whether that listing happened in India or outside India, listed companies. Second one is unlisted public company, fulfilling any one of these 3 criteria, satisfying any one of these criteria. What is that criteria? Paid up capital 500 crores or more, annual turnover 1000 crores or more, outstanding loans, debentures, deposits 500 crores or more. When these limits are as of 31st March immediately preceding financial year. Any one criteria satisfied, then that unlisted public company is governed by NFRA. Special entities, simply big companies as well as statutory companies, banking, insurance, generation and distribution of electricity. Next one, special acts, statutory companies, body corporate incorporated by an act. Next one, entities referred by CG. Next one, material subsidiary companies, material associate companies. Material means how much, sir? In the consolidated figures. In the consolidated figures, if 20% of turnover or if 20% of the net worth is coming from a single subsidiary or a single associate company, then that subsidiary, that associate becomes a material subsidiary. Consolidated basis, total basis, any single company, if it is contributing 20% turnover of the consolidated figures or 20% net worth of the consolidated figures, then that subsidiary or associate becomes material subsidiary, material associate company, and they are also governed by NFRA. So what are those 5 entities, ma? Securities listed either in India or outside India. Unlisted public company, limits 100, 1000 to 500. Sorry, 500, 1000 to 500. 500 paid up capital, 1000 turnover, 500 outstanding debt, loans, debentures, deposits. Next is all special entities, big companies, banking, insurance, electricity, statutory companies, statutory body corporates. Next one, entities referred by CG. And last one, material associate companies, material subsidiary companies. Next one, approval of financial statements by board of directors. Approval of financial statements by board of directors. Tell me, authentication of financial statements. Who authenticates financial statements? Chairman if authorized by board. Chairman if authorized by board. If no chairman or if chairman is not authorized, then 2 directors, one must be managing director. Clear? First one over. Second point, if CEO, CFO, CS has been appointed, these 3 people will sign. Sir, CS not appointed, sir. CEO, CFO there, sir. Then CEO, CFO should sign the financial statements. Clear? Next. With respect to OPC, if OPC is having a single director signing financial statements is sufficient. Those signed financial statements are sent to auditor for audit report. Next one. We need to circulate financial statements among the members of the company. Financial statements means what? Audited financial statements are unaudited financial statements are audited. That means financial statements shall be attached to audit report, board report. Yes or no? If company is having subsidiary companies, then consolidated financial statements. One more point, board report. Company prepares board report based on standalone financial statements, based on consolidated financial statements. Every company has to prepare board report. That board report is based on standalone financial statements of the company or consolidated financial statements of the company. Standalone financial statements. It's not consolidated. It's standalone only. Okay, next one. Contents of the board report. Just give one time reading. One time reading enough. But contents of director responsibility statement is very important. Signing of board report is important. I repeat, signing of board report is important. Signing of financial statements is important. Contents of director responsibility statement is important. So yes, signing of financial statements, just now I told you. Chairman if authorized or not, 2 directors. CEO, CFO, CS if appointed. 2-3 times question was asked like this. They narrated a story, they named few persons as a directors, managing directors, additional directors. Except managing director, other directors signed the financial statement. Now whether signing valid or invalid. Why? One should be managing director. If chairman is authorized, then director signature is not at all required. Why? Who is authorizing chairman to sign financial statements? Board of directors. Then director signature is not compulsory. Next one, signing of board report. In case of signing of board report, just forget about CEO, CFO, CS because they are not directors. So who will sign? Who signs board report? Chairperson if authorized. Not authorized, sir. Then 2 directors. Out of 2, one must be managing director. Clear? Next one. Next one. Contents of the director responsibility statement. How many points are there? 6. Remember, 6. How many? 6. First one. Accounting policies applied consistently. Going concern assumptions satisfied. Internal financial controls are there and they are operating effectively. Proper systems we designed so that our assets will be safeguarded. Safeguarding of the assets. I'm just telling about keywords only. Next, financial statements complied accounting standards. And last one, we are having a system to ensure that all applicable laws, rules and regulations have been complied with. Clear, Amma? Accounting standards, remember accounting standards, accounting policies consistently we applied. Next one, in case of departure from accounting standards, yes, I told you, deviation, you need to report the deviation, reason for deviation, and last, financial impact of deviation in the financial statements. Accounting policies applied consistently, adequate accounting records to safeguard the assets, going concern basis, internal financial controls, but this is applicable for listed companies, that means companies whose securities are listed on recognized stock exchanges. Proper systems are devised to ensure compliance with the applicable laws and they found adequate and effectively. CSR. In CSR, important points. CSR activities includes activities prescribed in Schedule 6. 6 or 7 or 7. Schedule 6 is for infrastructure projects. Schedule 7. CSR activity includes all the activities specified in Schedule 7. But CSR excludes 6 activities. How many? 6. R&D included or excluded? Research and development included or excluded? Excluded. But only for laboratory companies. With respect to COVID, R&D from 2020 to 2023, these 4 years included. Next one, sponsorship excluded. Training, sports training excluded, included, excluded. But if we are giving, if we are giving a training to the Indian sports persons outside India, either at national level, international level, included. Okay, na? So any activity outside India excluded, except training. That means training part included, other activities excluded. Three covered. What are those 3? Normal course of business, sponsorship activities, activity outside India. Political contribution excluded. Benefit of the employees excluded. Sponsorship, I told you already, sponsorship activities, statutory obligations. 6th one is statutory obligations. For doing the things we need to obtain license from the authority. Now license fees, is it a CSR expenditure? No. 6 points you have to remember. Next one, tell me what would be the maximum portion of administrative overheads in the CSR expenditure? 5%. It should not exceed 5%. Net profit for CSR excludes 2 amounts. What are those 2 amounts? Profits from branches. Which branch? Inside India branch or overseas branch? Overseas branch. Dividend income is also excluded. All dividend income. Dividend income from the company which is already following section 135. Already following 135. So there should be no double impact. Suppose that company already incurred CSR. After incurred CSR obligation, whatever profit left over, they paid dividend to me. Again, considering this dividend income, if I calculate CSR, duplication happens. Okay, no? So overseas branches profits, dividends from the company which is already complying with section 135 are excluded. Next one, ongoing project means it's a project more than 1 year or within 1 year? More than 1 year. It also includes a project initially decided as 1 year project, but it has been extended more than 1 year. But the maximum duration of this project is 3 years. Excluding the year of commencement or including year of commencement? Excluding. When you commenced it, exclude it, max 3 years. And for IFSC companies up to 5 years from commencement of their business, CSR is not applicable. So if company is getting any surplus from the CSR activities, what? If company is getting any surplus from CSR activity, can company use it for business purposes? No, it should be plowed back into the same CSR project, or unspent amount shall be transferred to fund specified in Schedule 7 within 6 months of the closure of the financial year. CSR applicability. 3 figures. Before that, tell me NFRA governance figures. Unlisted public company, 3 figures I told. 500, 1,000, 500. Here 500,000, 500, 1,005. 500 net worth, 1,000 turnover, 5 net profit. Okay, na? So any one criteria satisfied, then immediately they should constitute CSR committee. But in one case CSR committee is not required. Can you tell me in what is the one case CSR committee not required? If CSR expenditure not less than 50 lakhs, if does not exceed 50 lakhs, that means exactly 50 lakhs, sir, exactly 50 lakhs, Committee not required. 50 lakh 1 rupee sir, committee required. And in that committee you will find 3 directors. One should be independent director. Okay, now no independent directors sir, normal directors. For private company 2 directors. Next one, for foreign company 2 persons. One is authorized person, other one is person nominated by the foreign company. Okay, now with respect to foreign companies, we consider only branch operations, India branch operations net worth, turnover, net profit. CSR committee responsibilities, FRM. What is F stands for? Formulate. R stands for recommend. M stands for monitor. Formulate, recommend, monitor. Formulate policy, recommend policies to the board of directors. Once policies are approved, once policies are, once we are implementing the policy, monitor those policies carefully. FRM. And what are the duties of the board of directors? Approve CSR policy, supervise CSR implementation. That means ensure CSR implementation. Mandatory CSR disclosures on website. CSR committee composition, CSR policy, CSR projects approved by the board. So this shall be disclosed on website of the company. Next one. Tell me how much amount company should spend on CSR. 2% of last 3 years average profits. Last 3 years in losses only sir. No need to spend CSR. First of all, no need to have CSR committee also, because CSR expenditure is less than or equal to 50 lakhs. Next one. For new companies, period of existence, average it. That's it. 2 years it is in existence sir. Average by 2 only. Okay, no. Next one. Next important point. What about unspent CSR amount sir? Unspent CSR amount. What about unspent CSR amount? If it is not ongoing project within 6 months of closure of financial year, what should I do? Can I eat that profit? Can I eat that unspent CSR? I should transfer it to fund specified under schedule 7. If it is ongoing project, I am giving you 30 days. Why? Transfer it to separate account called unspent CSR account. And then I am giving you 3 years time to complete that amount, to utilize that amount, or else after completion of 3 years, within 30 days, next 30 days, that amount shall be transferred to unspent CSR account. Any default you do, schedule 7, fund specified in schedule 7. Any default, any non-compliance, non-transferring amounts to unspent CSR account or not transferring to a fund specified under schedule 7, the punishment is for companies 2 times of unspent CSR amount or 1 crore, whichever is lower. Officer, 1/10 of CSR amount or 2 lakhs, whichever is lower. Okay, na? Everyone. Sir, in case of unspent, you told. In case of excess expenditure, what should I do? In case of excess expenditure, you can claim set off in the next, how many years? 3 financial years. Within next 3 financial years, you can set off. That means next year, if you spend 1%, the excess you spend in last year, you can claim set off. Implementation of CSR policy, just give one time reading. CSR reporting. In CSR reporting, impact assessment is very, very important. Impact assessment is not applicable to all companies. It is applicable to company which is spending 10 crores or more on CSR activities. That means if CSR obligation is 10 crores or more, see, if CSR obligation is 50 lakhs, no need of committee. No need of committee. If CSR obligation is 10 crores, impact assessment is required. And again, impact assessment is not required for all projects. It is required only for the projects where 1 crore spending is there. First of all, impact assessment is applicable to companies which is having a CSR obligation of 10 crores. Next one, impact assessment is applicable only to the projects where 1 crore or more spending is there. And how much amount, for impact assessment we can spend? We can spend 2% of the total expenditure or 50 lakhs, whichever is higher. That means, suppose if my CSR obligation is 10 crores, into 2% means 20 lakhs. 20 lakhs or 50 lakhs, whichever is higher, that's what 50 lakhs. That means 50 lakhs I can pay to the agency which is conducting impact assessment. Getting my point? Next, clarifications, just read it once. Few important clarifications by MCA, just read it once. What are eligible CSR activities, what are not eligible CSR activities. Just give one time reading. Next one, rights of the members to the copies of audited financial statements. So every company has to circulate financial statements, audit report, board report among the members, among the debenture trustees, among the entitled persons, at least how many days before general meeting? 21 days before general meeting. For shorter notice, consent is to be taken from the members. What type of consent? That consent is similar to EGM of a company. In case of company without share capital, 95% of the total voting power members should give approval. In case of companies with the share capital, majority of members representing at least 95% of paid up share capital must approve this shorter notice. And for listed companies, if these financial statements are made available for inspection at least 21 days before AGM, it is deemed that listed companies have complied with the provisions, because in listed companies every day, every minute, every second members keep on changes. Now to whom we should send is a matter. Yes or no? Today if you take for example Reliance Industries Limited, some 10 lakh transfers happen, 10 lakh shares are involved in the transfer. ITC 1 crore plus shares are involved in the transfer. Now to whom you send these documents? That's why you make these documents available for inspection. What is availability time? 21 days before AGM. So the time limit is very important. And for Nidhi companies, this is another important point. For Nidhi companies, shares face value up to 1000 or up to 1% of total paid up share capital, whichever is lower, to those people no need to send them in physical copies. Just advertise in local newspaper and publish these financial statements on notice board, not website, notice board. So interested members will come, interested members will verify it. You remember Nidhi company members voting power, there is a restriction. To what extent they can exercise voting power? 5%. 5% or actual rate, whichever is lower, that's it. Next one, manner of circulation. Electronic mode, manual mode. Remember electronic mode. Electronic mode is applicable for persons holding shares in demat form and persons who give written consent. We need documents in electronic mode, that means through email. And for all other companies, all other members, registered mode of delivery, recognized mode of delivery, that is prescribed under section 20 of the Companies Act. Clear? So in the entire financial statements, one more point. If they want, they can also ask this point. If a company is having a subsidiary located outside India, then that subsidiary information, do you think a company should file subsidiary information also with ROC? Yes. Subsidiary financials shall also be filed with ROC. Suppose in that country audit is not mandatory, then file unaudited accounts with ROC. But that account should be similar to Schedule 3. Suppose sir they are not available in English language, sir, then obtain certified translated copy of financial statements. Obtain certified translated copy of financial statements. Clear? That's it. Next, filing of financial statements with ROC. What is the time limit for filing financial statements with ROC? 30 days of AGM if adopted. If not adopted, file provisional financial statements. For file unadopted financial statements with ROC consider them as provisional. Once they are adopted in adjourned AGM, file adopted financial statements within 30 days of AGM. Suppose if AGM is not conducted, then file it with ROC within 30 days from the last day by which AGM should have been held. Also explain the reasons why AGM not held. It must file its financial statements and all required documents. If company fails to hold its AGM in any year, getting my point? So in case of AGM conducted, adopted, file adopted financial statements. Not adopted, AGM conducted, unadopted, sir. File unadopted plus adopted. AGM are not held, sir. Then file financial statements with ROC. And also explain the reasons why AGM not conducted. And applicable forms, just give one time reading, not that much important, but very important is applicability of XBRL filing. And here one more point is very important: once applicable, forever applicable. So to which entities XBRL is applicable? Listed companies, paid up share capital 5 crores or more, turnover 100 crores or more, company required to prepare financial statements as per Ind AS. Once applicable, always applicable. Internal audit. Applicability of internal audit. Tell me, applicable in internal audit, applicability is very important. Listed company, mandatory. Unlisted public company, remember the limits like this: 50, 200, exactly half, 100, 50, half, 25. 50 for capital, 200 is for turnover, 100 is for loans, borrowings, 25 is for deposits. For private company, only these two limits apply. But if you observe this 100 to this 25, it's not on year ending date. It's on any day during the preceding financial year. If any limit has been exceeded, that's it. Just one small question. C Private Limited, a company, paid up share capital is 2 crores. Paid up share capital is 2 crores. C Private Limited, paid up share capital 2 crores. For private limited, paid up share capital is not a matter. Turnover 90 crores. But what is the limit as per internal audit section 138? 200 crores. That means not applicable. Next one, borrowings 85 crores. But as on 30th November 2024, total borrowings is 101 crores. Whereas borrowings as on 31st March is 85 crores. Now tell me whether internal audit applicable for financial year 25-26? Yes. Why? Borrowings exceeded the limit of 100 crores. Clear? And very important to remember, or more. So who can be the internal auditor? CA or CMA, any professional, as decided by the board. Maybe an employee, maybe a practicing person. Who decides scope of internal audit? Audit committee or board of directors in consultation with internal auditor defines the scope of the internal audit. Clear? Everyone? With this, accounts of companies completed. Let's continue revision with the next chapter. Chapter 10, Audit and Auditors, section 139 to 148. Average expected weightage of this chapter is 6 marks. And if your time is good, and if a case scenario based question comes from this chapter, then weightage will go up to 10 marks. In this chapter, important part is disqualifications. First important category, disqualifications. Next one, powers and duties of the auditor. Clear? Can I proceed? Appointment of auditor, applicability of audit committee, all these are secondary concepts. Time limit for appointment of auditor, first auditor, subsequent auditor, in government company, other than government company, everything secondary. So let's see, audit and auditors. Who can become a company auditor, ma? Either individual or firm of auditors can be appointed as company auditor, but that individual should be a chartered accountant. And if you look at the definition of CA as per Companies Act, CA means CA holding certificate of practice. In case of firm or in case of LLP, majority of partners are chartered accountants and practicing in India. Majority of partners are chartered accountants. Chartered accountant means CA with COP, and they should practice in India. Suppose 9 partners are there. In 9 partners, 6 are chartered accountants, 2 cost accountants, 1 company secretary. And if the 6 chartered accountants, out of 6, 5 chartered accountants are practicing in India. 5 chartered accountants are practicing in India. 1 practicing outside India. Now if you observe carefully, majority of partners out of 9, majority means 5. Majority out of 9, majority means 5 only. So 5 partners should be chartered accountants and they should practice in India. Satisfied? Yes, satisfied. So is this firm eligible to act as a company auditor? Yes, eligible. Getting my point? Next one, signing authority. Yes, chartered accountant who is in practice can sign audit report on behalf of the firm or LLP. Next, disqualifications. Body corporate other than LLP. That means LLP qualified or disqualified? LLP qualified, body corporate disqualified. An officer or employee of the company. Company officer, company employee disqualified because no independency. Next one, partner of officer, partner of employee, employee of officer, employee of employee. These 4 persons also disqualified. Next one, person, person, relative, partner. How many persons? 3 persons. Person, that means CA, relative, and as well as partner. If these 3 people are having any disqualification under these 3, in these 3 disqualifications, any disqualification attracted, then also disqualified. That person is disqualified, firm is also disqualified, LLP is also disqualified. Let's see what are those disqualifications. Holding security or interest. If it is a company with share capital, security. If it is a company without share capital, interest. In the company or subsidiary or holding, associate, subsidiary of such holding, CASH plus SH, group companies. In group companies, if they are making any, if they are holding any security, one security, disqualification. But for relative, there is an exception. Exception is up to 1 lakh. After appointment, if this investment exceeds 1 lakh, 1 lakh means what? Face value or market value? Face value. If investment exceeds 1 lakh face value, then 60 days time limit is given for corrective action. Okay, na? Again, these 3 people, person, relative, partner, if they are indebted to group companies in excess of 5 lakhs, disqualification. That means up to 5 lakhs, no disqualification. 5 lakh 1 rupee, disqualification. Again, person, relative, partner, if these 3 people are giving guarantee, or any person giving guarantee to any of these group companies in excess of 1 lakh, that means up to 1 lakh, no disqualification. In excess of 1 lakh, disqualification. Suppose person gave guarantee 1 lakh 10,000 rupees. Now person, firm, complete firm also disqualified. Relative gave guarantee or partner gave guarantee, that's it, disqualification. And here partner refers to business partner. That means he might not be my CA practice partner. Suppose I'm a partner in 2 firms. One is CVSD Associates, practicing CA firm. Other one is some firm which is engaged in business. For example, buying and selling of trading in prawns business. Now here partner refers to not only my practicing CA firm partner, but also business partner. That means prawns trading entity is there, right? In that partner also, any person giving guarantee in excess of 1 lakh or indebted to the company or group companies in excess of 5 lakhs, holding any security, disqualification. From security point of view, relative is having exemption. Up to how much they can hold? 1 lakh face value of securities. Clear? Next one. A person or a firm, whether directly or indirectly, has business relationship. I told you. Suppose I'm a practicing CA and I'm also authorized dealer of Asian Paints. Now what is the relationship between me and Asian Paints? Business relationship is there. So can I be appointed? Am I entitled to act as a company auditor of Asian Paints? No, because there is a business relationship. But if this business is happening at arm's length price, not dealership, any other transaction, if you and in that company, group companies, if you observe cash plus SH plus associate of holding company, with these 6 companies, if you had any financial relationship, and if that relationship is in ordinary course of business, or you are providing permitted professional services permitted by ICA, then also no disqualification. So dealership, disqualification. Ordinary course of business, sir, like Geo recharges, airways, I'm using airway services, but whatever price applicable to other passengers, same price I'm also paying, sir, then it is said to be ordinary course of business at arm's length price. Next one, services, professional services permitted to be rendered by auditor or audit firm, then also no disqualification. Every time remember, general rule is important, but exceptions are very important than general rule. Practical question comes on only on exceptions. Okay. Next one, a person whose relative is a director of the company or whose relative is in employment of the company as a director or KMP. If my relative, here relative means what? I will tell you. Relative definition I will tell you. But my relative is a director of the company or my relative is a KMP, that means CS, CFO, CEO, then also I gets disqualification. A person who is in full-time employment elsewhere, or a person or a partner of the firm holding appointment for more than 20 company audits as on date of proposed appointment. As on date of proposed appointment. That means full-time employee, disqualified. Next one, holding 20 company audits, disqualified for 21st company audit. While calculating these 20 company audits, yes, few companies are to be excluded. What are those companies? OPC, small, dormant, private company with paid up share capital. it's not up to 100 crores, it is less than. Suppose if it is equal to 100 crores, counted. Less than 100 crores, not counted, provided this private company is regular in filing financial statements and annual returns with ROC. Next one, in case of firm, limit 20 is for each partner. 10 partners are there, 10 into 20, 200. Suppose one of the partner is having his own practice. In sole proprietorship also he is practicing. And in that sole proprietorship entity, 20 audits completed. Now this firm will have 180 audits only, because 10 into 20, 200, minus, as a sole proprietor is practicing 20 company audits, minus 20, that means 180 allowed for firm. Next one, convicted by a court. Convicted by court alone is not sufficient. Offense involving fraud required. Remember example? You will remember example only. Offense involving fraud. Suppose accident cases, murder. Remember now? Counted or not counted? Not counted. Only if an offense involving fraud, offense is involved in, if fraud is there in such offense, if conviction is by court, 10 years ban. How many years? 10 years. If it is convicted by tribunal, 5 years ban. And a person is prohibited from providing services under section 144 if he is appointed as a company auditor. That means if any chartered accountant or a firm of chartered accountants providing services under section 144 of Companies Act, that firm is disqualified to act as auditor of the company. But here I'm talking about only 3 companies: company, holding company, subsidiary company. Can I proceed? Next one, subsequent disqualification after appointment. Subsequent disqualification after appointment. That means what? These qualifications I should possess not only at the time of at the time of appointment, but also after appointment during audit tenure. And I should not possess these disqualifications not only at the time of appointment, but also subsequent to appointment. Okay, any disqualification except relative holding securities face value exceeding 1 lakh, except that case, any other disqualification, audit office will be vacated immediately. Whereas relative case, investment of securities, up to 60 days time is there. Why 60 days? To take corrective action. Can I proceed? Next one, officer includes director, manager, KMP, shadow directors, that means promoters. Relative means members of HUF, husband, wife, father, mother, brother, sister, son, up to here all steps also. Whereas son's wife, daughter, daughter's husband, 3 people, remember, son's wife, daughter, daughter's husband, no steps, including wife, including husband. Okay, now again you are asking, sir, what about this? I'm telling you just. Next. Directly or indirectly means, directly means I'm providing services or I'm holding security. Indirectly means my relative or entity in which I'm having interest. Maybe a partnership is there, it is providing services. In this partnership, I'm a partner. If this partnership firm is providing prohibited service, services which are prescribed under 144, then I'll be disqualified. Just look at this word, directly or indirectly. Here, indirectly, the services means one partnership firm is providing services which are prescribed under section 144. In that firm, I'm a managing partner or I'm having some substantial interest in the firm. Now, that firm are disqualified, I also disqualified. Prohibited services. What are the prohibited services, ma? Prohibited services means these are not illegal services. These are legal only. But as an auditor, you are prohibited from providing these services. Accounts keeping, bookkeeping, internal audit, design and implementation of financial information system, actuarial services, investment advisory services, investment banking services, outsourced financial services, management services, any other services as prescribed by the law for the time being in force. Remember the list. If you are providing these services, but still if company wants to appoint you as an auditor of company, chance there or not there? What is the chance? Resign from these services. Next minute onwards you are eligible to act as an auditor of the company. Parallelly you can't provide both audit services and prohibited services. Next one, audit committee applicability. Audit committee applicability, small correction, paid up share capital, limits greater than or equal to. So here audit committee applicability, all listed companies audit committee is by default applicable. Next one, public companies that meet any one of the following criteria. What is the criteria? Paid up share capital 10 crores or more, turnover 100 crores or more, borrowings, debentures, deposits, here deposits also added, borrowings, debentures, deposits, 50 crores or more, audit committee is applicable. In audit committee, you will find directors. Majority of audit committee directors should be independent director. How many directors you will see in audit committee? 3. Majority should be independent. Okay, now what is the process or what is the manner for selection of and appointment of the auditors? Very simple. Audit committee selects auditor and recommends to board of director. Board of director further recommends to members. Suppose if board of directors are not in agreement with audit committee, they will return back that recommendation for reconsideration. If audit committee make reconsideration, no problem. If audit committee is making same recommendation, then board of directors may further, they're having an option to recommend another person as an auditor. Along with that, they need to mention reasons for disagreement with audit committee. Now finally, members will make a choice whom should be appointed as an auditor. Audit committee, in the entire story, forget about audit committee. Board of director will make a recommendation to members. Members appoint by passing resolution. Which resolution? Ordinary resolution. And before appointment, company shall obtain from proposed auditor written consent of such auditor, declaration that auditor is eligible, confirmation that auditor's total company audits does not exceed legal limit. Pending proceedings against the auditor, their partner, their firm must be disclosed appropriately. Pending proceedings with court or tribunal, with ICA also to be reported, to be disclosed. Okay, written consent, I had no problem, NOC simply nothing but. Not disqualified means to accept this audit, it will be within my ceiling limit only and I'm eligible. I'm not disqualified under section 141. And any pending proceedings you report. No pending proceedings, simply tell that no pending proceedings against my company or my firm or on me, like that you mention the point. Next one, appointment of the auditor. Time limits in this entire time limits are important. Companies, how many types? Government to non-government. Auditor, how many types? 2 types. First auditor, subsequent auditor. In case of non-government company, first auditor shall be appointed by board of directors. Fails, then members at EGM within 90 days by passing a resolution. Okay, that auditor shall hold office till the conclusion of first AGM. In case of government company, C&AG, and the time limit is 60 by C&AG. If fails, next 30 by board of directors. If fails, next 60 by members at EGM. If fails, lawmaker stopped here itself, so we should stop here itself. Okay, next one. And how long he can hold audit office? Till the conclusion of first AGM. Subsequent auditors, in case of non-government company, tell me the appointing authority. Appointing authority in case of non-government company, members. Appointment happens in first AGM, that person can continue the office till the conclusion of sixth AGM. In case of government company, C&AG appoints a CA within how many days? 180 days of commencement of financial year, and the appointed auditor shall hold office till the conclusion of next AGM. Okay, every year appointment is required in case of government company by C&AG, 5 years once in case of non-government company by members. Next one, intimation to the authorities. Once you appoint auditor, file ADT1 with ROC within 15 days of appointment. If you are governed by NFRA, also communicate with NFRA. Inform NFRA 1 within 30 days of commencement of the rules. Already rules commenced, sir. Within 15 days, communicate with NFRA. That means very simple. Governed companies, they need to file forms with 2 people. One is ROC, other one is NFRA. Powers of C&AG. C&AG can call for a supplementary audit or test audit. But if he decides to conduct supplementary audit, he should call supplementary audit within 60 days from the date of receipt of audit report. And that supplement audit report shall also be sent to the company members, debenture trustee, other entitled persons presented at the AGM in the same manner and the time as per audit report. Okay, everyone. Next one. C&AG may order a test audit of the company accounts under section 139 subsection Y, subsection 7 if deemed necessary. Test audit, simply test of control. Supplementary audit, audit of specified areas, once again. Or complete audit of financial statements. It's like second audit only. First time already done, C&AG not satisfied, he may order for second time audit, that's supplementary audit. Only test of controls, test of balances, for that test audit he may call for. Who may call for? C&AG with respect to government companies. Casual vacancy. Auditor, oh God. Can I proceed? Yes, listen carefully. If there is any vacancy, that means, auditor is coming out of the office before expiry of the tenure. When? Before expiry of the tenure. The reason may be death of the auditor. Sir, auditor is a firm, sir. Dissolution of the firm, disqualifications or loss of qualification or resignation. We call it as casual vacancy in the office of auditor. Casual vacancy in the office of auditor. But if that, in these casual vacancies, in all casual vacancy, in case of non-government company, board of directors within 30 days shall fill up the casual vacancy. But if it is a casual vacancy due to resignation, then board recommendation, after a board recommendation, within 3 months shall be ratified by the members at general meeting. Understood? Everyone. If it is government company, same time limit, no change in time limit, 30 days. Who appoints auditor to fill casual vacancy? C&AG. If C&AG fails, board shall appoint an auditor within next 30 days. Tenure. An auditor appointed to fill a casual vacancy holds office until the conclusion of next AGM. Whether he is an auditor of government company to fill casual vacancy or auditor of non-government company to fill casual vacancy, both the cases the tenure would comes to an end with the conclusion of next AGM. Next, duties of auditor in case of resignation. Once auditor appointed for 5 years, it doesn't mean he can't resign during the 5 years. If he want, he can resign. But if he choose resignation option within 30 days, how many days? Within 30 days of resignation, he should communicate with company, ROC. If he is an auditor to government company, then he should also communicate with C&AG in form ADT 3. Fails to communicate with them, attracts punishment. What is the punishment? 50,000 or remuneration, whichever is lower, plus 500 per day for continuing failure, up to 2 lakhs. Clear? Everyone. 50,000 or remuneration, whichever is lower, plus 500 per day during such continuing failure, up to 2 lakhs. Rotation of an auditor. Rotation of auditor, is it applicable to all companies or prescribed companies? Prescribed companies. Limits you remember 10 to 50. 2 limits only, 10 to 50. What is this 10 for? Unlisted public company, paid up share capital. Unlisted public company. What is this 50? 50 for borrowings, deposits, debentures. Sorry, borrowings, deposits. Correct. For private company, only one limit. What is that one limit? 50. 50 for paid up share capital, 50 for borrowings, public deposits. Borrowings from banks, public financial institutions. But these limits are not applicable to listed companies. So here, listed companies, no limits. Okay. Here, in these 3 companies, listed company, unlisted company satisfying any criteria, and private company satisfying any criteria. Unlisted public company satisfying criteria, private company satisfying criteria, can appoint auditor for 1 term of 5 years in case of individual, 2 terms of 5 years in case of firm or LLP. Once period is over, 5 years cooling period, that means next 5 years the same person should not be appointed as an auditor, some other different auditor. Sir, if this incoming auditor, that means appointed auditor, or and retiring auditor, that means tenure completed auditor, if they work under common network, then incoming auditor is disqualified. If any partner resigns from outgoing auditor and joins incoming auditor, then also disqualified. If they operates under common network, common brand name, common ownership, then also disqualified. Disqualified for how many years? 5 years. Next one, I told you, there is a transition provision. What is the transition provision? After implementation of this section, immediate vacancy, immediate removal of, immediate vacancy of auditors will not happen. Balance tenure or 3 years. Balance tenure or 3 years, whichever is higher. Auditor can serve. Auditor can audit the financial statements for next 3 years, or balance tenure, whichever is higher. Remember? Everyone. Already 6 years tenure completed. Now how many years firm can continue? 4. Transitional period 3. 4 or 3, whichever is higher means 4. Next, removal of auditor before expiry of the term. Removal 2 ways. One is board initiation, other one is NCLT initiation. In case of board, remember the equation. Remember the equation. Equation is board resolution plus CG approval plus special resolution. Don't change the equation. Board resolution. Once board resolution is passed, within 30 days, file a copy with CG. After you get CG permission, call for general meeting within 60 days of CG approval. At general meeting, take special resolution. So board resolution onwards, application with CG, 30 days. CG approval onwards, special resolution should be obtained within 60 days. Suppose, sir, can I follow like this, board plus special plus CG? No, no, no. You can't alter the equation. Board approval, central government approval, next members approval. In case of IFSC companies, no need to wait for CG approval. 60 days expired, that's it. It is deemed approval from CG. Other companies have to wait for the approval of CG. Okay, na? Next, removal of auditor by tribunal. Where an application is filed by CG or any person concerned, or sometimes tribunal on its own motion. I told you, in reopening of books of accounts. NCLT came to know that auditor acted negligently. Now NCLT, using section 140 subsection 5 power, NCLT can remove the auditor. Clear? If tribunal is satisfied that auditor has acted fraudulently or colluded in the fraud with the directors or officers of the company, it may direct the company to change its application by CG. If CG applies for the auditor removal and tribunal agrees, the tribunal shall make an order that he shall not function as auditor within 15 days of receiving the application. CG may then appoint a new auditor. Prohibition on further appointments. Once convicted by tribunal, 5 years ban. From this company, from all companies where he was appointed as an auditor, all companies where he was appointed as an auditor. And he is also not eligible to act as an auditor for the next 5 years, even in new companies also. If such conviction is by court, 10 years. And persons involved in the fraud, they get punishment under section 447. Appointment of auditor other than retiring auditor. Simply section 115. You remember special notice. Removal of auditor, retiring or removal of auditor, or appointment of another person in the place of existing auditor. Resolution not to reappoint retiring auditor, or resolution for appointment of another auditor in the place of company auditor. So here you all know who can send this notice, ma? Criteria: 1% of the paid up share capital or 5 lakhs, 1% of the voting power or 5 lakhs paid up share capital. Any condition satisfied. If they send special notice to the company, then company has to circulate that notice at least 7 days before general meeting. Company, if it receives written representation from the auditor, then company should also circulate this representation among the members. If not possible, then company shall allow him to read out that representation at AGM. But if auditor is misusing the powers, yes, company or aggrieved party can file an application with tribunal. If tribunal is satisfied that auditor is abusing their right to representation, it can order that representation shall not be sent or read out at AGM. Application for such an order can be made by company or any aggrieved person. Exemption. This provision does not apply if the retiring auditor has completed their mandatory rotation period of 5 years or 10 years. Once tenure completed, no need to remove them. We can appoint some other person in this place. That means 4 years completed, next 1 year also he can continue. But if you don't want to continue him for the next 1 year, then follow this section provision. Okay, next, powers of auditor. So he should be given unlimited access or limited access. Unlimited access to the books and vouchers. He is also entitled to obtain information and explanation from the management, internal management, as well as external parties like bank confirmation, debtors confirmation, creditors confirmation, and is also having right to receive notices and duty to attend a general meeting. He is having a right to report to the members on the examined accounts, and he will also express opinion on the financial statements, whether financial statements are free from material misstatements or not, whether financial statements express true and fair view or not. Next, duties of auditor. In that, first one is duty to report. This report is addressed to board members. In that report, he should specifically express opinion on true and fair view of company financial position, profit or loss, cash flow statement. Auditor shall prepare the report in accordance with Companies Act provisions, accounting standards, auditing standards. If auditor includes any qualification or remarks in the report, they shall provide reasons for such observation. That means what? Remarks alone not sufficient. Why auditor made that remark? Why auditor qualified his opinion? So basis for qualification opinion, basis for adverse opinion, disclaimer opinion, he should give justification also. Additional reporting requirements, in this additional reporting requirements, almost director responsibility statement points will come. In addition to that, whether he has obtained necessary information or not, he need to report it. Whether he received explanation, proper explanations or not, he need to report. Whether proper information, explanations are received or not, whether proper books of accounts maintained or not, whether branch audit is done by branch auditor or not. If not, company auditor shall do audit of branches. If it is not possible, then who appoints branch auditor? Members. But members may delegate this power to directors. So how he is going to deal with branch audit report? Whether financial statements are in agreement with books of accounts or not, whether financial statements comply with accounting standards or not. Next one, if financial transactions that negatively affect the company, comment on those transactions, report those transactions. If any director is disqualified, report it. Next one, qualifications, reservations, adverse remarks related to the maintenance of accounts, you have to furnish. IFC, with respect to IFC, auditor has to comment whether adequate IFC there or not, whether such controls are effective or not. Auditor's report shall also include views and comments on the following. But in this, remember this point, very important. So far not tested, it's a new point. What is all about this point? No money laundering activities. Whether company advanced money so that ultimate beneficiaries are getting that amount, or whether company receiving funds on behalf of some other party. That means these funds belongs to company but they are sending to other persons. Members' interest is getting affected. These funds not belong to company but company is receiving these funds to hold them on behalf of ultimate beneficiaries. So in both the cases, I repeat, in both the cases auditor has to report. And last one, auditor has not found any material misstatements in the company representations regarding the above transactions. Next one. Tell me, audit trail is mandatory from which date onwards? 1st April 2023. Whether audit trail enabled or not. If not, comment. If disabled, comment. If not operating effectively, comment. Duty to sign audit report. Who signs audit report? Auditor. Duty to comply with auditing standards. While conducting audit, he shall comply with auditing standards. And he is also entitled to attend meeting. That means it is a right. It is also a duty. If it is not possible to him to attend general meeting, he can send his representative who is also qualified to be an auditor, simply manager, who is a chartered accountant holding COP. Next point, reporting of the fraud. Fraud, how many types here? One type only. But amount involved in the fraud, estimated amount involved in the fraud. And this fraud is by whom? Who is doing this fraud? Officer, employee. And the amount involved in the fraud, if it is estimated to be 1 crore or more, auditor has to report it to the audit committee if applicable. If no audit committee, board of directors. Within how many days? 2 days. Within 2 days of finding the fraud, report to the audit committee or board of directors. And wait for 45 days. Within 45 days, they should give reply. Once I receive reply, within 15 days, I should communicate with CG. That means I should write a letter addressing to Secretary MCA. If there is no reply from the management, if there is no response from the management, then upon expiry of 45 days of finding those errors, those frauds, within 15 days, communicate with the central government. Manner of communication, everything is there here. Manner of communication, it should be on letterhead, including postal address, email ID, contact number. Auditor shall sign the audit report with the seal, mention their membership number. The report must be submitted in form ADT 4. If fraud amount is less than 1 crore, everything is common, but reporting to central government, no need. And these kind of frauds, board of directors shall disclose these kind of frauds in a board report. So what are the contents of the board report in case of finding fraud which is less than 1 crore? They should report nature of the fraud with description, approximate amount involved, who are the parties involved, and what remedial actions they have taken. Clear? Next one, other related provisions. The auditor need to report about the matters that are prescribed in CARO, and if auditor reports fraudulent matters, if it is in good faith, then it is not in violation of professional duties. Sir, he is violating confidentiality principle? No sir, no. He is reporting to CG as per section 143 subsection 12. So no breach of confidentiality. And this reporting of frauds to CG, reporting of frauds to the board of directors audit committee, applicable not only to company auditor but also cost auditor, also secretarial auditor. Non-compliance, if you are an auditor of a listed company, penalty 5 lakhs. If you are an auditor of other companies, for you penalty is 1 lakh. Clear? My branch office accounts, only 3 points. 3 points. Who do audit of branch office accounts? Company auditor or auditor appointed by the auditor for branch appointed by the members. Members can delegate this authority to the board of directors. If branch is outside India, then that branch can be audited by either CA holding COP or any certified person, any person, any professional permitted by the law which is there in that country. Okay na? Next one, that branch auditor shall report to the company auditor, and company auditor will consider the report of branch auditor. Okay, he may consider it if it is material. If it is not significant, then he may ignore it. Next one, to branch auditor also, reporting of frauds applicable or not applicable? At branch level, fraud 1 crore happened, then he need to follow same procedure. He need to write a letter to the audit committee or board of directors within 2 days. Wait for replies for 45 days. Then file it with a CG within 15 days. Audit remuneration, 2 points. What components are included in audit remuneration? Audit fees, expenses incurred during audit, facilities extended to the auditor by the company. But audit remuneration excludes payment for any other services provided by the auditor at the request of the company. So 4 components you remember out of 4. 1 is excluded, 3 are included. Audit fees included, expenses incurred during audit included, facilities provided to the auditor by the company. All stay expenses, accommodation expenses, traveling expenses, that's facilities. Next one, expenses incurred during the audit for getting confirmation from the expert or appointing audit expert. For valuation of inventory, if it is possible for CA, he can do it. Not possible, sir, he need one expert. He need to recruit one expert. To that expert he will pay remuneration, and whatever remuneration auditor paid to the audit expert, he will get reimbursement from company. That's what expenses. Reimbursement of expenses. Reimbursement of expenses also forms part of audit remuneration. Last but one, cost audit cost records. These are applicable only to the companies which are specified in either table A or table B, and total turnover is 35 crores or more. If total turnover is 35 crores or more, and if that company is covered either in table A or table B, then only applicability of cost records. Then only cost records are applicable. Next, who can, exceptions. Cost records are not applicable to MSME companies. Next one, applicability of cost audit. So cost audit applicability is also prescribed in the rules. Who can be the cost auditor is the point. Who can be the cost auditor? CMA, practicing CMA. Can company appoint one person as a statutory auditor as well as cost auditor? No. If any person is appointed as statutory auditor, he cannot act as a cost auditor. Who appoints cost auditor? Board of directors. And who fix remuneration? Members. Remember, reverse ma. Board of directors appoints cost auditor. Remuneration is fixed by board of directors but ratified by members. Next one, cost audit report submission. Within 180 days of closure of financial year, he need to prepare a cost audit report. He need to submit it to the company. Company will forward it to the central government. Everything is common. Next one, circumstances where retiring auditor can't be reappointed. Loss of qualification, can't be reappointed. Disqualification attracted, can't be reappointed. not giving willingness, not willing, not reappointed. Next one, uh, he didn't give any written consent certificate to the company, not appointed. Next one, resolution has been passed not to appoint retiring auditor, or resolution has been passed to appoint some other person as a company auditor. In all these cases, retiring auditor can't be reappointed. Remember these points, ma. Examination they can ask you. Penalty for non-compliance, section 147, just give one time reading. But in this punishment, unintentional contravention, the punishment to the auditor is 25,000 minimum, maximum 5 lakhs or 4 times of the remuneration, whichever is lower. In case of intentional contravention, it's not only fine, imprisonment up to 1 year and minimum 50,000, maximum 25 lakhs or 8 times of the remuneration, whichever is lower. Whichever is lower with respect to maximum only. Minimum it is 50,000, maximum 25 lakhs or 8 times of the remuneration, whichever is lower. Next one, NFRA and auditor, just give one time reading because it is already covered in section 132. With this, audit and auditors revision also completed.
Let's continue marathon with the next chapter, chapter 11, companies incorporated outside India. The expected weightage of this chapter in your examination is 5 to 6 marks. Small chapter and simple chapter, so don't ignore this chapter. So first of all, what is meant by foreign company? Foreign company means company or body corporate incorporated outside India, having place of business in India and conducts business activity in India. So two conditions to be satisfied. Condition 1, it must be a company or body corporate, either company or body corporate incorporated outside India, and it should have a place of business in India. Suppose if you take any company which is incorporated outside India, having place of business outside India, then it is not a foreign company, it is a company incorporated outside India. Suppose if a company is incorporated in India, having place of business in India or outside India, it becomes company only. Company means company incorporated under Companies Act. You remember the definition, right? So if place of incorporation is in India, then it is an Indian company. Getting my point? So the nationality of company is something not decided by the nationality of the directors, not decided by the nationality of the directors or subscribers. Nationality of a company is decided by place of incorporation. So first of all, incorporation should happen outside India and it should have a place of business in India. That business operations can be carried out by itself directly or with the help of an agent, either physically or through electronic mode. For example, you take Kia company, Kia cars, popular nowadays, Kia cars. So Kia is a South Korean company. It came to India, established one company, one subsidiary company. Getting my point? So Kia Motors Private Limited. Now this is an Indian company. Incorporation happened in India. This is an Indian company. But you take about foreign company. This company is carrying manufacturing operations with the help of Indian company. So the parent company becomes foreign company. Getting my point? I'm not talking about a company in India. It is a company, first of all. I'm talking about parent company. Parent company becomes company, foreign company. Getting my point? Similarly, you take Meta Platforms Incorporation. It is providing platform services to WhatsApp, Instagram, Threads, Facebook. Getting my point? So now they are carrying business operations through electronic mode. WhatsApp we are using in India, and who is providing platform services? Meta Platforms Incorporation. It's an American company. Similarly, you take Netflix. Netflix, it is also a company incorporated outside India, and it is providing services through electronic mode. All these comes under, it is providing services through electronic mode, and those services, yes, a person from India is availing those services. Now it becomes foreign company. Are you all getting my point? So business activity in India may be carried out either physically or through electronic mode. Kia Motors, you can take manufacturing operations are happening in India physically, and you take Facebook, Netflix, Meta Incorporation, Meta Platforms Incorporation, as well as Netflix. So here operations are carried out through electronic mode. Is it clear? Next one, electronic mode. What comes under electronic mode? You just observe carefully. Digital transactions, business to business transactions, business to consumer transactions, data interchange, digital supply transactions. All this comes under electronic mode of business operations. Everyone, suppose you take Amazon, you take Flipkart. So it will enter into a contract with business people, and it will also enter into contract with customers. Like what? First, customer will place an order with Amazon. Yes or no? Amazon will enter into a contract with a supplier. So with respect to Amazon, yes, first is it is entering into a contract with customer, business to consumer. It is also entering into a contract with supplier, business to business. So all these are happening, electronically. Data interchange is happening. Customers data, yes, Amazon is maintaining. Suppliers data, Amazon is maintaining. So whenever customer is placing an order, Amazon is purchasing that product, or Amazon is asking supplier to supply the product. So customer will pay money to Amazon. After a few days, Amazon will return that money. Amazon will transfer that money to the supplier. Accepting deposits, inviting deposits, accepting subscriptions in securities, offering financial services to the Indian citizens. So financial services also comes under electronic mode of business operations. Next one, web-based marketing, advisory, transactional services, financial settlements. Financial settlements, for example, if you purchase classes online, you will be redirected. First, you select the course. Next, you will be redirected to the payment desk. Roser Pay, PayPal, bill payment desk, all this comes under financial settlements service providers. Okay, so if these people are incorporated outside India and providing services in India, then those companies becomes foreign companies only. Online services such as telemarketing, telecommuting, telemedicine, education, research. So digital services also comes under electronic mode of business operations. Next, data communication via email, mobile devices, social media, cloud computing, document management, voice, data transmission. For example, you take cloud, Gmail cloud storage, YouTube also you take, incorporated outside India, but place of business is in India. Yes or no? Now, if you click on any video in YouTube, you get a advertisement. You get an advertisement. Suppose I'm the service provider, or I'm a manufacturer. I contacted YouTube. I paid some money for advertisement in a particular area. So in that particular area, whoever watches that video, whoever opens any video in the YouTube, first my advertisement appears. So I'm taking these services. I'm getting these services from YouTube. I'm availing these services in YouTube. Getting my point? So YouTube incorporated outside India. YouTube belongs to a company incorporated outside India, but it is rendering services in India. Now it also becomes a foreign company. Clear? But remember, one point remember, always from exceptions only question comes. So here exception, electronic security offering subscriptions listings in IFSC do not fall under electronic mode. So we had a concept called Gift City in Gujarat. So that is particularly specified as a SEZ. So even though services are, even though foreign companies, or even though any company is operating in these areas, assume that these services are not getting into the India. It is an assumption, says, even though it is a part of India, physically, geographically, even though it is a part of India, but we gave some relaxations. We gave certain relaxations to the entities operating in this SEZ. Getting my point? So only electronic security offering subscriptions listings in IFSC, International Finance Service Centers, do not fall under electronic mode. Remember this point. Definitely question comes on exceptions only. They will ask you whether it is suppose any company incorporated outside India providing electronic security offering subscriptions listings in IFSC, only IFSC, limited to IFSC, other areas in India, then place of business is said to be in India. If it is in IFSC centers, the two services related to electronic securities offering subscriptions listings, then only it is not rated as place of business in India. It is not a place of business in India. If there is no place of business in India, then it is not a foreign company. It is just a company incorporated outside India. You have to remember two things, ma. One is what kind of services? Electronic security offering subscriptions listings, where those services are getting availed in IFSC centers. Then even though it is incorporated outside India, geographically it is providing services in India, but as per SEZ Act 2005 and Section 2 Clause 42, so it is not qualified as place of business in India. Therefore, not a foreign company. You remember this explanation? Once again, I am telling you. Next one, section 379. It's all about applicability of this Companies Act to the foreign company. Entire Companies Act is not applicable to foreign company. Only chapter 22 is applicable. So specifically, which sections are applicable to foreign company? You can see here. Section 380 to 386. Section 380 to 386. 392, 393 apply to all foreign companies. Sir, then what about the middle sections, sir? 387 to 391. What about these sections, sir? Some 5 sections are there, no, sir? So what about these sections, sir? These sections are applicable to all body corporates offering securities in India. So if a foreign company is offering securities in India, then that foreign company or body corporates are required to comply 387 to 391. Getting my point, everyone? See, for a company incorporated outside India, which wants to conduct business activity in India, for them 382, 386, 392, 393 applicable. But if they are planning to offer securities in India, whether they are having place of business in India or not, whether they are having place of business in India or not, every body corporate offering securities to the public in India, then section 387 to 391 are applicable. Next important point, this is all about deemed public company. Sorry, deemed company, deemed Indian company, not deemed public company. It's a deemed Indian company. Just look at the percentage, just look at the criteria, which company becomes Indian company. If 50% or more, or not less than 50%, or at least 50%, anything is okay, greater than or equal to 50. Okay, next one, at least 50 or not less than 50. All these three terms are similar. At least 50% of paid up share capital, whether it is equity or preference or combination of equity or preference, if this paid up 50% of paid up share capital of a foreign company incorporated outside India is held by one or more Indian citizens, no natural persons, one or more companies or body corporates incorporated in India, it's about artificial person, a combination of both Indian citizens and Indian companies, that means both natural persons and artificial persons, then it is deemed to be, if the above condition is met, foreign company must comply with the chapter 22 and other provisions of this act related to its business in India as if it was a company incorporated in India. Observe carefully, this is the condition and this is the result. This is the condition and this is the result. So what is the condition? At least 50% of the capital. Which capital? Either equity or preference or both, of a company incorporated outside India, held by, who is holding that 50% of the paid up share capital, held by one or more Indian citizens, one or more body corporates or companies incorporated in India. And last one is partly by both, partly by citizens and partly by body corporates. Then that company, even though it is a company incorporated outside India, we assume it as a Indian company. Now accordingly, for all the business operations in India, what happens? All our provisions, all the chapters of Companies Act are applicable. That's it. Getting my point? So simply, to skip the applicability of Companies Act, few people, what they do, they go to Mauritius, they go outside India, they incorporate a company, and that company will have branch office in India. So to that branch, they will try to apply only chapter 22. But now, what lawmaker is telling, your intention is, I am getting your intention, why you incorporated outside India? To avoid entire Companies Act 2013 provisions, only to apply chapter 22, you are doing this kind of malpractices. Now what I am telling you, in this company, which company are incorporated outside India, if 50% or more capital is held by Indian people, Indian companies, Indian body corporates, or by both, then it is deemed to be Indian company. Accordingly, entire Companies Act will apply. Getting it? Next one, duties of the foreign company. Duties of the foreign company. So yes, foreign company means what? Company incorporated outside India, having place of business, tell me, place of business in India, correct? So once they establish place of business in India, within 30 days, from which day? Within 30 days of establishing place of business in India, they should file documents with ROC having jurisdiction over New Delhi for registration. So specifically ROC New Delhi means what, sir? Whether you are establishing your business in Chennai, Madurai, okay, next Mumbai, Hyderabad, Vijayawada, Vishakhapatnam, next Kolkata, wherever you are establishing place of business, you have to file documents with only one ROC. That ROC is ROC having jurisdiction over New Delhi. Getting my point? Actually, companies have to file documents with ROC which is having jurisdiction over your registered office. Suppose your registered office is situated in Mumbai, then ROC Mumbai is applicable to you. ROC Mumbai, to ROC Mumbai you have to file the documents. But coming to companies incorporated outside India, having place of business in India, simply foreign companies, for a foreign companies, ROC is a single ROC, and that ROC is ROC having jurisdiction over New Delhi. It's immaterial whether you are having a place of business, in Tamil Nadu, Karnataka, Kerala, West Bengal, etc., etc. But for you only one ROC is a correct ROC. Which ROC? ROC having jurisdiction over New Delhi. So what are the documents I should file with ROC, sir? Very simple. Certified copy of the charter. So yes, in India, whether company is in existence or not, certificate of incorporation decides. So for a foreign company, yes, certified copy of charter decides the existence of the foreign company. So the document you file in India, we call it as certificate of incorporation. Outside India, those documents may be certified, chartered documents, So I want a certified copy, attested copy of chartered documents. Next one, MOA, memorandum, articles, and any other document defining the company's constitution. In India, it is a certificate of incorporation. Okay. If not in English, a certified English translation must be provided. Suppose Japan companies are or Korean companies are, the language used in the certificate is Korean language or Japanese language. Now you need to translate it into English, but mere translation alone is not sufficient. You should get certified copy. That means someone should certify it, authority should certify it. Yes, whatever there in Korean language, it got translated into English, no words are altered, everything is similar, like that. You should get a certified copy. Okay. The full address of the registered office, principal office of the company. Company is incorporated in Korea, for example. So yes, the address in the Korea you have to mention. Next one, list of directors of the company and company secretary. So you have to provide the details of directors and CS along with these documents. Next one, details means what? Full name, surname, former name, father name, mother name, spouse name, birth date, residential address, nationality, passport details, PAN, occupation. All these comes under what, ma? All this comes under details of the individuals. Membership number is for CS. Membership number is for CS. Next one, name and address of one or more persons in India authorized to accept legal notices and documents on behalf of the company. And this fellow is known as authorized person for this entire chapter. Are you getting my point? This fellow is known as authorized person for this entire chapter. So now, any document to be served to the foreign company, it's enough if you serve the document to the authorized person. And definitely authorized person should present in India. You can select authorized person only the person who is residing in India. Getting my point? So you can't appoint authorized person outside India, because how can I send notices to the company if a person is located outside India? So definitely that person should be located in India. That person should live in India. That person details you have to produce, either one or more persons. Okay. Full address of the Indian office. Branch offices in India. Branch office addresses in India. If you are having two branches, furnish two branch addresses. Three branches, three branches address. How many branches you are having, all those addresses you have to file it with ROC New Delhi. Details of any previous opening, closing of place of business in India. Previously if you came to India, if you have established a place of business in India and closed, so those details also you furnish along with this information. A statement confirming that no director, no authorized representative has been convicted, debarred from the company formation, management in India or abroad. There is no disqualifications on me to incorporate a company in India or to set up a place of business in India. That's what, declaration is required. And my dear students, here on this point one MCQ is also there. In that MCQ options, if you observe carefully, one option contain directors, one option contain director plus CS, one option contains director plus authorized person, and last option contains director plus CS plus authorized person. Now declaration is to be taken from whom? Directors are director plus CS are director plus authorized person are director plus CS plus authorized person are. The answer is director plus authorized person. So important point, ma. MCQ is that case scenario based questions you can observe. So declaration about compliance, declaration about no disqualification. Declaration about no disqualification. Observe carefully. Declaration about no disqualification shall be taken from two people. One is director and the other one is authorized representative. Getting my point? Not from CS. Application process and submission of the documents. The required information shall be filed with ROC within 30 days of establishing a place of business in India. So when the document should be filed with ROC, within 30 days of establishing place of business. Filing shall be done using form FC1 along with the prescribed fees. So the form for communication of establishing place of business in India by a foreign company is FC1. Time limit 30 days. Remember these two. Form number FC1, time limit 30 days of establishing business in India. Next one, RBI and regulatory approvals. The application shall include an attested copy of RBI approval under the FEMA if applicable. Since foreign direct investment is involved, yes, that entry process also requires RBI approval. If additional regulatory approvals are required, they must also be submitted. Suppose you want to start a banking business in India, then RBI permission is required. You want to start a stock exchange in India, SEBI approval is required. If no approval is required, a declaration from authorized representative of foreign company must be provided. Sir, I'm not carrying any activities governed by RBI, SEBI, and foreign direct investments will also not come, sir. Then just furnish a declaration stating that no approvals are required. That's it. If any foreign company ceases to have a place of business in India, it shall immediately give notice of the fact to the registrar. Why, sir? It's not only at the time of opening branch office in India. Filing of forms are required at the time of closure of business also. Closure of business premises in India. Seema, communication with ROC is required not only at the time of opening branch office but also closing the branch office. Opening branch office, for opening branch office, why we need permission? We need permission to start business operations. So at the time of opening, one has to file forms with ROC. Then why at the closure times, or why at the closure time we need to file form with ROC? The reason is, once you file closure form with ROC, from the next day onwards you are not liable to file annual returns with ROC, financial statements with ROC. until you file this form until you file this form, you will be liable to file financial statements for every year, annual returns for every year. Getting my point? So if you comply with this requirement, that means what? If you are closing a business premises in India, if you are closing a branch office in India, the moment you file this form, from the date on which such notice has been given, the obligation or responsibility of the company to deliver any document to ROC shall cease, provided it has no other place of business in India. Next one, compliance for existing foreign companies. Foreign companies which already came to India before Companies Act 2013. That means they came under Companies Act 1956. If they comply Companies Act 1956 provisions, that itself is sufficient. No need of new compliance under Companies Act 2013. Or else if they comply under the provisions of Companies Act 2013, it's sufficient. But compliance is important. Reporting alterations in the documents. No, for the first time when you came to India, you filed FC1. You appointed, for example, Mr. X as the authorized representative, authorized person, and you fixed the Mumbai as place of business. Now any change in the details you furnished along with FC1, like change of authorized person, change of place of business, all the details shall be communicated with ROC. That means alterations made to above documents shall be communicated with ROC. In which form, sir? FC2. Within how many days, sir? Within 30 days of alteration. So within 30 days of alteration, file FC2 and report all the alterations that happened to the documents which you filed previously. Getting my point? Next one, accounts of foreign companies. Accounts of foreign companies. Every foreign company must each calendar year prepare a balance sheet, profit and loss account in the prescribed format, including all the required documents, and also deliver a copy of these financial statements to the registrar. So similar to the requirement of domestic companies, in case of domestic companies also, every year they prepare financial statements and they file financial statements with ROC. Here also they need to prepare financial statements for the operations. They are for the operations in the India only, for business operations they conducted in India. And format schedule 3, documents annexed shall follow chapter 9. So chapter 9 applicable to Indian companies. Similar provisions are also applicable to foreign company with respect to business operations in India. I'm not asking about business operations in the world. I'm asking about business operations in India. So how much turnover you made from India, how much purchases expenses you incurred in India. So with respect to operations in India, what is your turnover, what is your expense, what is your net profit, and what is your liability, what is your asset, simply what is the financial position. So everything shall be prepared in schedule 3, comply with chapter 9. The latest consolidated financial statements of parent foreign company are submitted in its home country under its applicable laws. Yes, a CFS of parent foreign company is also required to be filed with Indian ROC. ROC having jurisdiction over New Delhi. Getting my point? So with respect to branch operations, you prepare financial statements. And the financial statements filed by your parent company in your country's authority, with your country's authority, those financial statements also file it with our Indian ROC. A foreign company with a place of business in India does not necessarily have to follow 31st March as its financial year. Yes, they can follow our financial year, or they can also follow their financial year. Suppose their financial year period is Jan to December. They can follow with the approval of CG. So CG has power to exempt foreign companies from the financial statement requirement of section 381 subsection 1 or apply them with modifications as notified. So exemption from few accounting standards, or exemptions from the requirements of schedule 3, or exemptions from following April to March as a financial year. So who is having power to prescribe rules? CG is having power to frame the rules. Getting my point, everyone? Next one, additional documents to be filed with along with the financial statements. What are the additional documents? You can see here, first they have to furnish the list of all its business locations in India. Suppose they are operating in 4 metropolitan cities, Kolkata, Mumbai, Chennai, Bangalore, for example. So now furnish all the address locations, all the details of these premises along with the financial statements. Also furnish statement of related party transactions, repatriation of profits, transfer of funds including dividends. Related party transactions. So foreign company, any transaction with its directors or entity in which director is having interest, in which director is interested. So those related party transactions, prepare a statement with respect to related party transactions. Next one, repatriation of profits. See, in case of foreign company, so to manage that branch operations, definitely money is required. Money comes from parent company. Parent company is located outside India. So any money coming to Indian branch offices for carrying business operations, after the end of the year, whatever the result is, for example, the result is profit or whatever investment they invested, if they want to take back, we call it as repatriation. Repatriation means taking back, sending back to the origin. So whatever profits branch got in that year, those profits can be transferred to parent company. Not only not only repatriation of profits, but also transfer of funds. For example, yes, branch operations. Initially branch required some $1 lakh, $1 lakh. That means that is a investment made by parent company, or that might be the loan given by parent company to the branch, whatever it might be, either investment or loan given by the parent company. Now if that amount is taken back by the parent company, getting my point, so transfer of funds or any dividends are paid to the parent company, regarding that statement shall be prepared. Including dividends means what? Suppose you take Kia company. Kia is not having branch office in India. Kia, South Korean company, is having a subsidiary in India, Kia Motors India Private Limited. Now Kia Motors, if it is paying dividends, so if it is paying dividends to its parent company, prepare a statement, transfer of funds including dividends. Another example, suppose Meta Incorporation is just having a branch office in India, for example, branch, not a subsidiary. So from this branch, this branch earned a profit of, for example, 1000 crores. So the profit which is taken back by this Meta Incorporation, a company incorporated outside India, yes, we call it as repatriation of profits, taking back the profits. So both, actually no difference at all. In both the cases, transfer of funds, repatriation of profits is there. A repatriation of profits, I'm telling it is for a branch office in India. Transfer of funds including dividend means that branch in India is not it's a subsidiary company. It is having its own existence. Getting my point? Yes, company incorporated outside India can carry business operations with the help of its agent. That agent may be a company. That agent may be a natural person. Getting it? Time limit for submission. So within what time limit I need to submit all the documents with ROCs, or financial statements? Within 6 months after the closure of financial year. If you remember, for OPC 180 days of closure of financial year. If you remember all other companies, 30 days from the conclusion of AGM, 30 days of AGM, financial statement shall be filed with ROC. But if you take foreign company, financial statement shall be filed within 6 months from the closure of the financial year. Clear? Next one, the registrar may grant an extension up to 3 months if a written application is submitted by the foreign companies specifying a reason. So for extension, ROC is having a power to grant extension. And what is the time limit for extension? How long he can give extension? 3 months. Audit of accounts of foreign companies. So who can conduct audit of foreign companies? Obviously, chartered accountant, maybe an individual chartered accountant or a firm of chartered accountants or LLP having practicing chartered accountant. So simply chapter 10 is applicable. Next one, display of name of the foreign company. See, display of the name of foreign company. This section is talking about two things. One is name board at the entrance of the each and every business premises. Second one is official publications. Now you take name board or you take official publications. So the ingredients to be there on the name board and official publications is total three ingredients. One is name of the company, country of incorporation, and third one is if the members liability is limited. Then you have to mention these three: name of the company, country of incorporation, members nature of liability if limited, mention it. In which language, sir? Coming to the board, two languages, that is local language, English language. Next one, local language. But coming to official publications, English language alone is sufficient. Just observe, company name, country of incorporation shall be conspicuously displayed outside every office place of business in India. Along with the name and country, yes, you have to mention, if members liability is limited, then you have to mention, clearly state that in which language, English language as well as local language. See, there is no confusion at all. Name board in two languages. Which language? English language, local language. Official publications. Official publications, only English language. And what are the ingredients to be printed, or what are the ingredients to be there in the name board in the official publication? Three ingredients: name of company, country of incorporation, and last one is limited liability if members liability is limited. That's all about section 382. Just give one time reading. Service on foreign company. Any document served to the authorized person, assume that document has been served to foreign company. Or if you leave that paper at the address which was submitted to the ROC. Address submitted to the ROC means branch office address. Branch office address submitted to the ROC. If you leave documents at a address submitted with ROC, that is also deemed to be valid service of notice on foreign company. By this, it is very clear there is no obligation on a party to serve document outside India. It's enough if they serve document in India, either to the authorized person or to the address address submitted to the ROC. Next one, inspection of books, annual returns. For debentures, section 71 is applicable as if it is an Indian company. For annual returns, section 92 is applicable as if it is an Indian company. And what is the time limit? The time limit for filing annual returns is 60 days from the end of the financial year. Applicable form is FC4. Applicable form is FC4. Getting my point? And for financial statements, FC3. So total 4 forms. My FC1 is for registration of documents, FC2 registration of alteration in the documents, FC3 financial statements, FC4. What is FC4? Annual returns. What is the time limit for filing annual returns? 60 days from the end of the financial year. Next one, coming to the books of accounts, section 128 is applicable to the books of accounts of a foreign company, but in these books of accounts only the details with respect to business operations in India is to be recorded. Okay, so receipts, payments, sales, purchases, assets, liabilities only related to Indian business. And charges, chapter 6 is applicable as if it is an Indian company. Inspection, inquiry, investigation, chapter 14 will apply as if it is an Indian company. And fees for registration of the document. So what is applicable fees? That fees is decided by the authority, central government, and that fees will be as per company for registration of foreign company rules 2014. Next one, in the entire chapter, certified means true copy signed by an authority. It's just not a translated copy. The translated copy should be certified. So certified means verified by an authority having power to verify. Director, in a foreign company, any person whose directions or instructions the board of directors follow, he becomes a director. That means not only a named director, not only a person who has been named as a director, but the person based on whose instructions, if activities are going on, if operations are going on, then that fellow is also deemed to be a director. Place of business. Place of business includes share transfer registration office in India. Getting my point? In India, we are having share transfer, or we are having registration office with respect to transfer of shares. Then can we call place of business is in India? Yes, we can call place of business is in India. Next one is issue of prospectus by the foreign company. Section 387 to section 391. All these are special provisions applicable to all body corporates. Planning to offer securities in India. Their securities in India. This is similar to chapter 3 prospectus and allotment of securities, but chapter 3 is applicable to Indian companies, whereas these sections, section 387 to 391, applicable to only body corporates planning to offer securities in India. Let's see the documents that they need to file. See, first of all, before issuing prospectus, the conditions to be satisfied is every prospectus shall be dated and signed. Yes, prospectus dating is compulsory, signing is compulsory, and includes constitutional documents, say for example certificate of incorporation, MOA, AOA, and name the laws under which company was incorporated, and Indian business address, date and country of company's incorporation, date of incorporation, country in which company got incorporated, whether company is having a place of business in India, if yes, furnish address. Getting my point? See, these points are not applicable to the companies which is already in existence for 2 years. Which points? 1, 2, 3. Constitutional document, laws under which company was incorporated, Indian address where documents can be inspected, including a certified English translation copy. Why? If it is in existence, already 2 years completed, everyone knows about it, and they can download this information from the website. So that's what. But if it is a newly incorporated body corporate, then all these 5 points are compulsory. And remember one thing, the point is, so this information is extra when you compare it with domestic companies. Domestic companies, these information you will not find. Domestic companies, they will comply with chapter 3. They will comply with chapter 3 of the Companies Act. But coming to the foreign companies, additional requirements are constitutional documents, company law under which it got incorporated, address in India, which address, branch office address, date and country of companies incorporation. Yes, if you observe carefully, the third point as well as fifth point, if you observe carefully, whether company has a place of business in India. If yes, provide the address. Sir, if no sir, then it is not a company, it is not a foreign company. No, yes, if there is no address in India, if there is no address in India, it is not a foreign company, but still it is a body corporate. Why? It is a company incorporated outside India. What I told you at the beginning of this chapter, section 387 to section 391 applicable to all body corporates, whether they are having place of business in India or not. So if this body corporate is offering securities in India, then 387 to 391 are applicable. Clear? So yes, to this section, foreign company, it's not only foreign company, all body corporates incorporated outside India, they can also offer securities in Indian markets. Then they should require, they are required to comply with the requirements of section 387 to 391. Any condition requiring applicant to waive compliance, it's like agreement in restraint of legal proceedings. Agreement in restraint of legal proceedings is simply void. Next one, application form. Application form shall be issued with a prospectus. This is similar to abridged prospectus ma. Application form shall be issued along with the prospectus, or else that application form is in not as per the provisions of the Companies Act, so punishment comes. But that application form doesn't require any prospectus if that form is issued in connection with invitation to the underwriters. So if you want to enter into an agreement with underwriters, for that if you are issuing a form, that form doesn't require any attachment of the prospectus. Exemptions, section 387 does not apply to the prospectus or forms issued to the existing members. Correct? If shares are being offered to the existing members, prospectus required or not required. Or if shares belongs to the class of securities which are already issued and listed on the recognized stock exchange, in this case also prospectus is not required. See, prospectus is not required for existing members, prospectus is not required for existing securities which are already dealt on recognized stock exchanges. That means compliance of section 387, filing of registration of prospectus with ROC, registration of prospectus with authorities is not required. However, the document containing offer, that document shall be dated. Dating of the provisions, dating of the prospectus provisions will apply, but registration requirements will not apply. Getting my point? See, if any offer is made to the existing members under rights issue, or if offer is made with respect to the securities which are already dealt on recognized stock exchange, there registration of prospectus with ROC will not apply, but prospectus shall be dated. Next one, expert statement. So section 388, as per Companies Act, when we include expert statement, he first of all he should give a written consent, and he should not be a person connected to the formation, management, incorporation of the company. Next, that expert should not withdraw his consent until a copy of prospectus has been registered, filed with ROC, and disclosure about his consent in the prospectus. So only upon satisfaction of these conditions you can include expert statement. And if you observe carefully, this is very common for Indian companies prospectus also. In Indian company prospectus, if you want to include export statement, same conditions, yes, company has to comply. Next one, prospectus shall comply with section 33, that is all about security form along with abridged prospectus. Section 40 dealt on stock exchanges. So before offering securities, it's important to take permission from the stock exchange. That permission from stock exchange is nothing but listing. A statement is deemed to be the part of prospectus if it appears on the face of the prospectus. That means what? Any document you are filing along with prospectus, the details of the document shall be mentioned, shall be disclosed on the each and every copy of the prospectus. So this is all about disclosure requirement. Next one, registration of prospectus. So a certified copy signed by chairperson and 2 directors. So only signed prospectus can be delivered for registration of prospectus. And who should sign that prospectus? Chairperson of the company and 2 directors should sign it and deliver it to the ROC. And disclosure requirements, prospectus, on the face of the prospectus, yes, you have to mention that the documents you filed with ROC for registration. Prospectus includes any consent to issue prospectus documents, endorsements. So what are the other documents you can add to the prospectus? It is all about expert consent and other documents like underwriters agreements. Getting my point? So appointment of the directors, everything so can be attached along with the prospectus, and they become attachments to prospectus only if they were disclosed on the face of the prospectus. Without disclosure, even if you attach, it is not a part of prospectus. And documents to be attached, you can see here: expert consent, MD appointment letter, manager appointment letter, material contracts entered within last 2 years. One time MCQ asked on this C point. So what is this MCQ? With respect to how many years we should furnish material contracts? Last 2 years. It's not 3 years, it's not 1 year, last 2 years. Remember the time period, last 3 years, all material contracts entered by the company before issuing the prospectus. So those details also shall be furnished and shall be attached. Copy of underwriting agreement, copy of power of attorney, with respect to authorized person. A prospectus is signed by authorized agent. Next one, IDR. The concept of IDR is very simple, ma. So here you can see, body corporate incorporated outside India. They will enter into an agreement with two people. One is overseas custodian bank, because overseas custodian bank means for us, in India, that bank is located outside India, that is overseas custodian bank. And in India we are having a depository, that is domestic depository. First, body corporate will allot securities in the name of domestic depository, but those securities are deposited with overseas custodian bank. Allotted in the name of, you can see, allotted in the name of domestic depository, but custody is with overseas custodian bank. Now this custodian bank and depository will enter into an agreement. So based on this agreement and based on the allotment by the body corporate outside India, this domestic depository will issue receipts in India, and those receipts are tradable on the stock exchanges. Those receipts are known as IDRs, Indian Depository Receipts. So for issuing Indian Depository Receipts, yes, central government is having power to frame the rules. So a foreign company, central government can establish rules covering offers of the IDR, disclosure requirements. Next one, how IDRs are handled in the depository. All these rules, who is having authority to frame? Central government. Next one, foreign company cannot issue IDR unless it meets other requirements, that is SEBI requirements and RBI requirements. Since foreign currency, foreign currency is involved, not directly, but whatever money they are getting, if they utilize that money in India, no problem. If they are taking back to their country, simply conversion is required, rupees into dollars conversion is required. So in that case, what happens? RBI approval is also required, RBI directions should be complied. Next one, compromises, arrangements, amalgamation. This section is all about mergers of the foreign companies. Yes, a foreign company can be merged with Indian company, or Indian company can be merged with foreign company, subject to the guidelines of central government. And that purchase consideration, the consideration for settlement for merger scheme can be settled either in cash or depository receipts, or combination of cash and depository receipts. Only in this way, yes, it will be settled, but not in kind, but not in assets. Getting my point? Either cash will be paid, or issue of depository receipts, or combination of cash and depository receipts. Next one, application of section 34 to section 36 and chapter 20. Yes, ma. In the prospectus issued by the body corporate for offering securities in India, in case of any misstatement, section 34 criminal liability is applicable, section 35 civil liability is applicable, and if any person is fraudulently inducing public to invest in the securities of the body corporate, that person will also get punishment under 36. And under section 34 criminal liability, section 36 the punishment is section 447. 447 punishment is for fraud. Okay, na? So criminal liability, civil liability, punishment for fraudulently inducing the investments. And winding up provisions shall also apply to the foreign company. For that chapter 20, yes, winding up a foreign company, we assume it as not a foreign company, we assume it as an Indian company. Even though it is a foreign company, but we assume it as an Indian company. Accordingly, winding up provisions we will apply winding up provisions. 392. This is a common section. Any violation of chapter 22 for foreign company, punishment 1 lakh to 3 lakhs 50,000 per day. If it is a continuing offense. Officer in default, fine 25,000 to 5 lakhs. Next one, suppose section 380, filing of documents with ROC, that provision has not been complied. If that provision has not been complied and foreign company is carrying business operations in India, then what would be the effect, sir? Very simple. Any person entering into a contract with foreign company, that person can take any action against foreign company, but foreign company taking action against outsider is not possible. Simply, foreign company is liable for all its debts, but foreign company cannot recover a single rupee from outsiders. Very simple. Foreign company sold goods to the debtor. Debtor is not paying money, and that foreign company, can it take action against debtor? No. Creditor supplied goods to the foreign company, and foreign company is, if it is not paying the amount, can creditor claim action against foreign company? Yes. So outsiders can take action against foreign company, but a foreign company cannot take action against outsiders. Even set off, counter claim, all these also not possible as long as they fail to comply section 380. So until they comply with 380, they lose all the privileges. But remember, all the contracts entered by the foreign company are valid. The only point is foreign companies won't get right to enforce those contracts. Outsiders can enforce those contracts against foreign company. Next one, if you are not a foreign company, but if you are using the description that you are a foreign company, you are not a foreign company, but you are using a name like foreign company, then you will get a punishment. You'll be investigated under section 210 and appropriate action will be taken based on the investigation. And coming to the last point, powers of CG exempting foreign companies from Companies Act. CG is having power to exempt few foreign companies or all foreign companies falling in one class with respect to compliance of Companies Act. And from compliance with subscription of offerings, prospectus requirements and related matters in IFSC set up under section 18 of the SEZ Act. This is not SEC, this is SEZ. Okay. So CG is having power to exempt few foreign companies from complying with the provisions of Companies Act. So that's it. This is all about foreign company marathon.